given the fact that base rates, the base effect of core inflation has been increasing. So, I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Saviran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the
Stocks on Wall Street end lower as investors await the Federal Reserve's interest rate decision later tonight. Asian markets have opened on a mixed note as the US and China look to extend their 90-day tariff truce. The GIFT Nifty is indicating a marginally lower start for our own markets. Oil prices surged over 3% as US President Donald Trump ramped up pressure on Russia over its war in Ukraine. Gold prices also edge higher as investors await the outcome of the Fed's policy meeting.
Is the deal with India finalized?
No, it's not.
Okay.
As the 1st of August tariff deadline looms, US President Donald Trump says that a deal with India has not been finalized despite months of negotiations. Hints at import duties as high as 25% if talks do not reach an agreement. And in key results, L&T reports a healthy start to FY26 with robust order inflow that are up 41% from last year. Also keep an eye out for numbers from Tata Steel, where the company is expected to report a decline of nearly 6% in its top line from last year. Power Grid too will be reporting numbers today and is expected to see a close to 11% growth in its revenue. And India's first and largest securities depository, NSDL's 4,000 crore rupee IPO opens for subscription today, which is priced between 760 to 800 rupees a share. The company has raised 1,200 crore rupees from anchor investors ahead of the issue opening. A very important day beckons for our own markets. You're watching Power Breakfast here on CNBC-TV18 in the Mumbai News Centre. I am Hormas Fatakia. Let's first start off with how the Asian markets have started off in today's trading session. It's a slightly mixed picture, if you could call it that. The Taiwanese index is now trading with gains of close to 1%, but the Hang Seng is trading with losses of around 0.5% in today's session early in the morning. But most of the other indices are trading either at the flat line or below it. The Nikkei is trading below the flat line. The Shanghai Composite trades above the flat line with gains of around 0.2%. The Kospi in South Korea, which has been an outperformer throughout this year across the Asia Pacific basket, continues to trade with gains of around 0.5% this morning. So a mixed picture that is emerging from the Asia Pacific screen. We pull up the GIFT Nifty as well. We saw a very healthy reversal from the lows that the index made yesterday. And for today's session, which is is a sandwiched session between the monthly expiry of the Sensex yesterday and the monthly expiry of the Nifty tomorrow. The implied open is suggesting a marginal downtick as of now, just 14 points. But that is the global market action as of now this morning across the Asia Pacific. And let's take you through what the Indian market setup is likely to be this morning, and we'll also tell you the stocks that are likely to be in focus as well. But as we mentioned earlier, right, it was a 3-day losing streak that came to an end in yesterday's trading session. The Nifty closed above the mark of 24,800, and it was a major contributor to that move was Reliance Industries, and if you could see the stock that it moved from 11 a.m. onwards and it closed at the highest point of the day, 2% higher on the stock, was a chief contributor to the Nifty recovery. But it was not only Reliance Industries, it was ably supported by names like HDFC Bank, Bharti Airtel and Larsen & Toubro, as you see the names in the contributors list, including Bharti Airtel as well. But the worry here is that despite the recovery, the Nifty has made lower highs and lower lows. We struggled to cross Monday's high in yesterday's session, and we also managed to break below Monday's low. So 24,598 is the new low that the Nifty made in yesterday's session. Of course, earnings among the key triggers of the day. Well, earnings continue today. 3 more IPOs are opening for subscription, including the NSDL IPO. So we'll total have 6 IPOs open for subscription over the next 2 days simultaneously. The dollar continues to strengthen, and that is something that the market will have to take note of. The dollar index yesterday crossed the levels of 99 in yesterday's trade. Tonight we'll also see mega cap tech results from Microsoft and Meta. We'll also see the all important FOMC rate decision as to what happens there with regards to the future trajectory of interest rate cuts, although this policy is more or less likely to be a status quo. So keep an eye out on that. And of course, the 3 intraday highs remain the hurdles for the Nifty, right? It was yesterday's high of 24,847, Friday's high of Monday's high of 889, and last Friday's high of 25,010 are the key levels for the index. 24,600 now becomes a support level, and the Nifty Bank, though, keep an eye out on that because it has not closed below that mark of 56,000 since the 19th of June. So that remains a very key level for the Nifty Bank. Now, the implied open, as we just saw, is indicating a slightly sluggish start for our own markets. Over to Upasna now, who would list out the stocks that you need to keep an eye out for today. Upasna, good morning.
Good morning. First up, let me start with L&T. Overall, it's a good set of numbers that the company's reported. The order inflow also remains quite robust. The revenue has seen an uptick of 15.5% and net profit has seen a surge of nearly about 30% on a year-on-year basis. Next up is NTPC. It's an overall miss below our poll. Net profit up 6%, while revenue is down about 4% on year-on-year basis. Bank of India is the next one. NII is down 3.3%, but the asset quality of the bank improves with GNPA at 2.9% versus 3.3% sequentially. GMR Airport, the net losses have widened from 142 crore to 212 crores, while the revenue is up nearly about 34% on a year-on-year basis. Dilip Bitcoin revenue is down about 16%. Margin stood at 19.8% versus 15.2% on year-on-year basis. Next up is Triveni Engineering. It's overall a weak set. Profit and margins under pressure. Net profit down nearly about 85% on a year-on-year basis, and revenue is up almost about 23% on a year-on-year basis at 1,598 crores. Next up is GE Vernova T&D India. Overall, it's a strong set of numbers. It's a beat across the board. Revenue has seen a sharp uptick of nearly about 39% on year-on-year basis, and EBITDA margins has sharply expanded from 19% to as high as 29% on year-on-year basis. And lastly, we are watching out for Tilak Nagar Industries as well, as the board has approved a preferential issue of securities worth 2,296 crores. So we'll be looking out for all these stocks today.
Interesting list there, Upasna. Thank you for that update. And lastly, Mangalam joins in with cues from the FNO space. Mangalam, good morning. There's some relief yesterday, but is the Nifty out of the woods according to the FNO data?
Well, there is short covering in index options. That's what led the market higher yesterday. But for it to be out of the woods, there have to be some important levels that the market has to cross. So let's talk about the good news first. The frontline indices ended at the day's high yesterday. And towards the end, we had the advance decline far outnumbering. The advances far outnumbering the declines as well. So there was a fair amount of criss and cross between the green and red lines. And eventually, the green green line showed they were the boss. And then you have the volatility index as well. We've been talking about how that has, climbed almost 20% from the highs. But remember, yesterday, after at one point being higher by about 4%, actually ended about 4.5% lower, telling you that there was a fair amount of unwinding that we saw as well. The unwinding took place in index calls, and that was the up move that was led by yesterday. Short covering by FIs and index calls, they bought around 1,851 crores in index options. But that was just a smidge of a positive up move that we got in the market yesterday, because in index, futures as well as cash, they were sellers. In cash, the FIs sold about 4,600 crores. The DIs bought 6,100 crores, a net institutional inflow of 1,500 crores. But in index futures, they continue to sell. And even in expiry week, they unwound about 3,000 longs, added 3,000 shorts. And their positioning is at 13% long, 87% short. But in the options, like I said, calls, they unwound almost 42,000 short calls and they added 41,000 short puts, taking the put call ratio from a very oversold level of 0.64 to a more realistic level of 0.8 as well. What were the active options? 24,800 call writers, they ran for cover. 24,900 call writers, they ran for cover, as did the 25,000 call writers. But they were replaced by 24,800 put writers and the 24,700 put writers. So if you look at the premiums on all these options, that tells you that there is support between 24,700 to 24,750. That's moved slightly higher, but there is still some congestion above that 25,000 to 2550 mark, which also coincides with the technical levels. So for the market to actually sustain and stay above higher levels, the Nifty 50-day moving average needs to be conquered and closed above, and the Nifty Bank also, the 50-day moving average, which is about 100-200 points away from where the Nifty Bank is right now, needs to be conquered on an intraday basis and closed above too.
We'll keep an eye out on all of these important levels. Mangalam, thank you for that update from the FNO space as well. Take a short break here on Power Breakfast. On the other side, we'll get you a roundup of all that has happened in the White House in our special segment, Trump Watch. Stay tuned. Welcome back. On to the latest Donald Trump related developments. Dia is joining in our special segment, Trump Watch.
Tariff trouble on the horizon. President Donald Trump said that India may be hit with a tariff rate of 20 to 25%, but cautioned the final levy had still not been finalized as the two countries negotiate on a trade deal ahead of an August 1st deadline. Listen in.
India is preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be for India?
They are going to pay 25%.
Yeah, that India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so. Look, they're my friends, and he's my friend.
Is the deal with India finalized?
No, it's not.
Okay, so what rate are you expecting?
Well, we're going to see. But India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and you just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
U.S. Commerce Secretary Howard Lutnick, in an interview to CNBC, said that they have done their job in terms of negotiations with India and that it's now up to Donald Trump to take a final call on the deal. Have a listen.
We put in front of him the deal. He sees the deal and he decides, do I want to do a deal with India or I don't? And that is up to him. We've done our job. They've made offers, but these countries came to the table slowly from what President Trump was hoping for. But of course, from their perspective, no one's moved as fast. For the rest of the world, we're going to have things done by Friday. And Friday is not that far away. So you should expect, we said August 1st is the date that we're setting all these rates. And they are off to the races after that.
And it's not just India in the tariff crosshairs across the globe. Trade tensions with China are also in focus. China and the U.S. agreed Tuesday to hold further talks on extending their tariff truce, but a top U.S. trade official stressed that President Donald Trump would make any final call. Now, the world's two top economies met for a second day on negotiations in Stockholm, with both sides aiming to extend a tariff truce. Now, moving on, the Trump administration is considering halting all wind development on federal lands and in federal waters as the president expands his campaign against renewable energy source he has long criticized. And lastly, U.S. President Donald Trump said Tuesday he did not plan to attend the G20 summit in South Africa, rehashing debunked claims of white citizens being systematically persecuted and killed in the country. That's all for today. Now back to you, Hormuz.
Yeah, thanks to you for that update there. And the US markets also were showing some signs of caution yesterday ahead of some very important macro and earnings data. The S&P 500 retreated from its record highs. There were also uncertainties regarding the progress on trade talks with China, and traders also are bracing for the Fed decision later tonight. Now, both of them, the S&P 500 and the Nasdaq, ended lower after hitting record highs on an intraday basis. And the Dow Jones, which is yet to hit its own record high, fell almost 200 points. Now, the Fed's two-day meet ends tonight, and Chairman Jerome Powell will announce the decision along with commentary on the future trajectory. CNBC's Steve Leisman joins in with the key expectations.
The Federal Reserve is expected to hold rates steady at its meeting this week en route to an expected September rate cut, and respondents to the CNBC Fed survey seeing a three-way tie in the race to replace Fed Chair Jay Powell. Here are the Fed expectations. 100% say no cut in July, but 27% think the Fed should cut. That reflects some agreement with the two Fed governors who many think might dissent at this meeting. 65% expecting the cut in September. The chance of recession falling to 31% from 38% in June and 53% in May, amid more clarity on the tariff impact, along with somewhat better GDP, now at 1.4%, up from 0.8% from the May low. Take a look now, the current rate outlook from the Fed, from respondents. 4.4 is the current, goes down by about 2 rate cuts in, this year, 2 more next year, showing the Fed is still remaining above the neutral 3.3% rate, even with a new Fed chair. But who that next Fed chair will be, well, that's anyone's guess. We have pretty much a three-way tie here. Kevin Warsh at 24%, Treasury Secretary Scott Bessent at 24%, Hassett at 22%, and then Fed Governor Waller at 14%. Bessent has said the president could pick a new Fed chair as soon as December. That would be just a couple months earlier than either former Fed chairs Bernanke or Yellen were nominated. The Powell's tenure or term ends in May.
Steve Leisman there with the expectations from the US Fed later tonight. Let us also listen into what Goldman Sachs Vice Chairman and former Dallas Fed President Robert Kaplan expects from this Fed meet.
I think you're going to see him be balanced and leave his options open, including the option of acting in September. I think he's going to be careful not to get too deeply into tariffs. And, the fact of the matter is there are a number of disinflationary forces that are going on here. Growth is sluggish. There's a regulatory review, should be disinflationary. We have an AI boom, it should ultimately be disinflationary. You have goods overcapacity around the world. Against that, we'll get more resolution, and we're about to get more resolution on what the tariff rates will be. Those will certainly increase costs. The question is, will it lead to persistent price pressures in a disinflationary environment? And the truth is, for this meeting, I think they're not sure. I wouldn't be sure either. But I think they're going to direct attention to September, and I think you'll see them try to be balanced.
That is all the action from the global markets overnight. We take a short break. On the other side, we get your cues from the commodities market. Stay tuned. Welcome back. Now, in a major relief for JSW Steel, the Supreme Court has agreed to hear petitions of both the company and its lenders in the Bhushan Power insolvency case. Ashmit is here to bring in more details and explain why this is a significant development. Ashmit.
Well, big relief coming in for JSW Steel as well as for the lenders in the Bhushan Power and Steel case. The Supreme Court agreeing to hear their review petition in an open court. Now, let's add context to that. Why is that significant? Bear in mind that in the month of May is when the Supreme Court had scrapped the entire resolution plan for 19,700 crore rupees altogether, had sent shockwaves across the IBC space, had sent the clock back by as many as 5 years. And it's after that that a review petition was filed by JSW Steel by the lenders. Now, as is the course, review petitions are decided within the judge's chambers. They don't hear any arguments. It's done within closed doors. And therefore, an application had also been made by both JSW Steel as well as for the lenders, asking for an open court hearing, which would allow them an opportunity to impress upon the court why it's important to overturn this May judgment by the Supreme Court. that relief has been granted. Just yesterday, the Supreme Court passed the order issuing notice, agreeing to hear this petition, issuing notice on the review petition, saying that the Supreme Court will be taking this up on July 31st at 3 p.m. And that's when JSW Steel, as well as the lenders, will be able to make their case. JSW Steel, as a part of its petition, has been arguing that they've managed to script a turnaround for Bhushan Power and Steel. Sales have doubled, revenue has tripled, and that's the argument they'll be leading with on July 31st when the Supreme Court takes up this review petition in the Bhushan Power and Steel insolvency case.
Ashmit, thank you for that significant development there. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. Some rise in oil prices seen overnight.
Oh, yes, a second straight day. And, Monday was 2% of gains, and Tuesday we've seen 3% of added gains come back in case of crude. So with that now, we're trading at a 5-week high. It is $72 a barrel for the Brent prices now. We've been looking at the rising geopolitical tensions and then, of course, improving global trade relations with so many trade agreements happening and on table as well has been supportive for the crude demand going forward. But majorly, it really is about Russia, where after the U.S. president saying that Russia has 10 days now to agree on a ceasefire or face sanctions, you also have statements coming in from the U.S. Treasury Secretary Scott Bessent saying that with the U.S. secondary tariff legislation, if the sanctions on Russian oil come, then China could also be facing higher tariffs if Beijing continues to buy Russian oil. So there are various statements coming in, and this is exactly what seems to be finding its way in case of prices. In focus now is the China PMI data. That's on Thursday. You also have Bank of Japan monetary policy meeting. But ahead of that, you have the U.S. Fed meeting today as well. And statements, tone, etc. is what the street will absolutely cling on to. Ahead of the Fed meeting, you have the dollar index trading at a 1-month highs into the market. And that seems to be putting pressure on various metals. If you look at aluminum, zinc, silver, we have seen declines come in for this one. The ferrous metals are doing well. So steel, iron ore prices trading at around 4-month highs. Gold as well trading slightly higher ahead of the U.S. Fed meeting. So all focus, center and square, is on U.S. Fed meeting today.
All eyes will be on Jerome Powell and company. Manisha, thank you for that update. Now, tsunami warnings have been issued in Japan after an 8.8 magnitude earthquake struck off Russia's east coast. Warnings have also been issued for coastal regions, while lower level advisories are in place for other parts of the country. Japan has also urged residents in affected areas to evacuate immediately as the first tsunami wave hit the Hokkaido island a short while back. Authorities have also warned that subsequent waves could even be higher. We'll keep an eye out on all of these tsunami-related developments as well. But with that, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call on the other side to set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week already, Wednesday morning. Yesterday, the market saw a nice bounce after a while. So there's a fair bit to go in terms of stock-specific coverage, earnings, and of course, the broader market as well. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning. Hi, morning, folks. So still no deal. Yeah. And now there are all these headlines coming saying 25%, 15%, 20% will happen. So, yeah. On tenterhooks as far as India is concerned.
Yeah, maybe too much of tariff talk. Maybe we're giving it too much attention. Let it play out by itself. I mean, but the market's clearly a little bit nervous.
Yeah, I mean, we'll see what happens. Interim deal, perhaps. We don't know. But 1st of August is the deadline. Let's just take it from the top, right, in terms of the new stuff that you need to know as we start today's session. So, President Trump essentially said that India may pay between 20 and 25% tariffs, but it is not yet final. That essentially, I think, summarizes what the US president said. And let me just tell you the context of this, right? I mean, the context was that Reuters had reported earlier that a trade deal, I mean, a US-India trade deal may not come until September or October. And Reuters in that same report said that India could get potentially a higher 20 to 25% tariff rate. So, President Trump was asked whether this is true. And the response from him that India may have 20 to 25% tariff, but not yet final, was with regards to that. It was not an open-ended question to which he said, well, 20, 25%. So I think it's an important nuance in that sense. Actually, let's listen in to President Trump saying this, being asked this, and of course responding.
India is preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be?
That they are going to pay 25%.
Yeah, that India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so. Look, they're my friends, and he's my friend.
Is the deal with India finalized?
No, it's not.
Okay, so what rate are you expecting?
Well, we're going to see. But India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and you just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
So that's the soundbite. I mean, important to note, it was in response to a number, and he kind of sort of agreed with it. So it was not sort of, organic in terms of that response. We don't have to wait very long. We'll see what really happens. But that's the starting point. Now, U.S. equities were modestly lower yesterday. Of course, there is the FOMC, the Fed meeting tonight. Nasdaq was down about a third. The S&P was down a little bit. The 10-year on the U.S. lost about 9 basis points. There was some data as well, some macro data, which at the margin might have made some difference. But, for example, there were treasury auctions, which actually went very strong. So yields did move about 9, and the 30-year but down about 10, 11 basis points as well. Dollar index up about a quarter. Actually, I think we hit about 99 and then cooled off a little bit, just under it, 98.9 or so. Oil prices continued to spike up. So Brent crude about 4% higher, almost at $73 a barrel. I mean, there's no new news except the fact that President Trump again 2 days back, day before yesterday, basically said that Ukraine-Russia ceasefire deadline is being brought forward by, it got to get done in the next 10, 12 days or so. As I said, FOMC, the Fed decision today, we'll hear from Fed Chair Powell, etc., but most likely to be a non-event. So no change expected. And I think we'll hear some of the same stuff, which is we are waiting to see the full impact of tariffs. Had it not been for tariffs, perhaps rates would have been lower. US jobs data later on Friday, perhaps a lot more important. That's the monthly jobs data. We'll tell you how labor market is holding up. There are Meta earnings later tonight. Apple and Amazon report tomorrow. So you got some big tech earnings coming through as well. On US-China, the US Treasury Secretary Scott Bessent said that they are still discussing the terms of a tariff truce extension. The extent The tariff deadline for negotiation expires on the 12th of August, and they're seeing whether they should sort of extend this further. Most likely, perhaps, that is what will be done. Now, just to tie in the levels here, yesterday, of course, as I said, we got a bounce market. As we were saying yesterday, was looking oversold on many short-term matrices. So we got a bounce, decent bounce. And the good thing was that it was actually a very broad-based move. If you just look at the mid and small cap part of the market, especially the small caps, very long list of volume-led gainers, 20-25 names, and we'll sort of talk about some of these individuals ones later on. So yesterday's low, because we had a bounce, becomes important, that we should not break it. 24,598 is that level. And the resistance is 25,998. We put that level out yesterday as well. Only once the market gets above that, you can say that maybe the decline is complete. That is nothing but the 61.8% retracement of the recent decline from the 24th high to the low that we saw day before yesterday. For the Nifty Bank, the low yesterday was 55,843. So similarly, that becomes the important support, which the Nifty Bank should not go below. And resistance similarly is the 61.8%, which is 56,753. So, a bit of a wait and watch. Let's see if you're able to continue with the repair and recovery. But there is this tariff headline as well. We've got to get over that hump as well. GIFT Nifty will give you a quick sense of how we're likely to start. It's a tepid, sideways kind of start, about 30 points lower. Surbi.
Absolutely. Asian markets are actually fairly range-bound, and it's tariff, 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 trade, trade, trade. That's the only headline for two of the largest economies here, India as well as China, because there's uncertainty around both. US futures, by the way, have perked up. I mean, after yesterday's slightly negative session, there's about a 0.25% increase, depending on which US index you're looking at in the futures market. Now, on the trade part, just to go back to the big headline, the uncertainty around any deal with India. Hear out what US Commerce Secretary Howard Lutnick had to say. He was speaking to CNBC in an interview, and he said that we've done our job in terms of negotiations, and now it's entirely up to the US president.
We put in front of him the deal. He sees the deal, and he decides, do I want to do a deal with India or I don't? And that is up to him. We've done our job. They've made offers, but these countries came to the table slowly from what President Trump was hoping for. But of course, from their perspective, no one's moved as fast. For the rest of the world, we're going to have things done by Friday. And Friday is not that far away. So you should expect, we said, August 1st is the date that we're setting all these rates. And they are off to the races after that.
No deal yet with India. Let's see what happens here. With China, at least the commentary has been a little more positive. But again, over here, trade negotiators have once again reiterated that it's President Trump who holds the key. In fact, Scott Bessent, and I'm quoting him exactly, he says the meetings were very constructive. It's just that we haven't been given the sign-off. President Trump has the final say on all the trade deals. This is with respect to working out that pause, an extension of that 90-day pause in terms of China tariffs. So let's see. So this is the big overhang. Not just this, time and again, there's Pharma coming back into the conversation, and we should keep that in mind when we're looking at Pharma stocks, because I don't think we've seen the pricing in of a particular tariff risk when it comes to Indian Pharma. Yesterday, we had a statement, coming again from Howard Lutnick. He says the president will be coming out with the pharma policy in the next 2 weeks, and he says there will be massive tariffs for companies which are not investing in America. So from an Indian perspective, IT's got its own set of issues. There's banking. Pharma has been holding up really well, but these headlines do not inspire too much confidence. So keep a watch on pharma stocks in the next couple of days as well. Central bank action. We've got, some action in Singapore today. The Monetary Authority of Singapore left rates unchanged, but in their outlook, they're acknowledging that the second half is going to be weaker than the first half. So keep that in mind. The Fed, of course, is expected to remain pat, not expected to change rates at all. 98% probability that there'll be absolutely no cut this time around. But let's watch for if there is any dissent between the voting members. That'll give the market some interesting cues and clues. But amidst all this uncertainty on trade and tariff, guess what? The IMF has increased its growth forecast for India and for the world. Global growth in 2025 is now seen at 3%, which is a 20 basis points improvement from their April forecast. And it's seen at 3.1% in 26, which is a 10 basis points improvement from what they expected in April. So it's not looking bad for India. The growth number expected for this year and next year is 6.4%. The IMF feels that the impact of tariffs is not, at least right now, it's not looking as detrimental as was feared earlier. Very quickly to talk about the flows and the levels here. We've seen some buying from those oversold levels. The Nifty finally had a decent day yesterday, but the flows picture is not encouraging, especially if you're looking at the FPI number. Again, we've got a big sell number, 4,600 crores of selling from FPIs. Good buying from domestic institutions as usual, 6,150 crores nearly of DII buying. Earnings, just want to spot one or two quick stocks. L&T has been a very steady quarter. The top line growth is fairly strong at 15%. The market will say, okay, margins haven't moved up, just under the 10% mark. But all in all, it's fairly decent. Good, order flow as well. And GE Vernova could be a real star to look at today because pristine set of numbers, very, very solid performance in line with the way the stock has run up. So Q1, they've delivered. And finally, keep JSW Steel on your radar as well because there's some relief, sigh of relief coming in for the company and the lenders because the Supreme Court yesterday, actually it was a rare thing. They heard the review petition and they've agreed to look at a hearing again, and it's going to be an open court hearing when it comes to the Bhushan case. So that's some positive for JSW as well. So plenty to keep us busy this morning, Nigel.
Well, that's right. But yesterday's bounce was actually encouraging. Yes, we came off oversold levels, but after a while, we're getting some earnings surprises. And you like to see a couple of earnings beats that come in through as well. So yesterday's session was good, but follow-through is going to be important. And if you look at the rollovers picture, well, we have the expiry that will play out, the monthly expiry that will play out tomorrow. And you have both the Nifty as well as the Nifty Bank, the rollovers, if you compare it on D-2 or 2 days before expiry, both are relatively low. So maybe we have plenty more in this series itself, just going by the rollovers data as well. Moving to what the FIs did, well, they added some shorts, no surprises out there. They covered some longs as well. The short positioning at around 87% and more than 1.6 lakh contracts. That's moving to the extreme end. So that was one data point that we highlighted yesterday as well. But if you look at the stock futures, well, out there was some kind of covering that we saw, and there could be some kind of arbitrage as well that's taking place out there, rollovers as well. So difficult to gauge out there, but it appears that at least was on the individual stocks, there was some covering that we saw. Moving to the options data then, and before we do that, just look at this data point. The Nifty on a day-to-day basis is making lower highs. It's also making lower lows. What you would like to see is the Nifty turns this around. Make a higher high, make a higher low. So that's another data point. But as promised, let's go to the options data. And after a while, the bails got taken off from the call writers because they were writing calls aggressively. And that's what's called the PCR to move up to around 0.8. Put writing came back into play. There was a mix of put activity at lower levels as well. And on the upside, you did see that call writers, 24,800, 24,700 call. Well, there was some shedding that we saw at those levels, even the 25,000 calls. So there was some call writers that got a little bit jittery after the bounce we saw yesterday. Though the 24,800 put, there's a mix of activity out there. The premium's around 60 rupees or thereabouts. So, those writers, they'll be hoping that the 24,700 odd level does hold out. So in the near term, we've got a broad range. Yesterday's low becomes a crucial reference point. That's important. And the resistance level comes in at around 25,000 odd. The Nifty Bank, yesterday it showed signs it wants to get past the 50 DMA. On the closing basis, it didn't decisively manage to conquer that. So you'll want the Nifty Bank actually to conquer this 50 DMA and then move to around the 20 DMA. And the other one is Reliance Industries. Yesterday from the day's low actually saw a bit of a recovery. It's pulled back a little bit from the recent peak. But Reliance Industries is some distance away from the 20 as well as the 50 DMA. So you'll want the stock to get back towards that 1,500 odd level. Reliance Industries, the Nifty Bank, they hold the key for the Nifty to bounce back higher from here on.
All right. Well, just quickly, Nigel, thanks for that. Quickly get you some calls, right? This is Pratik Parekh of Novama who says that high valuations and slowing profit of Indian equities are inverting buyer-seller incentives. He says insiders, that is promoters, PEs are on a selling spree, whereas domestic flows are slowing. FI flows are hence now critical, but India's appeal amongst EMs is fading given a high valuation premium and a blunted earnings edge. Essentially, he adds sellers are stimulated while buyers bide their time, and this risks stalling an aging bull market. Even so, he says, policy easing large enough to revive earnings growth could reverse this dynamic. Caution is particularly warranted in small and mid caps given their larger valuation earnings wedge. Okay, we'll have John Stolfers, who's Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, great to have you with us here. Thank you very much. Actually, that I don't know if you heard that line from a local brokerage, Novama, saying, well, insiders are selling, local flow momentum is easing a little bit, and FIs are not exactly all that excited given valuations are high in India, which have always been the case. So where does it leave us, John, in your opinion?
Well, in terms of which market, the S&P 500 or India's market?
India. That was in reference to India.
You know, related to India's market, we'd have to think when you get to different points. Pardon me? I couldn't hear you.
India. Go on, John. We can hear you clearly.
Related, you know, right now what you've got to consider is markets have to take time to get where they're going. A detour does not necessarily a journey end, is what we always say related to our markets. What we think here, where we are right now, is in a period in which we're beginning to see a change in the world order related to the emerging markets, which markets will be a prominent coming out of a diversification of the emerging markets, as well as from within developed international markets, but it'll be likely more pronounced in the emerging markets. And we expect of the major emerging markets, India, Mexico, Korea will likely be among the major emerging markets to benefit from some of the changes that we will see in terms of global trade. And we think that will be reflected in GDP, and ultimately it will be reflected in revenue and earnings growth.
John, hi, good morning. It's encouraging to hear you say that, because there's no deal yet between India and the US. And the US president yesterday said that he could levy up to 25% tariff, which would be higher than some of our competing Asian economies. What's your sense? The other problem with at least the Indian stock market is that earnings aren't picking up and they're fairly subdued compared to what you said. You know, China seems to be doing better now. Even Korea seems to be doing better. So can that keep foreign investors away longer?
Well, I think, you know, anytime that you see a slowing in earnings growth, naturally you're going to find investors are going to begin, some nervous investors, skeptics, and bears will likely take some profits at those particular points. But we've got to say, if you're looking for the trends intermediate to longer term, and I mean 2, 3, 4 years out, which is really what you need to look at, it would seem to us that the new order that we're envisioning is very likely to be realized. And some of this is a result, first of all, of the great financial crisis, followed by the pandemic, and then the disorder in terms of the global supply chain. I think from a perception of the tariff talks that are going on right now, these are highly complex situations to be worked out, and it is quite natural that there will be some volatility that will come into the markets and questioning in terms of where we will likely arrive to as a result of negotiations. But we think that where we are headed, because of the innovation that the United States offers, as well as the potential for manufacturing in other countries outside China. This is not to say that we believe that China will not be still remain a substantial player, but it will not be any longer all roads lead to China when it comes to the global supply chain, but yet it will be shared among countries. From a practical standpoint, it makes all the sense in the world. And usually things work out to genuinely rivers will flow where they're going to flow at the points of least resistance.
All right. Hi, John. Good to see you in this morning. Very quickly, before we let you go, the S&P 500 actually has been quite resilient, but you believe that maybe it has more in store before the end of this year. You're calling for another 10% move from here on. So tell us, what's the target on the S&P 500? And also the dollar index, you know, that's weakened a lot in the last few months. Are you calling for a bottoming out of the dollar index?
Well, let's start with the S&P 500. We came into this year with a 7,100 target for the S&P 500, and we put that in last December. By a little bit after April 2nd, we lowered our target to 5,950 because the markets had gone through a correction, and then almost a bear market at one point. We were down 18.9% from February 19 from the peak to a low on April 8th. From that point, we've rallied, we've regained, we're back at new highs. And we do believe that the process that is beginning to be seen, whether it's with the agreements that have so far been more than sketched out, but still not absolutely locked in stone, but the ones that we've seen with Japan, as well as the most recent one over the weekend with the EU, we think these are pointing the way to the tariffs risks that have been felt by the market, and the concerns about earnings will likely be ameliorated enough to see gains of around 10, 11% from here to the end of the year. And that is in process what we've seen. We've seen a broadening of the S&P 500 rally. If you look at it right now, industrials is the best performing sector on a year-to-date basis, and also from the lows. This would tell us that the market is definitely broadening. And related to the dollar last year, based on the Bloomberg Dollar Index, as I recall, was up about 8%. The dollar this year has fallen, about my recollection, at the depth down around 10%. We saw some strengthening in the dollar that has come back. That is likely going to settle, but still at a point it'll bottom out, but at a position where we expect the dollar will remain the reserve currency of the world. If you consider all currencies being dirty shirts in a basket of dirty shirts, the U.S. tends to be the cleanest dirty shirt, and ultimately it is the dollar is the reserve currency of the world because of the transparency, governance, and innovation the economy has.
If the S&P 500 does indeed do that 10%, 10 to 11%, move up from here, it'll be a great year for U.S. equities once again. Then, good to have you on the show, John. Look forward to the next one. We'll have a longer conversation on India next time you're around. Thanks for joining in. Well, with that, let's move on and talk about the other interactions that are lined up on the show today. At 8:35, we'll have the management of Greenply Industries joining in on the Q1 numbers. Lots of corporate conversations today. At 9 a.m., we'll be talking with the management of Arvind Fashions, talk about how their first quarter has been and their outlook for the year. Remember, the company is also going through a management change. At 9:20, we have Saurabh Mukherjee of Marcellus Investment Managers joining in. He's a market master of the day. Figure out what their stance is on the market now. Mazagon Dock, weak start to the year. Those weak first quarter numbers, is that a one-off? Is there more? Mr. Biju George will detail out that performance at 9:30 a.m. After that, we have the management of the International Gemological Institute, IGI, joining in at 9:40. At 9:50, we'll have Venkatraman Narayan and Joseph Anantharaju of Happiest Minds Technologies, one of the few IT stocks that had a positive reaction after the quarterly earnings. So we'll talk about that. Towards the end of the show, Lata will be in conversation with Rajneesh Karnatak of Bank of India on the bank's first quarter performance.
All right, time to slip in a short break. You've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I give you a sneak peek. L&T, JSW Steel, GE Vernova, GMR Airports, Pyramil and Allied Blenders will be reacting to positive news flow. NTPC, Bank of India, Star Health and Tilak Nagar Industries could be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. So there's some caution across Asian markets, but there's no major slide or anything like that. The Hong Kong market is down about 0.3%. Japan has finally turned positive. 2 days of profit taking in Japan after they got their deal and we had that monster rally. Now there's some green back on the Japanese screens as well. Australian markets are holding up. Mainland China is holding up. But what are we doing? Let's get the implied open. It was down about 30 points last we checked, 40 points lower right now. So brace for maybe another slightly weak opening. Lots of stocks in focus as always. So let's straight away get to our top list to watch this morning, guys. Good morning to all of you. Let's kick it off with the big earnings. Vivek, how's L&T?
Well, good morning, L&T. Very strong set of numbers. Hardly much to complain about. A healthy start to FY26. Order inflow is something that is positively surprised the street, and the execution too is quite strong. The only blip is the margin performance, but the company has not changed the guidance, implying that margin trajectory over the next 3 quarters will be quite robust. So revenues higher by 15.5%, a slight beat, EBITDA higher by 12.5%. EBITDA margins on the consolidated level coming in at 9.9% versus 10.2%, and net profit higher by close to 30%. Now, the EBITDA margin in the core services business is at 7.6%, largely flattish on a year-on-year basis. The EBITDA margin trajectory for the year has been maintained in the range of 8.3 to 8.5. If you're talking about the order inflow for the order gone by in the core business, it's up 41% on a year-on-year basis at 77,000 crore, which is the key positive takeaway as far as the results are concerned. One key development that the company did mention as far as the conference call was concerned for the media, number one, the prospect pipeline maintained at 14.8 trillion rupees. And secondly, the company has said that they're open to opportunities as far as divestment of Nabha Power Plant is concerned.
40% growth in order book, Vivek, right? I mean, that is incredible. We used to wonder a few years ago, 10-15%, will it come, not come? And here you've got a much larger base, very, very strong accretion in order book. Let's just stay with the old economy in that sense. NTPC, Vivek, take us through those as well.
Well, that's right. NTPC, well, this particular quarter was expected to be slightly subdued given the fact that you actually saw slightly muted power demand in the entire quarter. On the back of that, the gross generation trends was something that was slightly muted. But having a look at the numbers themselves, looking at the revenues down 4.2% on a year-on-year basis, EBITDA down 17.5%, margins coming at 24.1% versus 28%, and profitability higher by 5.8%, aided by higher other income. Now, the gross generation, one key metric to track, is almost down 7% on a year-on-year basis, and the commercial generation was down 6.8%. Now, one key positive development that the company has highlighted, and this was something that the street was looking forward to, especially in terms of visibility, is the strong pipeline that they have given, especially when it comes to nuclear power generation. So that is something that the street will look forward to. More details awaited when the company holds its analyst call later.
Okay, thanks for that, Vivek. Well, there's some relief coming in from the Supreme Court for JSW Steel. Ashmit joins us to run us through that piece. Ashmit?
Well, big relief coming in for JSW Steel as well as for the lenders in the Bhushan Power and Steel case. The Supreme Court agreeing to hear their review petition in an open court. Now, let's add context to that. Why is that significant? Bear in mind that in the month of May is when the Supreme Court had scrapped the entire resolution plan for 19,700 crore rupees altogether, had sent shockwaves across the IBC space, had sent the clock back by as many as 5 years. And it's after that that a review petition was filed by JSW Steel by the lenders. Now, as is the course, review petitions are decided within the judges' chambers. They don't hear any arguments. It's done within closed doors. And therefore, an application had also been made by both JSW Steel as well as for the lenders, asking for an open court hearing, which would allow them an opportunity to impress upon the court why it's important to overturn this May judgment by the Supreme Court. That relief has been granted. Just yesterday, the Supreme Court passed the order issuing notice, agreeing to hear this petition, issuing notice on the review petition, saying that the Supreme Court will be taking this up on July 31st at 3 p.m. And that's when JSW Steel, as well as the lenders, will be able to make their case. JSW Steel, as a part of its petition, has been arguing that they've managed to script a turnaround for Bhushan Power and Steel. Sales have doubled, revenue has tripled, and that's the argument they'll be leading with on July 31st when the Supreme Court takes up this review petition in the Bhushan Power and Steel insolvency case.
Okay, all right, Ashwin, thanks very much. So indeed, some relief coming in over there, and that all-important hearing will begin in open court again. Let's move on now and talk about some more numbers. Vamakshi is looking at GE, Vernova, TND. And I guess as the stock kept rallying, at least the numbers seem to be keeping up with those expectations, Vamakshi.
Well, absolutely. So we're not just keeping up with the expectations, in fact, beating them. In fact, last night when I was calculating the numbers, I had to actually double check because it was such a big beat as far as consensus estimates are concerned. Now, the revenue for the company grew by almost 39% on a year-on-year basis, and this was largely driven by exports. They were up almost 78%. The domestic market sales were also up in double digits, up almost 21% on a year-on-year basis. Now, when we look at the cost of goods sold, however, it grew at a slower pace, and therefore we saw an improvement in margins of almost 814 basis points, which is quite massive for a capital good company. Gross profit margins now stood at 48.4%. Look at the EBITDA margin as well. That is too seeing an expansion of almost 1,000 basis points, and it stood at 29.1%. This is one of the highest margins among some of its peers, and resultantly the EBITDA has more than doubled to 388 crores, and the net profit too is more than doubling at almost 291 crores. This is almost a 57% beat as compared to what the street was expecting. The ordering activity though was quite robust. It was more or less in line with what Nomura was expecting. Order inflow was up almost 57%, and the order book stood at 12,960 crores. This is slightly lower than what Nuvama was expecting, but nevertheless a good set of numbers for GE Vernova.
Okay, thanks for that, Vama. Well, going back to Vivek. Vivek, tell us about GMR Airports.
Well, GMR Airports is a robust operational performance by the company. Remember, despite multiple headwinds that the company faced in the quarter gone by, aided by number one, strong traffic movement itself, and number two, aided by the fact that there has been a tariff uptick as far as Delhi Airport is concerned. You've actually seen the revenues higher by 34% on a year-on-year basis, EBITDA higher by 45%, margins coming in very strong, 40.7 versus 37.4% on a year-on-year basis. On the bottom line, there is a loss. However, when you're talking about what the company has said as far as the operational performance is concerned, number one, they've highlighted the fact that the tariff uptick in Delhi has improved the financial profile. Along with that, there is a chance that there could be a further hike as far as tariff is concerned, given that there is a review underway. Now, when you're talking about the bottom line, there is an exceptional expense of 42 crore, which the company says going forward will not be there. So overall, a strong operational performance from GMR Airports this time around.
Okay, all right. Piramal Enterprises and Bank of India, the next two we want to focus on, which is financials in focus. Gaurav has got those. Gaurav, morning.
Well, yes, when we talk about Piramal Enterprise, good set of number is what we saw. Although AUM growth was at around 22%, the company has guided around 25% growth for FY26. And even when we look at the numbers, net interest income that increased almost by 25%. Now operating profit is up more than 50% because of the other income, and total profit is also up almost by 50%. Now, when we look at the asset quality, there also we saw a bit of improvement. The credit cost that has gone down almost by 40 basis points. Although management has said that there is some stress in the used car and MSME segment. Let's not forget that the drag from their legacy book is actually going, and that is the reason why they have given a PAT guidance of around 1,300 to 1,500 crores, which is positive. And after that, we also saw brokerages like Citi, Jefferies, CLSA, all of them, they have upped the target price for the company. When we talk about Bank of India, a weak set of number in terms of net interest margins because they have gone down to 2.55%. Now, management has guided around 2.5 to 2.6% of the NIMs. But let's also look at the numbers. Net interest income that declined almost by 3%. The operating profit that increased by 9%, but that was because of the other income, and profits they have increased by 32% on a year-on-year basis, but that translates into ROA of just around 0.82%, and management is also guiding for ROA of around just 0.9% for the year, which is actually a little bit of negative, and that is something which can be taken in a negative way, and that is the reason why we are watching out on Bank of India as well.
Okay, all right, got it, Gaurav. Thanks very much for that. In fact, we'll be speaking with the management of Bank of India, 10:15. They will talk about their first quarter performance and the outlook ahead for the rest of the year. Mr. Rajneesh Karnatak joining in over the next couple of hours. Let's get back to more earnings then. Yash joining in on Star Health. Was it a healthy set, Yash?
Well, not a healthy set, certainly. The numbers have been weak, though the premium numbers, the net earned premium, has been stronger than what the street was anticipating. To speak about specific numbers, NEP, net earned premium, that grew by about 12% in the first quarter. As I said, it's a beat as per what street was anticipating. Underwriting profit, that has reduced significantly, and that's a big negative, coming in at about 72 crore versus about 140 crore. The street was anticipating a number of 108 crore. Operating profit, that has also reduced, coming in at about 249 crore versus 312 crore. The street was anticipating a number of 233 crore. Finally, PAT, that has also reduced about 17-18%. So that's another negative. And the final one is the combined ratio coming in at about 102.16 versus 99.14. So that has deteriorated. The street was anticipating a number of 99.93, but it's come in at over 100. So that's a big negative for the company.
Okay, all right. That's Star Health for you, the largest private sector health insurer out there. Let's get Mangalam in on Allied Blenders and Tilaknagar Industries. Mangalam, good morning.
Good morning. So good numbers coming in from Allied Blenders. In fact, all the three triggers of the company are playing out. Sales mix is improving. That's leading to a good revenue growth led by volumes. Gross margins are improving, and at the same time, the profits are further getting boosted by lower finance costs. What does all of this mean in terms of numbers? 22% jump in the revenue. Gross margin improved by 500 basis points. EBITDA margin improved by close to around 300 basis points. We have the net profit, which is quadrupled from 11 crores all the way up to 55 crores, further boosted by lower finance costs as well. Volume growth of 17%, realizations per case increased by 6%. And remember, now Prestige and above accounts for nearly 56% of their revenue. So see some green on Allied Blenders. On the other hand, Tilaknagar Industries, we have the details of the fundraise that have come by. The company's announced nearly 2,300 crore of fundraise via preferential issue. The only fly in the ointment here, the issue price is at 382 rupees, which is a 25% discount to the current market price. So maybe the stock has run ahead of the price at which the issue was made. Warrants have been issued to Small Cap World Fund Inc. There is Abacus, there is Singularity, Ramesh has the money. So a bunch of investors out there, and they will be utilized obviously to buy Imperial Blue, which the company acquired for 4,150 crore rupees. But the good part is that because fundraise has come in at around 2,300 crore rupees, implied debt addition on the back of this deal is close to sub 2,000 crore rupees, which could be a positive. So for starters, the stock opens in the red because of the sharp discount, but thereafter the street looks at possibilities going ahead post this consolidation. So maybe we see some recovery.
Okay, absolutely. We'll watch out for Tilaknagar. And that was, of course, the big break that Nigel told us about. Big acquisition coming in for the company. Let's quickly recap then all the stocks in focus today. The ones that have positive news flow today are L&T, JSW Steel, GE Vernova T&D, GMR Airports, Piramal Enterprises and Allied Blenders. Stocks with negative news flow or earnings would be NTPC, Bank of India, Star Health and Tilaknagar Industries. Okay, that's our equity list. It's time to talk commodities. And remember, along with all the earnings issues and trade issues, another overhang for the equity market today is the sharp jump in crude oil prices. You've got Manisha in with the latest. Manisha, morning, 3% up on oil overnight. What's happening?
Oh, well, absolutely. So this week actually has been quite bullish. Monday was 2% of gain. Tuesday was 3% of gain. And with that now for the week, if you look at the 5 last trading sessions, we are up by 6%. For the month of July, the crude oil prices are up by 8%, and we are trading at a 5-week highs right now. Well, improving globe trade relations, as you see more and more those trade agreement announcements coming in, has been supportive for the crude oil prices. But 2 other things which have led the prices higher. One is, of course, the statements coming in from U.S. after Trump saying that Russia has now just about 10 days to agree on a ceasefire or face sanctions. After this statement, there was a statement from the U.S. Treasury Secretary Bessent saying that with the U.S. secondary tariff legislation or sanctions on Russia oil, China could also be looking at higher tariffs if Beijing continues to buy Russian oil. So there are various statements coming in, and that is where you have the premium for the prices as well. Apart from that, OPEC and allies also are discussing to pause further production hike from the month of October. But what the markets will watch out for now is the Fed policy meeting today. You have Bank of Japan monetary policy meeting on Thursday. The China PMI data also comes in on Thursday. And amidst all of that, dollar index is trading at a 1-month highs. And even with that, the crude oil prices are trading in the positive, telling you that it is looking strong on charts.
Okay, all right, Manisha, thank you very much for that. So that's commodities in focus. Oil seen a bit of a bounce over the last 2 sessions or so. We'll take a quick commercial break here. We're going to come back with our first corporate on the show. Greenply Industries reported earnings. And we speak with Mr. Manoj Tulsian of the company on their earnings and outlook ahead.
Welcome back. Well, let's focus on Greenply. The past quarter's numbers a little bit subdued, but what's the way ahead? We're joined by Manoj Tulsian, the joint MD and CEO of the company. Hi, Mr. Tulsian. Good morning. Always a pleasure to have you on the show. Well, it appears in the plywood business, this time around is a little bit softish. Could you tell us what is the volume target you have on the plywood business? What is the margin outlook? So volumes, margins, and have you lost any market share? Because there's no growth this quarter.
So, morning, Nigel. It's always a pleasure to be there on your show. In terms of plywood, for the full year, we are given a guidance of a 10% volume growth and also a double-digit margin. But yes, I agree with you. The first quarter has been subdued. But when I look at the lower sales in housing by almost 20% across all the metros, I think possibly it's a decent job done. There is a pressure on liquidity in the market, and June was quite a bit, possibly early monsoon, and maybe a mix of also lower housing sales.
But you believe that things will recover from here on? Your plywood business, you'll do 10% revenue growth at least. Is that possible?
I think so. If we just wait and watch quarter two, July has been good for sure. And, I told you also earlier that with the BIS implementation across the panel division in the month of August, in H2 will look much better for sure. Yes, but I think, we need some more traction on the housing sales side because quarter one was quite disappointing when you look at the numbers.
Indeed. And margins recover to double digits as well?
Well, if we are able to do around, even 7 or 8% volume growth during the year with around 10 or 11% revenue growth, I am sure that we'll touch double-digit margin because we'll get a lot of operating leverage also, which will play.
Mr. Tulsian, what did you mean? Some liquidity issues there in the market?
Well, so, Prashant, what has been happening, which we have been seeing for last 2 or 3 quarters, that we are not able to get our receivables we recover on time. And to that extent that, some of our dealers and the channel partner who have never failed in terms of paying on time, also this time could not pay on time in the month of June. That clearly shows that somewhere there is a liquidity issue into the market,
Should we tie that in with what we've been hearing from, some finance companies, etc. we speak to, or that's not it's a specific issue here with Greenply?
No, I don't think. I know we have checked with other building material organizations also, and we find that they are also facing similar challenge. So somewhere, liquidity is stuck, and I think RBI has taken enough measures. Everybody is saying from quarter two there will be a lot of money which will come back to the market. So I think possibly that will resolve the issue. It's a short-term issue.
Mr. Tulsian, what is the overall, as we stand right now, what is the overall FY26 revenue growth estimate that you can tell us? It is that 10-15%?
Yeah, so, two line of business, plywood and MDF. MDF, if you really see, we have done around 7.5% volume growth and 10% plus revenue growth. So our target for both the division of business was that we'll grow in double digit. MDF will maintain a healthy margin of around 16% for the full year. We are already ahead of that. We are around 17.5% in quarter one. And plywood, we said that almost from 8% last year, we will move to double-digit margin this year. First quarter, we have not been able to pull that up. But I'm very sure that by the year end, we will move to double-digit margin and as well as double-digit growth in plywood also in terms of revenue.
All right, Mr. Tulsian, got that. Encouraging to hear that July has been better.
Yes,
couple of other pointers. Debt repayment target for this year, what is it likely to be? And working capital days got stretched a little bit. Maybe it's because of the liquidity issues and the likes. Where does it stabilize at?
So, debt right now, we are at around 500 plus. But by the end of quarter two and quarter three, this will come down significantly. As you rightly said, one account of better collection. The other is also on the MDF. We are taking a planned shutdown in the month of August. It's a expansion of capacity by almost 200 CBM per day.
Okay.
We built up the inventory, so that will get also liquidated in the month of September. So by the end of quarter two and quarter three, we'll continue to reduce our overall debt exposure. And I think by the year end, we should be somewhere around 400 to 425 against 534 right now.
And working capital days comes down to back to 45, 50 days?
Well, 45 days in plywood looks to be difficult, but we are almost at around 59 days or something right now. But I think 51, 52 days for sure will bring it down. So that will also pump in extra money into our balance sheet.
And net profit for the year will be around 120 crores odd? Last few years, you've been doing 90 to 100 crores. Is that a probable number we can work with, going by everything you're saying?
Well, I mean, I'm looking at both the business separately, and then we also have a hardware business, so which will still have some drag during this year. So I'm just looking at individual businesses, and whatever it adds up to, you guys understand the numbers very well. So whatever you're saying, numbers must be correct.
Okay, let's see whether or not you can do that. Next time I'll push you a little bit more once we're at the halfway mark, but 120 to 130 crores net profit is what some brokerage estimates are working with. It's doable. All right. Thanks a lot for that, Mr. Tulsian. Well, we'll slip into the short break. We have Devan Choksey or DR Choksey FinServ waiting for us on the other side.
Okay, welcome back. There's about 7 minutes to go for the pre-open session. Just want to make a quick mention of the GIFT Nifty is at 55 points lower. Keep an eye out on Indian pharmaceutical names, Dr. Reddy's, Cipla, some of the GLP-1 hopefuls within Indian pharmaceutical companies. And the reason I'm saying this is because Novo Nordisk, which is a Danish company, I mean, the stock was down 22% last night. And it was down because they put out a muted sales forecast for the full year, partly driven by pressure that they're seeing on the weight loss segment, which is GLP-1. semaglutide. I mean, different brands. For Novo, it is Viyogi. The other companies, I mean, there's Ozempic, etc., etc. It's a very large category globally. I mean, perhaps even larger than the cardio drugs like Lipitor, etc. I mean, GLP-1 as a category of drugs will be huge. Some estimates put it at $100 billion. But the fear, the concern at the margin is that there will be too much competition too quickly coming into this space. So keep an eye out on the DRLs of the world, and of course a couple of others as well. But even fill-finish companies, One Source and a couple of others who have spoken publicly about how they're setting up large capacities to cater to the demand which may come from GLP-1 drugs. So just wanted to put that up for you. Devin Chokshi is with us with a quick check on things and what he's making of it. Devin, good morning. Good to have you here. I don't know if you have a comment on this the pharma space on the back of the Novo guidance cut last night. If you do, please weigh in. Otherwise, I think the big story, of course, is L&T's very strong accretion in its order book.
Yes, Prashant. Good morning. I think the visibility in the order book is something significant for L&T. And I think this quarter's result has also been an outstanding one for a long period of time. I think L&T hasn't produced this kind of result. I think that's a confirmation that I think larger the order book size, I think the ability to deliver is giving them the better handle on the markets in the business. I would imagine that I think they continue to hold the size of the order books, I think visibility for at least 2.5 to 3 years, next 5 years as well, because of the amount of demand for the construction, including from the UAE segment that they are having, is quite a significant one. So that's where probably I think one could possibly argue for a steady to better growth going forward as against the muted growth in the past.
Okay, I think what we'll do, Devin, is take a quick commercial break here. We'll come right back and continue this conversation on a bunch of other stocks as well with Devin. Stay tuned. Coming up.
Welcome back. So just about 9 a.m. now, we'll start getting the pre-open rates any second. Devin is with us. Devin, hi, good morning. We've got two decent earnings, good numbers coming in from both GE, Vernova T&D and L&T, both in the infrastructure and old economy capital goods space. Do you like either of the stocks?
Yeah, absolutely. Good morning. Well, L&T, as I said, I think looks promising from a point of view that I think it is creating a very large visibility of order execution for next 2.5 to 3 years at least at current levels. The more important part is I think they have stabilized on the margin, which was not the case in the past. And that's why I believe that I think going forward, if this strategy works for the company of managing the costs along with the higher growth, probably I think the results are likely to be relatively better compared to what we have seen in the past. So remain cautiously optimistic about the prospects going forward. Of course, I think in some quarters when the market gives you the price correction, that would be a better time to buy into this stock.
Devin, it's been largely a subdued, lackluster earnings season. Not too many big hits, but pick out something for us last 4-5 days. I mean, any company, mid cap, large cap, small cap, where you were very pleasantly surprised with the numbers, and if it makes sense to buy any stock.
Well, I think the importantly among the finance companies, the Bajaj Finance and Bajaj Housing Finance, both these companies compared to the peers have shown at least 2.5 to 3 times higher rate of growth. And that is what is more important to understand. Of course, we have been calculating that possibility. But importantly, I think when the peers are facing the pressure in the marketplace, these two companies have been showing relatively better performance. Maybe their ability to deliver the loan faster to the end customer and process it, I think, in the best interest. Probably, I think giving them the advantage, which no other players are, I think, enjoying at this point of time. So we look forward to, I think, such differentiators in the marketplace, I think, while building the portfolios.
Another space they were in, which was buzzing and how, was chemicals, right? And this is a kind of new story, not that new also, but it seems like China is pulling back seriously on a lot of capacities. Because, there's just too much price competition within China, right? And chemicals is one area which people like Morgan Stanley, etc., highlighted. We put out that note, Morgan Stanley double upgrading their view on Tata Chemicals. But it was not just Tata Chemicals. The stocks will come up on your screen. Tata Chem was up sharply. Sharda Crop Chem. Some of them, of course, are based on individual result reaction as well. Deepak Fertilizer, Zuari, Granules, Dhanuka. Of course, a small name like Paradeep, of course, on the back of earnings. But that entire pack and more was buzzing with lots of vigor yesterday. Any thoughts, anything you like here, Devin?
In the specialty chemical space, I think many companies have actually shown respectively, I think, a higher performance, largely because of two reasons. One, on the input side, I think the cost factor has remained under control. And either because of the China factor or I think overall improvement in the conditions. I think some of these companies have actually started showing relatively higher amount of offtake in the revenue. So both the volume-led growth as well as revenue-led growth is coming up, for price-led growth is coming up for these companies in current times. In my viewpoint, I think if I have to put across one summary, I believe that given the situation when the cost is under control and the demand situation is on a buoyant side, probably this period of next 4 to 6 quarters would be, I think, a super quarters for most of the chemical companies, and particularly the specialty chemical companies who are actually supplying to even the pharma segment apart from agrochemical segment. So we remain, I think, relatively more positive on their prospects as far as those companies are concerned.
Okay, Devin, we'll leave it there. Quick chat, but useful as always. Appreciate you joining us here on CNBC-TV18. Let's get some trades out of the way. Sudarshan and Mitesh are with us with a quick check. Gentlemen, good morning. Good to have both of you here. Will the bounce last, and what should you do if you get a flattish open? That's the question to both of you, gentlemen. Mitesh, you go first.
So, my sense is that, Prashant, the bounce may not last too much, but we are not getting any, strong directional bias. Like earlier, we were, looking at least a test of 24,900. And then if it breaks a test of 24,500, 550, we got a low of around 24,598. But broadly, the Nifty, which now will be approaching those medium-term supports around this 24,550 zone, there is no sign of continuation on the downside, neither there is a sign of reversal. So most likely outcome, in this kind of a scenario is that you might see a range develop. My sense is 24,550 to about 25,200, 250 on the upside, and therefore you would want to deploy this range strategy, which means that you try and sell near the upper end of the range, get into put spreads or buy put options or even sell futures, and try to take profits on the lower end of the range and then explore long opportunities.
Sudarshan, what about you? Good morning.
Yeah, good morning. Well, the Nifty is still under pressure, and we are going to have these days like the ones we saw yesterday. The markets don't go down or don't go up in a straight line. So in spite of the fact that we had a very decent rally yesterday, I would expect the markets to be a sell-on rally trade till proved otherwise. The trade really works like this. You look to sell the Nifty on rallies and look to buy good quality stocks. So essentially, you also create a hedge of some kind and go into the outperformers.
Okay, all right. Got that point, gentlemen. Good morning. Let's discuss stocks for the morning then. Mitesh, what's on your list?
Good morning. So I have a mix of buys and sells, slightly more biased towards long sides because the stock patterns are positive. So Asian Paints, I think, gave a very good reversal yesterday. Buy here with a stop below 23.79. Look for targets in the range of 24.45.50. Similar, very strong price and volume reversal on Geo Finance. So that's a buy as well. Keep a stop below 315.5. Look for a 335 kind of a first target. A buy on Syngene, it was called earlier as well, but even now can be bought with a stop at 702 for a trading target of 730 plus. And one sell call, that's Petronet. Would recommend selling here with a stop at 297.5 for targets of 282.
All right, got that. Sudarshan, let's come to your stock list as well. Is it buys, sells, or is it a mix?
No, it's just a buy list, as I explained. You buy stocks and try to sell the Nifty. L&T is a buying opportunity. You've already talked about it. Buy with a stop under 34.20. Syngene is also on my list. It's a buy with a stop under 695. And then another stock you've already spoken about. So it's really a common ground today. Tata Chemicals is a buy with a stop under 980. Tata Chemicals and L&T are essentially not just intraday or short-term trades. They're really positional investing ideas also. And Zydus Life is a buy with a stop under 975. So all four buying ideas.
Okay, all right. Gentlemen, thank you very much for that, Mitesh and Sudarshan, with those specific trades coming through. And of course, useful to get that overall view on markets as well. Let's get on the standout brokerage report. Nimish is with us. Nimish, good morning.
Hi, morning, Prashant. So today's standout is on M&M Financials. An interesting upgrade from Citigroup. So they've upgraded the stock to a buy from neutral and they've retained a target price of 292. They believe that the risk reward is turning favorable, backed by fundamental changes, and those includes that the rural demand is quite strong compared to the urban demand. So that's going to help M&M Financial. The growth potential exists in tractors, SME, as well as pre-owned vehicles. So they see a business momentum there. Third, the asset quality is improving has improved in Q1, and that trend is likely to continue in future as well. And fourth, even in the worst case, they expect the book value impact of not more than 5 to 6%. So on back of all this, and at current valuations of close to 1-time price to book, the risk reward is favorable, and hence an upgrade to a buy to M&M Financials from Citigroup, and they've retained a target price of 292.
Okay, all right, got it. Thanks very much for that, Nimish. We'll keep M&M Financial on our radar for sure. Let's quickly get to some earnings conversations then. Talk about Arvind Fashions. The company came out with the numbers, and it's been a good start to the year. Kulin Lalbhai, Vice Chairman and Non-Executive Director at Arvind Fashions, is with us to take a couple of questions. Kulin, hi, great to have you on. Of course, it's been a pretty steady start, and for the sake of our viewers, I'll just quickly recap the numbers. Revenue growth, almost 16% up. Margins steady at around 12%, and your profit has grown substantially as well. But before we talk about the numbers, Kulin, I want to talk about the change of guard. You have Ms. Amisha Jain taking over, and the market got very excited with that because of her pedigree and what all she brings to the table. She's been with Levi's, global brands like Nike earlier. So what's the growth mandate you've given to her in an environment where we talk about sluggish consumer demand? Tell us what you're seeing on ground and what can we expect slightly more medium term from the change of leadership.
I think we are very excited about welcoming Amisha to the company. I think this is a part of our succession planning exercise. So as we look at the next 10 years of value creation, we were looking for a leader who could energize the brand portfolio further and also, create a stronger growth momentum for the company in times to come. I think the company has done incredibly well, to re-energize and pivot on profitability. And we are very well set now as a platform to truly make these brands the largest and most aspirational. And as we move along, I think what you will see in the fashion business model is beyond the core tenets of creating exceptional retail product and branding. We'll have to become very strong in capabilities of the future, where digital, AI, quick responsive supply chain, these are all going to become very critical skills to win in the future. So I think the next 5 years should see us further lean in and accelerate the growth of this portfolio and also make our business model robust further compared to even where it is today.
So, Kulin, I mean, you've given for this year, I think the overall guidance is between 12 to 15% top line growth. But if I extrapolate this a little bit, let's talk about a 2 to 3 year view. Is there a possibility of perhaps even going within the vicinity of 20%? And how does the change in the channel mix, how does that impact your plans? Because there's so much buying that's happening online, even when it comes to high ticket items, whether it's sneakers or luxury for that matter.
Actually, we believe that for this business model, 15% sort of growth rate would be a very, very healthy growth rate on organic growth, because I mean, that's a very large growth on the base we have of 5,000 crores. And as a company, we are very focused on OCF generation, right? We are not just focused on top line generation. So along with growth in top line, we want to continuously improve our bottom line percentages. And therefore, the cash flow growth that we want over the next 5 years is the main focus area for the company. So we still retain this sort of 12 to 15% band. Hopefully, we can push it towards 15 as all our growth drivers come in place consistently. But I think a 15% growth rate, but with a much higher growth in EBITDA and OCF is what we would look to deliver. I think this quarter has been a very heartening quarter for us. 16% growth is the highest growth we have printed in the last 3 years. And it's a function of all of the hard work that has gone over the last couple of years in energizing the brands. We have increased our marketing, we have differentiated our products, bold retail. So all of that is now coming together and we're seeing the build-up of the momentum.
Kulin, hi, morning. With Amisha coming on, would you want to leave us with, I mean, I don't know if there's a big target on the board for Amisha that you've put up. Is there one you can share with us?
We will leave the board targets to the board conversations. But what do we do want to do, as I mentioned, is create consistent accelerated growth and a further revitalization of the business model. I mean, directionally, that's what you can expect from us.
Yeah. So there is one, or you're not telling us that. So obviously, thank you very much, Kulin. Short conversation today. Appreciate you joining us, and good to speak with you here on CNBC-TV18. That's Arvind Fashions. Stocks done very well. 543. We are hitting market open in about 2 minutes' time, and we will just take stock of how some of the stuff is closed in the pre-open session. Let's just put up L&T and just take a look at where the stock is at. 3.5%, 4%. So that's a big mover this morning on the back of very strong accretion to order book as it's come through. Arvind Fashions, of course, we just sort of highlighted, but a bunch of others as well through the course of the next 1.5 hours that we'll be speaking with. Look at Mazagon Dock in terms of how the numbers have come through. Gale, perhaps another one which we should put up for you. And a few others as well. I don't think there's a bit of a bump, 70-odd points, but as Mitesh was saying, perhaps it's about stocks rather than the index. Both Mitesh and Sudarshan made that point earlier. So we will keep with it, keep with some of the names. Actually, no, except L&T, no large reactions that I can spot. We've got some of these names at the bottom of the screen as well, which are coming through. First sort of rates which will start to appear in a bit from now, and we will look at those. Chemicals is an area which, of course, was buzzing yesterday, and some of these stocks were flying. We'll see if there is any follow-through as well. That's a non-earnings related, slightly a broader topic, a tailwind in that sense. Nifty is up to begin the day. We are above the 25,000 mark. That's good to note. A close above 25,000, and then I think people will start to believe that maybe this decline is behind us. This broader decline from the highs is behind us. For now, it is above 25, just under 25 actually now. The Nifty Bank is absolutely flat, nothing on it to begin the session. Mid-cap index flattish. The small-cap index will come up on your screen, give you a quick sense of how we are starting, and we will pick up from there. Broader markets was the story yesterday, and out of the gates, straight out of the gates, you got 3:1 in terms of advances to decline ratio. So this is a very, very strong kind of market breadth. Although we'll give it 5-10 minutes for it to settle down, more measured picture then. What do we have? More down than up, like yesterday, 30 down and about 20 up. That's the overall sense of things. You got L&T on one corner and Tata Motors on the other end of the spectrum to begin the session. Surabhi.
Concern. Tata Motors, if they indeed go for this big Italian acquisition, as reports are indicating, it's a huge one, $4.5 billion. Is what the set price would be, and this is the largest they've done since Chorus. The market's a little nervous about how this could play out, given the size and the scale and the numbers involved. So 3% down on Tata Motors. Dr. Reddy's is also lower. Let's watch for some other stocks like Cipla, slightly lower there. Remember the negative news in Pharma? One is on what we've heard from Novo Nordisk on semaglutide, scaling down their guidance for the year on that all-important GLP-1 drug. And the other is this constant talk of higher tariffs in the US. So Pharma under a bit of pressure. If we talk about what else is moving in the market, on the upside there's L&T, which is good news. 3%, good quarter coming in for the company. JSW gets relief from the Supreme Court. Supreme Court has agreed for hearing on the Bhushan matter. 1.5% up on that stock as well. Some gains on BEL, Tata Steel, Bharti Airtel. This is where the leadership is. Some big stocks like TCS and HDFC Bank, for the time being, they're keeping their head above water. So let's see how that plays out. Tata Motors is the one to look at. It's down about 3.5%. We'll get you more on the story. By the way, Asian Paints, yesterday's excitement after Q1 numbers, it's fizzling out this morning. Stocks down 1.5% as we speak. Net 30 higher on the Nifty. Nigel.
Well, a lot of stocks actually from the broader markets are buzzing around. Bliss, GVS Pharma, it's a small company, 1,800 crore company. They came out with their numbers. The street seems to be liking that. Top line growth, I think, of around 10% approximately, and margins clocking around 20%. So I think that's why the street does like that. The net profit as well has come substantially high. I'm not sure whether or not there is a big other income actually in that. So I think that's why that net profit number is looking much higher. But that's one of the top volume gainers. Operational performance okay, and net profit bumped up by a big other income. The other ones that are moving around, Gateway Distriparks, that's been a rank underperformer, right, over the last few years. But yesterday's numbers were encouraging, and the street likes it. So after a bounce yesterday, we're seeing a further bounce today. We'll have the management that will be joining on later on in the during the course of the day as well, during midday. So that's up and about. IGI, we'll be having the management shortly who will be joining in. That as well is up close to around 6% in today's trading session. Northern Arc, we had Digant Haria, who joined on Finding Alpha a few sessions ago. He was saying that this is one of the companies that's actually very, very well placed. It's already had a big run. It continues to move up close to around 5% as we speak. And Jaiswal Neco, the stock is up close to around 7%. There was no clarification that came in yesterday with regard to the ARC 5 crores pending sale. But for the time being, the street believes that most of that is over. We'll have to look through the day with regard to if there is a disclosure or not that's coming out there. For the time being, very, very large volumes, but the disclosure from the ARC will be important because last count, there was close to around 5 crore shares that were pending. Tata Motors, the street believes they're going to be looking to, choose something that's too large. So that's why, on the fears of some inorganic growth, that stock is down close to 3%, one of the top losers today. So that's about all the movers. The Nifty, by the way, is up close to around 40 points, and at least we made a higher high, which is encouraging.
Well, let's see if it holds and we're able to sort of grab on and keep at it by the end of the day. Well, we'll have more sort of stock spotting as we kind of go along. But let me welcome in Saurabh Mukherjee, who is with us. He's founder of Marcellus Investments. Saurabh, great to have you on the program. Thanks very much. Good morning. It's been a while since we had you on the spot. So let me ask you to outline your views on where we stand as you see things. I think markets, of course, how should I put it, done well over the last couple of years, maybe entering a bit of a slow patch. Earnings, of course, once in a while you get into this slow spot as well, slow patch as well, and I think that's where we are at. Where does that leave Marcellus and you in terms of your thinking on what's ahead? Saurabh.
I think the good news for India, right? The good news for India, I think, is that in the context of what's been a remarkable bull market over the last 5 years, large cap and specifically large cap quality, I think, is pretty reasonably valued. So the kind of things that we tend to like, e.g. HDFC Bank, is sensibly valued. And even though the economy has entered a cyclical downturn over the last 5-6 quarters, and even though earnings growth has slowed down to a crawl, I'm not that stressed about large cap quality valuations. Value investing stocks or cheaper stocks with questionable fundamentals have had a tremendous 5 years. And as the economy loses steam, typically the market tends to rotate back to volatility. I think that piece gives me a lot of hope that our style of investing is gradually coming back again into vogue. This year so far has been good for Marcellus. Where I worry about the Indian market is small and mid cap. I think the valuations make no sense to me. Why the small cap index has doubled in 3 years without any fundamental support makes no sense. And what really worries me is the intensity and strength of flows into small and mid cap AUMs. The amount of money they're taking in, the lack of earnings growth, the giddiness of valuation. I think that patch of the Indian market worries me, not just as a market participant. I also have macroeconomic concerns. I think middle class India is putting too much money in small and mid caps. And if there is a big correction there, that'll have macro implications for the country as well.
Saurabh, could you just lay out what the Marcellus flagship kind of portfolio looks like right now? You mentioned HDFC Bank briefly. What else makes up? I mean,
large positions. So much the same actually, Prashant. We don't change the large positions that much. So HDFC Bank for many years has been a large position. Obviously, when it flatlined for 3 years, we suffered. But then it's a high-class institution. As asset quality tanks in India, HDFC Bank is obviously coming to the fore. Divi's Lab has been for now, I think, nearly 7-8 years a big position. It did well during COVID, then pulled back in the year after COVID. It's done well again, remains a large position. Trend 3 years ago, we built it into a large position, remains a large position. We're seeing the slowdown in consumption. Obviously, Trent is taking its share of pain from the consumption slowdown. I think your previous speaker, Kulin Lal Bhaiji, was also speaking about it. Trent is also seeing its share of consumption slowdown. But I think structurally, we see Trent as far better placed as most other apparel retailers in our country. Asian Paints, for many years, a large position, remains a large position. We remain reasonably sanguine about the Birla piece. I know the Birla empire is mighty and they're putting in a lot of money and effort, but I don't see the competitive intensity playing out in the marketplace as much as perhaps many people watching this show do. Asian Paints' bigger challenge will be the consumption slowdown, like everybody else. That company's volume growth is also muted because of the consumption slowdown. And then moving on beyond these names, companies that we've built more larger positions in more recent years, say Eicher Motors. 2 years ago, we built that, remains a healthy position for us. Pidilite, long-standing Marcellus favorite. So it's much the same. New entrants, I would say Eicher Motors at the newer end. And there are some mid-caps, small and mid-caps, where we are beginning to nibble. But I have to confess, in small and mid-caps, the valuations are so punchy that we worry about building large positions just yet.
Hi, Saurabh. Good to have you on the show after a while. You want to name a few of them, though? I've gone through the large caps, the traditional favorites, HDFC Bank, Asian Paints. Eicher Motors is something that you've added. Divi's Laboratory as well. You've spoken about it in the past. From the mid and small caps, one name if you could share with us?
So look, I mean, the overall pharma space, right? I believe the pharma space will do well. It's not just Divi's and outsourcing. That obviously is a part. I think outsourcing will come to India. I think the America-India trade deal will fructify. I'm not in the camp which says America will hammer India with pharma tariffs. It makes no logical sense for them to do so. So as the pharma space burgeons, as both outsourced manufacturing and Indian formulation makers do reasonably well, there'll be a whole bunch of ancillaries who will do well on the back of that. And that's where we're focusing, Nigel. That's where we're focusing a big part of our research attention. And to that end, I think 2 years ago, we built a small position in Aequitas. This is a supplier of raw materials, supplier of intermediates to firms like Divi's. And I think as Indian APIs gain market share in the global context, suppliers to Indian APIs, firms like Aequitas should benefit. I know it's expensive. It was reasonably inexpensive when we bought it 2.5 years ago, just soon after its IPO, but it's become eye-wateringly expensive. But that being said, many of the intermediates players in India are growing their business at 30-40%, which is what's leading the whole world to say that shouldn't we be loading up on these type of specialty chemical companies.
Which is the company? Sorry, missed that. The company's name, sort of, just to clear the air?
So this is a company that changed its name. It used to be called something else. It's now called ACUITAS. ACUITAS.
Okay. Saurabh, hi. It's almost like deja vu speaking to you after so long, and yet some of your top holdings still remain, right? So you've kept the faith.
Same old. Yeah.
Absolutely, the Pidilites of the world, HDFC Bank, Divi's. This could be a conversation, I think, 3 years back as well. But, I want to get your thoughts in a little more on the consumer piece, because there's a lot of disruption that's going on. Now, while you've kept the faith on trend, the market's been, volatile, saying they're not growing at 50% and now it's 20%. At the same time, what are you thinking about the platform guys? Because they're showing profitability, they're showing the burn, reducing, and consumption patterns have been changing. So just tell us a little more. Like you used to have Page Industries. It was a big conviction stock for you guys. I don't know if you paired off that. What about QSR? Tell us what else you're liking in consumption, and where have you taken profits or paired positions?
So look, I think let's start with the platform piece, right? So on the platform side of things, InfoEdge is how we chose 3 years ago. We chose to build a position in InfoEdge, and because InfoEdge holds stakes in Zomato, Blinkit, or now it's called Eternal, right? InfoEdge holds a large stake in Eternal. We are able to get exposure to that. I'm not so sure that directly we'll be investing in these platforms because it sort of runs contrary to the house style of focusing on well-established players with strong cash flows. But we can see that somebody, maybe two companies, will build multi-sector QCom platforms. At this juncture, via our InfoEdge stake, we think Eternal seems to be the front runner, but it could be Eternal and one more. We don't quite have the skills to go and load up on the platforms directly. With regards to Page, we exited around 3 years ago now. I'm glad to see the company is doing well in the recent quarters. We exited because in the post-COVID, during COVID, for obvious reasons, we all sat at home and bought plenty of leisure wear and shorts and t-shirts and so on. And Page had a terrific run. In the post-COVID aftermath, as the excessive spend on Page's products tapered off, and there was some comparative new entry, Page suffered, and 3 years ago, I think we exited the position. It's doing well. We'll keep tabs on it, but at the moment there is no Page in the Marcellus portfolio.
Okay,
on that
Aequitas,
I think Nigel was asking. So it used to be called Ami Organics. It's now called Aequitas. They changed their name recently, and that's why it might not be a familiar name. We built that position a couple of years ago, I was saying.
Okay, so Ami, that was to the earlier point to Nigel, that Ami Organics was the chemicals play that Marcellus liked, and now the name has changed to Aequitas. On the platform companies, Saurabh, while you're not playing them directly, I mean, you do still have InfoEdge, right? Anything else in consumption? Any new ideas that have managed to pass your filters?
No, nothing on consumption. My reading is we are heading for a consumption downturn. That's why I'm holding off both on talking up more consumption stocks. Right. And Marcellus genuinely is holding off building new consumption positions. So the RBI data is very, very clear. Net household financial savings is at a 50-year low, right? Savings in India running at very low levels. I think Indian household savings will rise over the next 2 to 3 years. As that does so, I think there will be pressure on consumption. A, given punchy valuations. B, given impending pressure on consumption, we are holding off building more consumption names because we worry about that space. If you ask me, if anything, right, we will try to see, can we find more plays on private capex? I think the single best piece of news I've heard for many months was the was not just the L&T results, but within the L&T results, the announcement that a big Indian company has given L&T a big BTG project, boiler turbine generator project. I think private capex will make a comeback over the next 2 to 3 years. And what we are trying to do is scope out where should we put money in private capex. I stress again, I'm talking about private capex, not government capex. Corporate India, for the first time in its history, has net cash. I think we will see a private capex a bull run over the next 2 to 3 years, and we're trying to figure out whereabouts in that we should position ourselves. I think the consumption piece, we are in a downturn on consumption. I expect it to continue for several quarters.
Okay, I think that stock that Saurabh is talking about, it's Acutaas, ACUTAAS Chemicals.
That's right, yeah. Thank you. Thanks, Prashant.
It's not ACQ. I think we should change that.
ACU, you got this name in the ticker right. So it used to be organics, they changed their name.
A bit of confusion there, but there you go. I think we have it now.
This space, I think, will do well. I think India, America, Pharma, specialty cans of Pharma API will be a central part of the deal. America is very, very keen to reduce dependence on China for API. As that happens, ancillary suppliers such as this, and there'll be many more ancillary suppliers such as this, should benefit because they will get a slice of global action via firms like Divi's Lab and Lotus Labs and so on.
Got it. A great conversation, Saurabh, and we'll chat again in greater detail on some of these themes. By the way, I liked how you said we don't have the skills to invest in such a nice way to. What was it? I think it was the quick commerce company. Surabhi, you asked, right?
Yeah, because they don't pass master.
Nice one. Thanks very much, Saurabh. Good to have you back.
Yeah, but that's an interesting pivot at Marcellus as well. Now they're looking at private sector capex. And speaking of capex and the heavy industries or the old economy space, let's pivot to one important set of earnings. And the company on our radar is Mazagon Dock. Now, Mazagon Dock had a weak start to the year. The higher expenses impacted profitability quite a bit. Margins saw a sharp fall as well. Let's talk about this and the outlook for the rest of the year. We have with us Mr. Biju George, Director Shipbuilding at Mazagon Dock Shipbuilders. Mr. George, thank you very much for joining in. So that's been the market's concern as well, right? Your subcontracting expenses were up 9%. Project expenses, moved up 3x. Provisions were much higher. Can you just explain to us if this is just a one-quarter hit? And what should be the normal expectation on margins for the coming quarters and for the year as a whole on EBITDA as well as EBITDA margins?
Yeah, so there has been a dip in the EBITDA this quarter. This is primarily owing to the fact that we had to make some conservative provisions for our ongoing projects where we have encountered a steep hike in the subcontracting rates as well as similar kind of hike in the equipment cost. These are all driven by boom of shipbuilding in the country as well as globally, because the equipment manufacturers have already moved into a seller's market. So when we contracted these orders, it was a buyer's market. So therefore, that shift in the scenario. So we have given a kind of provisioning, and that is the reason why it has taken a hit. And there is no further anticipated provisioning in the quarters to come. So that kind of pressure is not anticipated in the... Yes.
So, sir, can you give us a trajectory to work with as margins start to normalize, maybe Q2 onwards? What will the recovery path look like? And for the year as a whole, what is the steady state margin expectation that your shareholders can have?
Yeah, so the margins like the year before, we hope to maintain same. The 15 to 20% margin is what we expect. Now, what is happening for the next couple of quarters, we would be on a path of recovery because our ONGC projects are seasonal. During monsoon, we are unable to execute it in offshore. So once the monsoon period is over, so the next 3 quarters, we expect a pickup of revenue from the ONGC projects as well.
All right. Hi, sir. Good morning. Good to see you. Ben, what about growth for the year? 8 to 10% is doable?
Yeah. So that's what I can give as guidance because currently our residual order book is approximately 30,000 crores. We are executing it. So this particular quarter we had to provision, as I said, that is the reason for this hit. But we are on the road to recover.
The current order book you said is 40,000, 50,000 crores?
No, around 29,900.
29,000. Okay, ballpark 30,000 crores. But there are a couple of other large orders that we were talking about the last time around, sir, that you were expecting. Could you tell us which project we could look at closing out this year in terms of an order inflow? And what could the quantum be?
Yeah, so as far as the future projects is concerned, we are serious contenders for 3 additional submarines and 6 75I submarines. So these are at the advanced stage of negotiations. We are awaiting government decision, which hopefully would be in our favor, and we expect that some kind of orders are going to materialize this financial year itself.
So just confirming, I believe in the investor call you've given a number. I'm just reconfirming the number that with all of these additional submarine contracts, your order book could touch 1,25,000 crores this year itself. Is that right?
See, that is, I would say, slightly speculative because we do not know which order is going to materialize and in what sequence. So if everything comes, of course, it will touch that figure. But at this point in time, I won't be able to commit that this is going to happen and this financial year it's going to happen.
Okay, so then let's work with where you have realistic timelines for bid awards to come through. So if not 1 lakh, what should we work with? I mean, you were at about, I think, 30,000 roughly is the order book position right now. Should we expect the order book to double? Would that be a more realistic assumption?
That would be realistic, but the order in hand is 30,000. In the next 4-5 years, it will have to be liquidated. By 29, the current order book has to be liquidated. So it will get progressively liquidated. And at the same time, we are in the process of, these are the anticipated orders. And we are also looking at warship projects also, apart from the submarines. That is the 7 follow-on 17 Bravo project. That is a frigate program. Then the next generation destroyers are also there. We are serious contenders for that as well.
Sir, and so that's on the order book front. Just give us a sense of the execution. Like for this quarter, you've had double-digit top-line growth. Expecting to do more of that? 15% revenue growth for this year?
Yeah, so in the current order book itself, we would be able to sustain that. So if new projects also come, the revenue recognition or booking will happen only after 2 years down the line, because after signing the contract for realization of the value of production on ground, it will take 2 years.
Okay, I guess we're done with the
all right. Just one more quick question, sir. In terms of exports, what is what is the potential that you're looking at in the years to come? It's still reasonably smallish, but that is some potential out there. So if you could tell us where do you see this number headed? So, and also in terms of breakup, repairs and what is the segmental breakup, the ideal mix you'd like for the business on the whole, exports and business breakup?
Yeah, so we'll have to put it into 3 buckets. One is shipbuilding and the new construction for domestic consumption, like for Indian Navy and for Indian Coast Guard, ONGC, etc. Secondly is the export, and thirdly is the refit and repairs. So coming to the export, right now we have already contracted 6 ships for a Danish client that is progressing. And there is a lot of export potential. We are looking for further orders. We are in the process of discussion, but nothing, as of yet, nothing is crystallized. And coming to the repair vertical, we already have a repair vertical, but for doing in-house repairs, we have a dedicated dock for repairs where we are doing relatively small vessels around 120 meters long. That's what we can take in a dry docks. And that is clocking a revenue of approximately 100 to 120 crores per year. That's a minuscule revenue compared to our total revenues concerned.
All right.
And
thanks.
I would also like to mention that
Yeah.
you are already aware we are acquiring controlling stakes in Colombo Dockyard, where their main business vertical is ship repairs. So on the ship repairs front, that revenue also will get consolidated into our portfolio as when Colombo Dockyard would become a subsidiary company to Mazagon Dock.
Okay, we wish you all the best of luck, sir. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. We, by the way, had a really extensive, long interview with the shipping secretary a couple of weeks back. And lots of what you're saying, essentially, in terms of the pipeline of orders, etc., the secretary had sort of confirmed to us as well. Thanks once again. We have the next company ready with us. We have Taimas Printer, Managing Director and CEO, and Ishwar Iyer, Chief Financial Officer at the International Gemological Institute, IGI, now joining us. Gentlemen, great to have both of you here. Thank you very much for your time.
Thank you.
Always a pleasure.
Hi, good to see you.
Let's just, revenues are up 16%, EBITDA is up 37%, profits are up 67%, and volumes are up 21%. So these are very, very healthy numbers. Margins are up some 900 basis points on a year-on-year basis. And you're saying these will get better as you go forward.
We will at least sustain this for sure.
Okay.
Yeah.
Is there a specific sort of guidance you're working with? I think we're about 58% here.
Yeah, we spoke in the beginning of the year. I think the guidance was a 15-20% revenue growth for this year. With an EBITDA margin, we had given a range of around 57 to 64. We delivered 64 in Q1. We are at 58 this quarter. I think we should meet the guidance that we'd given at the beginning of the year.
What happened in the quarter, if you can just sort of run us through a little bit of, highlights. Volume growth has also been very solid.
Yes.
In our earlier two conversations, at least, we've asked you about whether, on the lab-grown side, things are going to look... will that kind of dampen enthusiasm for your kind of business, competition, etc.? Doesn't look like it's made any difference.
See, lab-grown is a new disruptor. And it's come in after 100 years. Okay, so obviously there is a lot of disruption happening in the industry. IGI is a neutral body, certifying body. We are independent of all biases, any preferences, nothing. We believe in giving the analysis of a gemstone or a diamond to the consumer. It's the consumer's right to know what he or she is buying. So from that point of view, while there have been different opinions among the labs, we stand neutral. So we say we will certify the diamonds as per the 4 C's, which is an age-old criteria which has been used to analyze the diamonds.
Right.
Okay.
Between sort of lab-grown and natural diamonds, in terms of certification revenue, what is the split right now?
I think it's between 50. It's remained more or less the same. I think 55-45. That's been the split.
There was the one concern was that as the lab-grown diamonds become really widespread, and there's no... Will the need for certification itself go down over a period of time?
Let me put it this way. If you want to buy a natural diamond, you need IGI certification to know that it is not a lab-grown.
I see.
And if you buy a lab-grown diamond, you need IGI certification to know that it is not a piece of glass.
Okay.
Simple as that.
No, but just on the certification controversy, because the GIA, the Gemological Institute of America, it started there, right? They said that we're not going to give the 4C certification for lab-grown, but you are giving the 4Cs.
We are giving the 4Cs.
In terms of just having certification market share for lab-grown, are you bigger than GIA, or do they certify?
Where lab-grown is concerned, we are much bigger than GIA. In fact, we lead the global markets in lab-grown.
So it doesn't impact your volumes at all?
Because we have adapted the lab-grown. Initially, we started lab-grown certification in 2005. The US continent is the first continent, the Western country is accepted the lab-growns. Last year, the bridals were over 50%, in lab-growns. So we don't see that. What we believe in is giving transparency and awareness to the consumer.
Absolutely. And your volumes are intact, so no change.
And they speak for itself.
All right. Good to have you all gentlemen in the studio. A couple of questions. You use a couple of adjectives. One is that y'all are neutral. It has been a disruptor. for someone like me, it's an opportunity actually, because otherwise you'll never give the lovely ladies at home a natural diamond. So at least now this lab grown could be a potential opportunity. That for a later time. Let's talk about business for y'all. In terms of certification, I think per certificate for lab grown, it's ballpark $15, and I think for natural, it's twice of that, around
around
$40 or thereabouts, a little more than half.
That's right.
So 2x is what it is for natural diamonds. Could you tell us what is the margin difference between the two?
See, I think we've addressed this in the past as well.
Yeah.
While from
the profitability aspect, I don't think we touched upon. We touched upon the realization.
The margin as well. I think while natural diamond, because of the price at which they sell finally, is a high margin business from a unit economic standpoint. But the volume throughput that we get from the lab grown is what therefore accelerates the revenue and EBITDA performance for us. And that's what is being seen in the last 3-4 quarters in our results. I think the volume throughput that comes from lab grown is enabling us to therefore really move that into the EBITDA or the PAT from an operating leverage standpoint.
Right.
I think the mix of both is therefore helping us. Sorry.
You want to give a margin difference though, and also now lab-grown jewelry is something that's a smaller part of the business, but I guess it has tremendous potential. So just wanted the margin difference between natural, lab-grown diamonds and lab-grown jewelry.
We don't measure it by each segment because the grader who does natural diamond today does lab-grown as well. So we don't have that sort of a distinction within our MIS tracking or whatever in terms of what could be the differential margins there. But as I mentioned, the throughput that comes through volume on lab grown is therefore accelerating the revenue performance and also the EBITDA performance.
Absolute number.
These $40 which Nigel mentioned, that's the average realization per report.
Right. Yes, natural.
Okay. And when we say volumes, that is the number of stones that you're certifying.
Yes, that's correct.
So essentially, I mean, it'll be. Would you say the ASP or the average realization over a period of time you'll be able to sort of hold this at these levels?
I think, what's happened over the last 3-4 quarters, which we discussed again, I think we took a slight pricing correction in Q2 last year. Was that we've seen a lot of price stability in the business. And thanks to that, if you look at the sequential ARPU as well or the ASP, I think the average realization is slowly inching up because we're starting to cycle those price drops of last year. So I think we should be able to hold that for this year.
Okay. And just the way the market is moving, I'm assuming volumes will move more and more towards lab grown.
What happens is lab grown is an affordable luxury.
Exactly.
So more and more millennials and the Gen Zs are adopting it. They have other expenses to take care of. At the same time, they can satisfy the desire to own a diamond. That's the most important criteria. I mean, the percentage of...
You brought a smile to Nigel's face.
He's a Gen Z. He's a Gen Z,
At least it's affordable, Prashant.
I have already messaged the important people at home. Don't worry about it. Conversation has been relayed.
Pressure.
It is a diamond.
There
is no difference.
Absolutely.
And
whether it's found under a rock or whether it's lab grown, it always looks good.
So volumes will keep going up. You think volumes will keep going up?
Of course.
Whereas ASPs...
As the awareness grows, the volume's going up.
Yeah.
It's a question of awareness. I mean, the Indian community, is more conservative. But they are also slowly realizing the economics of buying a diamond. And once we Indians...
Take to something, then the volumes hit the roof.
So, it's a exponential thing actually right now.
Nigel actually touched
what we are seeing is we are in the business of certification and authentication.
And but the other point what Surbhi said, we take to it, but we also drive prices lower. I mean, eventually. You think
on the wholesale level there is a lot of competition. On the retail level, the prices are holding solid. It is the brand value that a brand can command. So at the retail level,
what is the drop in wholesale pricing, and what do you see
currently
ahead?
It is steady at around $70 to $100.
$100
Yeah,
close to
$100
a carat.
$100 a carat, which is decent.
More pressure ahead? Wholesale
Pressure is always there. Pressure is always there. But you have to, do a different kind of awareness creation. It's not only a price point. You have to create a market, and lab grown has the ability to do it.
Because the men will talk about market value and resale opportunity. That's why I was asking. Go on, Nigel.
One number, if I can ask you before you all go, looking at your past record, your profit number effectively doubles in every 2.5 to 3 years. Currently, you're going at a run rate where this year, you'll be doing close to around 600 crores ballpark, going by what you've done at the half-year mark. next 2 years, you can be more than 1,000 crores of net profit? Is that the aspiration?
Yeah, I think, yeah.
Aspiration is definitely
there.
there.
But to what Temas just mentioned, I think while the US market has adopted lab-growns, I think India, China are the next probably growth drivers. And you touched upon lab-grown jewelry.
Yeah.
That could be the big propeller of growth for us. So hopefully things going to plan. We don't see any reason why we shouldn't double.
All right.
Where we are today.
That's interesting. So 1,000 crores net profit is achievable. Thanks a lot, gentlemen, for joining in.
Thank you. Thank you very much.
I think I put myself in the spot by making that. The lovely ladies at home are waiting for that. So let's see how I can work out that. But thanks a lot for joining
having us here. Thank
you. Time to slip into a short break. On the other side, we'll have the management of Happiest Minds. Stay with us.
Welcome back. You're with us on Corporate Radar. Let's continue with more corporate conversations. And Happiest Minds is the next company that we're speaking with. The company reported a strong set of numbers for the first quarter. There was healthy revenue growth coming through along with margin expansion. Rima caught up with the company's MD, Venkatraman Narayanan, and co-chairman and CEO Joseph Anantaraju. And she began by asking them about the quarter and how they see growth shaping up in the future.
We had stated late last year when we gave our Q4 results that we would be looking to doing double-digit growth in constant currency. The first quarter of this year, we have done 2.3. If you keep this trend and build on the strengths, we should be there for the year. The good thing is, the trend up in our margin profile. We have got back to the 17.8, 18% operating margin kind of a number from the slight dip that we saw in the last quarter. So if you look at year-over-year growth or a quarter-over-quarter growth, whether it is EBITDA or operating margin, there has been significant growth to underpin that statement that we made. So guidance, I would say we're not holding it out as a guidance, but the estimate for us is double-digit growth and margins in the range of 20 to 22%. But one point I would like to highlight in the call is that our generative AI business, which I have been consistently referring to, has been taking in investments for the last 4-5 quarters has broken even operationally. So we have just made about 24 lakhs of operating margin on, if you can look at our segmental results, that comes out clearly. But that break even is a significant, uptick from the investment phase that we were in the last 4 or 5 quarters. We continue to be investing in that business because, it has to come to a profitability level of equivalent or higher than PDEs and IMSs. So we have a slightly, a road to that or a plan to reaching that, upping our efficiency in terms of utilization, picking up from 40 last year to about 55, should go up all the way to 75, doing billable projects. And that's the way forward for us to turn that, investment into a payback kind of a situation. New sales into which we had made investments is also starting to pay fruit. And that's also seen in the financials. So yes, efficiencies that we are seeing in the business, improvement and turnaround is what should hopefully pay for, the pay increases and foreign currency volatility and further investment that we hope to make in Artha banking and other platforms that are in the works for us.
So just to complete the point on generative AI, and congratulations on it breaking even. So today, generative AI is 2.4% of your revenues, which compares with 2.1% prior quarter. When do you think you will be able to get, operational profits from generative AI at par with the company average? Can it happen as soon as, say, Q4, the end of this fiscal year, Q4 of FY26? What's the roadmap? And even in terms of revenue contribution from Gen AI, when can it hit double digit? I mean, what pace is it growing at?
Generative AI to the similar operating margins as the other business would happen in FY27 because we have just 3 quarters left, and I see the EBITDA increasing sequentially. So FY27 is when we're expecting it to get to the same levels, and then after that, hopefully be at a higher level. And as far as the contribution of Gen AI is concerned, I think we need to look at it from the lens of direct revenues and pull-through revenues, because for most of our Gen AI projects, there's a need to figure out the right source of data to get the data into one data lake or a customer data platform. And then there's integration involved, there's UX element involved. Typically the flow, the pull-through is around 1:2. We expect that in the next 3 years, generative AI should get to around $25 million in revenue from the 5 million that we expect this year. But the more interesting thing is the pull-through revenue and the ability to differentiate out in the market.
Joseph, that $1 billion target, $1 billion revenue target, which you had set by FY31, last time you said that, that's been delayed and you will provide a revised timeline. So now what is the new goalpost for the company or the milestones? When can we hit $1 billion?
Sure. So we've been constantly, looking at this number given all the movements in the market, because when we set this as part of our vision in 2021, 2022, the market dynamics were a little different. Having said that, if you look at our, CAGR CAGR over the last 4 years, from 2021, it's been at 28.5%. To get to $1 billion by FY31, we need to do 22%. So it is a feasible number. But we're keeping a very close look at the number, the inorganic growth, the organic growth. And, when we feel that we need to make a statement, we would get back. But as of now, I think we're holding on to that FY31 goalpost, but keeping a very close watch on our quarter-on-quarter, year-on-year growth and market conditions.
Venkat, the margin guidance of 20 to 22% by FY26, is that for EBIT or is that for EBITDA?
It's for EBITDA. And
so you're already there, because this quarter you did 21.6, I think.
21.4 for this quarter. Yeah. Okay. So that's what we want to maintain and improve on through the efficiencies that are there in the system. Yeah.
Quickly, what drove the margin improvement on a quarter-on-quarter basis?
One is the organic business growth, 2.3%. That's a healthy growth, in our business. That plus there was some benefit that we got from foreign currency, but not as much as we thought we would. The third is, generative AI pulling in that break-even number, and also, there are a few of our existing projects which have grown nicely. If you look at our segmental results, you will see that existing business, there was a little bit of relaxation on the holdback on the so-called discretionary expense. So that all of that helped us in keeping the same cost structure, and we could get to the profitability. The most important thing is utilization is at a 5-quarter high at about 78.9%, if I'm right. So that's something that all the teams have been consistently working on. So that's also contributed to the margin gains that we saw.
Venkat, you want to add to wage hikes? How much, by when? And do you think your company will need to either freeze hiring or perhaps even look at layoffs?
Just to put numbers in perspective, we had 150 people hired last quarter, and we have gone down on our headcount about 109. So you see, we had to hire. So it's almost kind of a reset of sorts, if you ask me. Like Joseph mentioned, the pyramid getting slightly shifted with the way markets are moving. So that's one side, and we have to also, handle the attrition of 18.2%. So it's actually counterintuitive. You have got companies talking about layoffs, and we are having an attrition of 18.2, which does speak about the kind of people that we have and the attention that they are getting from the markets in terms of opportunities. So we balance both of them. So I can make one statement: we're not looking at layoffs as such, but efficiency improvement levers. We are surely working on that. In keeping with all of this and the market trends, we will be looking at compensation. Our annual increase is due this quarter, and we will be looking at it. And yes, obviously, that will have to be defrayed through revenue growth. Some bit of luck on the foreign currency and the efficiency improvement that we talked about in utilization. So we have to do that, and we have to also keep the market trends. So we are looking at going ahead with our increases this quarter. So we are working on that, and communication will be out to people very soon.
So wage hikes are intact?
Yes. No, I would say we are going ahead with the plan. The percentages are being worked out. If you look at the industry, nobody has made any commitments of any sorts. So in that kind of a background, there's quite a bit of assessment that's happening internally. What sort of increase that we have to do, and what are the segments that we have to look at. So all of that is in the works, Bima.
Needless to say, but hikes this year will be lower than last year, given the environment?
That would be a fair estimate.
Okay, that's an interesting chat. That's Happiest Minds talking about, of course, some of the generative AI revenues, etc. Some targets out there as well. Mitesh Thakkar is with us with what he'd want you to do as far as individual trades are concerned. Mitesh, welcome back. 10, 12 points, kind of tentative right now. Market breadth looks better, 1,500 up, about 1,000 lower on the NSE. Your trades?
The market has just been flat, kind of recovered from slightly from the intraday level, but again, it's also off from the days. It's just a market which is still not giving any strong directional sense to me, so I would avoid the index in that sense. On the stock side, I have one buy and one sell call. Angel One, I think, that's the stock which gave a pullback yesterday to its 200 average, and today it started dropping below that level again. So keep a stop at 26.61 here, and look for a short position, and look at a price target of roughly around 25.50, 25.40 to begin with. Maybe slightly lower, but I think that's the primary target. And on the buying side, I have Amber. That's a buy with a stop below 7,800, and look for targets of around 8,100.
By the way, GNG Electronics and IndiCube, they have become the two latest entrants on the street. And look at the listing. GNG Electronics is flying 44%. Oh, that's a big one. They run the brand called Electronics Bazaar. They're in the business of refurbishing laptops, among other electronics. IndiCube is, of course, the co-working space management company. 9%, 7% down on that stock, but GNG Electronics is definitely electrified. new listings of the day. Speaking of primary market action, very soon we'll hear from NSDL. And it's a reasonably sized issue as well, over 4,000 crores. We have Vamakshi joining in to give us all the details of one of the key depository participants of India. Vamakshi.
Well, NSDL is set to hit the markets with a 4,011 crore IPO priced at 760 to 800 per share. It's a pure offer for sale, meaning no fresh funds for the company, only exits for existing shareholders. At the upper price band, NSDL will command a market cap of around 16,000 crore with listings slated exclusively on the Bombay Stock Exchange. So let's decode NSDL. Set up in 1996, it is India's very first securities depository and remains the largest. It oversees the highest number of issuers, active instruments, and total asset value under custody. Think of it as a bank, but for securities, your stocks, bonds, mutual funds, and more, all safely held in demat form. The business goes beyond the depository. NSDL runs two wholly owned subsidiaries. NSDL Database Management Limited delivers e-governance and tech solutions from SEZ Online, insurance repository to digital onboarding. NSDL Payments Bank Limited offers digital banking, prepaid cards, merchant acquisition, and third-party product distribution. But NSDL doesn't operate in isolation. It's locked in a duopoly with CDSL. The differentiator, NSDL leans on institutions and unlisted companies, while CDSL thrives on India's booming retail wave. The numbers tell the story as well. In FY25, NSDL reported a revenue of 1,420 crore, growing at an 18% CAGR since FY23, yet the margins lagged 26.4% with profits at 343 crores and an ROE of almost 17.1%. CDSL, on the other hand, with a smaller revenue base of 1,082 crores, delivered 572 crores in net profit, a margin of 57.7%, and a stellar ROE of 29.9%. And valuations reflect this trade-off. At 47 times FY25 earnings, NSDL comes in at a 24% discount to CSDL's 61 times. But who's cashing in? Legacy investors. IDBI Bank alone will take home 1,778 crores, NSE 1,440 crores, SBI 320 crores, HDFC Bank 161 crores, and Union Bank 40 crores. For some like IDBI and SBI, returns stretch up to almost 400 times. But don't mistake this for a total exit. Post-IPO, IDBI and NSE will each still hold around 15%, with SBI, HDFC Bank and Union Bank retaining meaningful stakes. They're booking gains, but yet keeping their skin firmly in the game. And to wrap it up, NSDL is a story of steady growth with leaner profitability reflected in its current valuation discount to CDSL.
Okay, all right. Very, very interesting primer as far as the NSDL issue is concerned. I mean, the issue closes, I think, on the 1st of August. It's open for subscription today. Vamakshi, thanks very much for that. We'll take a quick commercial break here. Manisha joining us on the other side. Commodities in focus. Manisha.
Welcome back. Well, the equity market has been more or less flat. Let's look at cues coming in from the commodity space. Manisha is joining in with the latest. Over to you, Manisha.
Thank you for that, Subhi. Well, commodities are buzzing, and it's not just the crude oil prices that gained up by 3% overnight. It has been the case with the cross metals as well. But I want to put focus on the ferrous metals, steel and iron ore, that is, because we are trading at multi-month highs into both of these. Well, we have seen gains on improving macroeconomic backdrop is the reason you're looking at steel prices holding firm, and we are trading at a 4-month highs at this point in time. Also, when you look at the prices itself, on a week-on-week basis, the Chinese steel prices have gained up by 3%. For the month of July, we are up by 9%. But it is the US steel prices which seem to be outperforming, and that is because you have a 50% tariff on import of steel within US, and is the reason you've seen US steel prices gain up by 20% in this year until now. Well, apart from US steel tariffs, it also has to do with China, which really seems to be pushing quite a mite. The policymakers are looking to reform the industrial policy that has been supportive. China is looking to erase overcapacity in construction inputs especially, and then China crude steel production, when you look at for the month of June, also has seen a decline. That seems to be supporting prices. Bao Steel also says that they're expecting national output to decline by 50 million tons for 2025. So everywhere that you look, whether it's about cutting capacity to declining steel production, the month of May and then June also has seen a decline. And then guidance coming in for 2025 also has been on the weaker side. China also looking at that immense spent on the hydroelectric dam is also expected to lead to metal prices and metal demand gaining, and that has been supportive too. And then it's also about iron ore prices, which also are trading at around 4-month highs. Interesting statement coming in from Chinese Premier Xi Jinping, who's criticized local governments for concentrating investment in AIs, EVs and computing power and losing it all when it comes to infrastructure, construction, housing and real estate. And that is where the problem really seems to be coming in from. Apart from that, it was also about the Politburo meeting, which is underway right now. And some statement from China could really be supportive. And markets also are looking at the US and China trade talks, where we are hearing reading statements on how there could be a more longer breakthrough there. Markets are expecting China's stimulus measures to come in, and that really could be supportive. If you look at the iron ore prices for the month of July, then we've seen the Chinese prices gain up by 13%, while the US markets are up 5% as well. So ferrous, non-ferrous, all of those metals really surging, and the month of July has been quite positive.
Absolutely, and hopes ground that trade negotiations will turn out favorable between US and China. Thanks for that, Manisha. We do have to take a very quick break. When we come back, Lata will be in conversation with Rajneesh Karnatak of Bank of India to talk about the bank's Q1 performance.
Welcome back to our earnings analysis. Bank of India's first quarter numbers was impressive for the very minor fall in net interest margins, just 6 basis compared to what 25, 35 that others have reported. It's also a fairly decent 32% rise in net profit. But the bank's cost to income has risen quite sharply from quarter ago, from the fourth quarter. For more, we are joined by Mr. Rajneesh Karnatak, the Managing Director and CEO at Bank of India. Good morning, Mr. Karnatak. Thank you very much indeed for your time. Well, first up, if you can take us through this margins picture. It's not fallen much, but at 2.5, 2.55, you're already lowest among banks. You're saying you will bottom out this quarter? You don't expect Q2 margins to be lower than Q1?
Yeah, thank you, Lataji. Thank you for having me here. First of all, as far as the margins are concerned, I would say that, yes, we have bottomed out at 2.55%. If you see, it has come down by 6 basis points on a sequential basis, from 2.61 to 2.55. At the backdrop, it is the net interest income which has come down. So if you see the net interest income, our interest income has gone up by around 8%, and our interest expenses have come down. It has gone up by, in fact, more than 15%. So the net interest income, there is a minus of 3%. However, having said that, I would say that we have, the net interest income is flat at around 6,000 crores. So it is bottomed out in this quarter. We are saying this because of the fact that the repo rate impact, whichever is there, which we have already taken. So 1% repo rate cut, 60% of our loan book is the repo book, which has already been repriced.
No, 1 minute, sir. 1 minute.
Less.
Mr. Karnatak, just a minute, sir. You know, the second rate cut came in June. Could you pass? I mean, your EBLR, external benchmark linked, is quite big. It's 59% of your book. So it won't impact on your returns in Q2?
So in Q1, the first cut had come 25 basis point in February. The second cut of 25 basis point came in the month of April, and the next 50 basis point cut came in the month of June. You are very right that the last 50% 0.50 cut has come in the month of June itself. But nonetheless, even 50 basis point cut, which the full impact has been taken in the Q1. So 50 basis point cut impact was there for the full quarter of Q1. So that is what is the point that I would like to make. And on the liability side, the repricing takes some time. There is a lag in the repricing on the liability side. So we have already cut our saving deposit rates. We have already cut the fixed deposit rates. But the final impact on the liability side, on the interest expenses side, would be happening in the Q3 and Q4 quarter. So that is why we are saying that the stabilization of the NIM should be there from Q3, Q4 quarter onwards. And we feel that this 2.55 is bottomed out for us.
Okay. So, you know, most of your peers, like, you know, even smaller banks like UCO or larger banks like BOB, are all managing at least 2.9, 2.95 in terms of margins. What holds back Bank of India? Will you aspire to those higher margins anytime soon?
Oh, yes. If you see our book, there are two parts in that, Lataji. One part is with respect to our global book. If you see, 15% of that global book is the international book. So whichever bank has a significant international book also, their global NIMs are compressed on a lower side. So that is one of the basic reasons why our global NIM is 2.5. If I give you a color on the domestic NIM, there our domestic net interest margin is somewhere around 3%. In fact, it is around 2.9% at around our domestic NIM also. So because of the international book, the global NIM comes down. But nonetheless, we are very confident with the coming quarters, the NIMs should improve.
Okay. Well, let me come to the slippages. It's a very impressive number. Your credit cost at 68 basis is absolutely not a problem. But if I look at your SMA2, it's a little worrying. It has risen to about 4,400 crores, almost 3 times what it was a year ago. SMA2 means, you know, you're just a few days away from NPA. Should we worry that NPA can rise in Q2?
Yeah. So if I give you a color on the SMA book, you are right that in the corporate book, particularly the SMA2 book has gone up. So the SMA 0, which was there in June 24, has now gone to the SMA2 number in the corporate book as far as that is concerned. So majority of the SMA2 book is there, which is the corporate book. And these are predominantly 3 or 4 state public sector accounts, which are under the SMA2. But the present understanding that we have, these are all consortium accounts. None of them is a sole banking account. And the present understanding that we have is they should not be slipping into the NPA category. They should continue to remain in SMA2 or roll backwards in the coming quarters.
Okay, that's good to hear. The only other thing that we had about, doubt we had about your asset quality is that there are not enough upgrades and the write-off is a bit too much. Will that change? Will we be able to see more recoveries and fewer write-backs, fewer write-offs?
Yeah, so if I tell you the bigger picture which is there, in March 25, we had a gross cash recovery of nearly 9,500 crores.
Yes.
This year also we are targeting the same run rate of gross cash recovery of around 9,500 crores, and this does not include any write-off. So any write-off which is excluding that. So with that kind of number, and this quarter also, our gross cash recovery was more than 2,000 crores. In fact, our reduction in the NPA book, if you see in the outstanding, is more than 4,000 crore. 2,400 crore contributing through write-off, and 2,100 crore is the gross cash recovery, which is more than the fresh slippages which have happened. In fact, equaling to the fresh slippages. So gross cash recovery should be at the same run rate of around 9,500 crores in this financial year also.
Okay, and my final worry was on MSMEs. Would you worry that your growth of MSME loan book has been fairly robust? It is in high teens. Will there be more slippages in that? Is there any sign? Because I think in SMA2 you are indicating that SMEs are there. There is a worry, but the bigger worry is in corporate SMA2.
Yeah. So as I said, for at the cost of repetition, I would say that we are not much worried about the SMA2.
Yeah, I got that. Yeah, they are state institutions.
Correct.
But MSMEs,
Correct.
would you worry?
Yeah. So as regards MSME is concerned, you are right that we have grown on a YOY basis by more than 17% in the MSME book. However, the collection efficiency got impacted in the MSME book in this quarter, definitely. And if you see our fresh slippages of around 2,000 crore, nearly 30% of that slippage came from the MSME book. To give you a further deep dive into that, I would say that MSMEs up to 20 lakhs what the slippages, maximum slippages where it is happening. So it is the small ticket MSME book where the slippages are happening. That is a bit worry for us. And for that, we have improved our collection efficiencies and more of monitoring is taking place. And some guardrails also we are placing as far as the underwriting is concerned. And going forward with the busy quarters happening in September, December, we feel that this fresh slippages in the MSME should also come down in the ensuing quarters.
That's very good to hear, sir. Thank you very much, Mr. Karnatak, for joining us. The street is clearly noticing what you have said about the SMA2 book, as well as your NIM forecast that you've bottomed out and the stock is up 2.8%. From banks, let us move to a very important stock which is on the move today, and that's Tata Motors. It is a loser today. Talks have emerged on a potential Tata Motors Iveco deal. Parikshit, our correspondent, our stock correspondent, is joining us for more on that potential deal. Parikshit, what have you picked up?
Well, Tata Motors has been in talk with Italy's Iveco Group for several months now. This is to acquire a large stake in their commercial vehicle business. Now, what we learned from sources that both companies could announce the stake sale today, and Tata Motors will acquire the Agnelli family's 27% stake in the Italian truck manufacturer. And this could significantly enhance the presence of Tata Motors in the European market. This would be one of the largest acquisitions ever for Tata Motors. It is estimated to be around $4.5 billion. This is what we're picking up. So this would be a big move for Tata Motors at a time when their demerger process is also on. Hopefully, this will give them more access to European markets, and with the FTA, they could benefit as well.
Okay. Thank you very much for that very important nugget. At the moment, Tata Motors, I guess, is worrying because there will obviously be a debt addition because of this, and probably memories of previous acquisitions are not very pleasant even for Tata Steel. But, well, this time it could be different. Tata Motors a little under the weather because of this news. We have to wrap up on Bazaar on that note. Chartbusters after the break.
Shares of L&T rise over 4%, and the company is the top Nifty gainer today after reporting a strong set in the June quarter. They witnessed a 30% jump in profit, while order inflow also rose 41% year-on-year.
GE Vernova T&D jumps on the back of a stellar Q1 numbers. The net profit more than doubles while margin improves by 800 basis points. The company also sees a 78% jump in exports.
Bank of India trades higher after reporting 32% growth in profit due to strong credit growth. The bank's asset quality also improves on a sequential basis. The management tells CNBC-TV18 repo rate impact has taken on 60% of the bank's book.
Allied Blenders is higher in trade after a strong showing in the June quarter. The company sees an improvement in its sales mix, while profit jumps multifold, boosted by lower finance cost.
And two new debutants on bourses today. Shares of IndiCube listed at a discount to its issue price. It's lower by 12% now versus its issue price. On the other hand, a stellar debut for G&G Electronics as the shares listed at an over 50% premium, holding with a gain of almost 40% from its issue price. We will have the management later on in the show. Stay tuned for that.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets, have moved a little bit into the red. It seems, we're into a bit of a range. The only good point today is that, in fact, we made a higher high at the start of trade. But holding on to that is a little bit sketchy. So, Mangalam, we had a relief rally. Few earnings, positive surprises, which was good as well. Let's see if we can build onto those gains.
Yeah, that's exactly, what the street is hoping for. Let's see whether the yesterday's up move that was there, whether that momentum continues, or after that oversold levels and the bounce that we saw from there leads us to nothing but another consolidation. Brent crude prices, however, we'll keep an eye out on that, above $72 per barrel. A lot of stocks which are moving around. Delivery has moved to the low point of trade. Strides Pharma is at the low point as well. Post numbers yesterday did well and now selling off. In fact, a lot of these pharmaceutical stocks are lower. Laurus Labs as well. After a big move in the last couple of trading sessions, both their numbers seeing some bit of profit taking. But speaking about profits and profit taking, let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Jitendra Gupta joins us today with a stock. GT.
In a volatile market, we think JSW Energy could be good investment backed by strong execution, robust balance sheet and aggressive renewable expansion. The company offers good earnings visibility. In its recent move, it completed 12,500 crore takeover of O2 Power, which is having a total capacity of 4,696 megawatt of renewable platform. This deal gives JSW access to 2.3 gigawatt of projects which are expected to go live soon. For the remaining 2.4 gigawatt, it will invest close to 14,000 crore. Importantly, the company has reprioritized its capital allocation. More capex is directed towards inorganic growth, which will provide higher scale, offer better returns, and of course allow operational synergies. Now with 10,000 megawatt of operational capacity, JSW Energy, which was targeting 20 gigawatt of capacity by 2030, but at the current rate of pace, it may hit that number well before. The management estimates that a 20 gigawatt portfolio could clock close to 20,000 crore of EBITDA by FY28, which is nearly 4 times FY24 levels. Stock is currently trading at nearly 29 times its FY27 estimated earnings. Considering robust balance sheet, healthy cash flows, strong pipeline of projects and earnings growth, stock offers good margin of safety.
All right, meanwhile, keep an eye on the bottom of your screen. Orders worth nearly 1,500 crores coming in for KEC International. That stock mildly higher in trade. A lot of these companies have seen strong order inflows right from L&T to the others that we're looking at. Take a short break, come back on the other side. We do have stock-specific action on the other side. Stay with us.
Welcome back. As promised, let's focus on Arvind Limited. That one put up a steady show in the first quarter. The profits jumped up by close to 35%. The uptick in revenues was around 9%. We're now joined by Puneet Lalbhai, the Vice Chairman of Arvind, to discuss the quarter gone by and how things should shape up. Hi, Puneet. Good morning. Thanks a lot for joining in. Well, you started off the year on a decent footing, right? It's a 10% growth on the top line, but margins have improved. For the year on the whole, what kind of a revenue growth? Should we be working with mid-double-digit growth? Would that be possible? And also, if you could tell us, advanced material, that didn't grow as much as what your textile business grew. Do you see that picking up as well? Because that would be margin accretive.
So I think at the outset, let me say it's been an extremely challenging quarter because of the global trade uncertainty. And unfortunately, that uncertainty persists. So we are comparing a Q1 to last year's Q1, which was also very challenging for us. So there looks like we have, it's a decent quarter. And actually, given the circumstances, it is a decent quarter. But I expect that the first half of the year will continue to have some of this overhang of tariff uncertainty. However, the second half of the year should start looking much better. As far as AMD is concerned, we are facing a little bit of uncertainty-related holdback on orders, and we expect that to also come back on stream in the second half of the year.
So all said and done, what do you expect for this entire year? First quarter you said was challenging. You did about closer to double digits on the revenue. You said second quarter challenges continue. I suppose even if it continues this way, you could do about double digits. The second half likely to do a lot better. So like Nigel said, mid-teens revenue growth possible this year. And advanced materials, first quarter 350 crores. By when do you reach that 450, 500 crore per quarter run rate mark?
That should happen by the second quarter as far as AMD is concerned. And as far as the company as a whole, the growth should be in early double digits because we did grow quite well.
Okay. And margin improvement scope from here? If AMD is going to bounce back, then margins could gradually move towards the double digit mark? Or do you think it'll hover around this 9% odd?
So actually the margin has been the bigger challenge, and the margin is likely to be the bigger challenge in the first half. So most of last year we were in double digits. We have gone slightly lower in the first quarter, and that is related to discounts that we had to pass on due to tariffs, air freights, due to order mismatches, and demand uncertainty. So that continues till the second quarter, but third quarter onwards, that impact should be behind us.
So EBITDA margins right now closer to 9%. Do we see them go back to double digit by sometime this year?
Definitely in the second half.
Okay, definitely the second half. So far what we know is that low double-digit revenue growth for the full year, 450 to 500 crore quarterly run rate happens for the advanced textile business from the second quarter onwards itself, and margins in double digits by the second half. Let's talk a little about your textile business itself. We saw growth coming in from denims, wovens, and you are fairly confident about garments growing as well. If you could give us a sense of what proportion of your textile revenues comes in from garments, how much of it comes in from woven, and how much of it comes in from denims?
So, I mean, the way to look at our business is that historically we've been a very fabric-heavy business.
Yes.
And only recently have we been vertically integrating the business into garments. So currently garments stand at 20% of the fabric that we produce, we convert into garments ourselves. That number has to go up quite significantly. We would like it to double. And we have a very robust plan to go from about 40 million garments that we did last year to around 60 million in a year, in another couple of years. So that's the kind of investment. The focus on growth in the fashion side of the business is going to come through.
And what is the incremental delta from garments? Say you're making 100 rupees with a 20 rupee contribution coming in from garments. If that 20 goes to 40, which you want to do over the next few years, what would the incremental revenue and concomitantly EBITDA be for you?
So the way to look at it is that verticalization is a result of changing business models globally. So more than the value addition, that that differs quite a bit from product category to category. However, the real reason why verticalization is important is it makes you more strategic to your customers, especially in this kind of protectionist world where there are going to be trade blocks and there's going to be mostly in-country sourcing. And of course, the opportunity to target the domestic market is much better done through full package vertical garmenting route.
Okay, all right. What about debt repayment?
So debt, we feel we are very comfortable at the level of debt we have. We are saying that we have around that 400 crore mark of long-term debt. That we don't want to go very much more than that, and we would like to sort of let working capital remain the way it is at the turns level. So the efficiency of working capital should remain.
So the net debt number that we have, Puneet, is around 1,470 crores. So it hovers around this vicinity?
Yes, it's around that 400 mark. It's around 375 or something.
All right. India, UK, they signed that FTA. And, many believe that that's a big potential for Indian producers. For you, what percentage of your revenue comes in from UK? And how big, an opportunity is for you? Where do you see that number headed?
So we are around that 10% mark at the moment, which is not insignificant, but it's also not very large. We believe that this FTA will significantly make India very attractive to the UK. It should double our garment exports at a minimum. And for us, that also represents a very large opportunity, and we're working towards that.
Are you more optimistic about the India-UK FTA, or are you more worried about the India-US trade deal? Because on a daily basis, we get some or the other comment from Donald Trump, and some days it is complimentary, some days it is not. But be that as it may, if it is between 20 to 25% tariffs, do you stand to gain or do you stand to lose?
It will all depend on how the negotiations play out and what relative tariff regime comes into play for India vis-a-vis our competitive locations. Common consensus right now is that India should be at an advantage. However, there will be short-term disruption because of tariffs moving up and down and customers trying to manage their near-term P&Ls, taking decisions to do just that. So short-term, it's going to lead to a little bit of chaos and uncertainty. But at some point, this whole thing will settle with relative tariffs of hopefully in India's favor is what everybody is feeling. But of course, we have to wait and see where everything lands.
All right, Puneet, we'll leave you with a promise to join us back as soon as there is some more clarity on the tariff-related issues, and maybe you'd be at a better position to comment on the actual impact of that in the near and the medium term on that. For now, we'll hold on to double-digit revenue growth for this year, with margins expanding in the second half of this year itself. Take a short break. On the other side, we have the management of G&G Electronics joining us after a strong D Street debut. Stay with us. Well, one of the stellar listings of recent times, we have G&G Electronics. Shares list at a 50% premium to its issue price and now still holding on with 40% gains. There was a sharp, demand for this. The issue, a near 460 crore issue, was subscribed by almost 150 times as well, still holding with a 43% gain. The question is, where does it go from here? We have Sharad Khandelwal as well as Ajay Pancholi, who's the director, and Sharad Khandelwal obviously is the founder of the company, chairman and managing director. Congratulations, it's been a stellar listing. There was good demand, but more power gives you more responsibility, and that's what the street really wants to know right now. Ajay, your business has been growing fairly well. The two things that I want to understand from you going forward is what proportion of your revenues will come from India, how much of that will come from Middle East, at what rate are these two likely to grow going forward? And your margins, they've been between 7.5% to 9%. Where do they settle?
So first of all, thank you to the investor community at large. The resounding response and the success that we have received leads to a significant responsibility onto us, and we hope that we'll stand to the confidence that has been shown. In terms of how we see the international and domestic revenue, as you would know that the product is an international product. We have presence across India and international, and we see that the significant market, India, continues to grow, and so does the global markets, and we see a similar proportion to continue in terms of our overall trajectory in terms of the business growth going forward. And as regards margin, I think we have been fortunate in terms of the business that we have grown, the category that we have creation, and as this goes in the future in terms of more acceptability of the product, we see the stabilization of margins at a healthy level going forward.
And what about your mix, revenue mix?
International and India?
Yeah.
Last year it was about 75%. Last year it was 75% international and India being 25%. We don't see a significant change going forward as well. We see that the absorption on both sides and overall markets on both sides will grow and lead to a continued proportion more or less similar.
And most of your revenue comes in from sale of laptop. Will that change, or that's likely to stay pat?
No, it's likely to continue in the 75 to 80% range in terms of laptops and other ICT devices.
So no big change in terms of a revenue mix. Got it. You raised this money to repay debt. So now you're debt free?
Yes, we will be.
All right. So that will be a good amount of...
debt free, and that gives us a huge opportunity.
So close to 40-45 crores of interest savings per year is what we could say. Going by that, your net debt was around 400 crores. And now you'll be debt-free. So I'm assuming you're borrowing at 10% odd. So around 40-45 crores of interest saving?
Yeah, last year we had a total interest payout of about 38 odd crores. So that will give you a sense.
All right. Sharad, what about, the pace at which you can grow from here on? The reason why I ask you is because, the industry is still largely unorganized. You expect the organized industry to grow faster. If you could give us a couple of numbers, at what pace is the organized industry growing? And at what pace have you been growing in that organized industry itself? Over the next, say, 3 to 4 years, what is that mix likely to be?
See, we have grown, thank you, Mangalam, 40-45% last 2-3 years. And we are kind of doing a category creation, making industry more organized, not only in India, but across the world. Industry is largely organized, you're right, and getting more organized because there is a big value proposition. The proposition has a lot of advantages on both sides, on the vendor side as well as on the customer side. We will continue to grow at a very healthy rate as we move along because it has tremendous potential. The use case is across. On the business side, it enables e-education, e-governance, as well as for SMBs and other in all the markets that we are in. Industry is getting organized across the world from being an unorganized market, as we have seen in other items like car market, it is getting more organized and will be ahead in that. Difficult to put a number, but yes, we'll have a very, very robust growth. More responsibility now coming our way. Yeah.
Ajay, it's difficult to put the numbers here, but if we do some calculations by our own estimate, last year you did 1,400 crores of revenue. Say you add another 300 crores more this year, you're roughly likely to do anywhere between 1,700 to 1,800 crores on the top line. Your margins stay at around that 7% mark. That's about 120, 130 crores on EBITDA. And add to that, you will be saving that another, 38, 40 crores on interest expenses as well. Take the tax out, are we likely to see over 120 crores of PAT in FY26? Is that a fair estimate?
I would say you have covered it well. I would just acknowledge that we are in the right trajectory.
All right.
Okay. All right. Final question before we let you go. What about sourcing? From where do you source it individually? If you want to break it up country-wise, and anything else sourced from China?
No, we don't source anything from China. We buy from large corporates, mid-corporate leasing companies, mostly businesses, small IT asset disposition companies in India and international market. From Europe, America, India, everywhere we source from. It's a long tail of suppliers that we have.
Okay.
All right. Thank you so much, gentlemen, for joining in. The street, once again, has been celebrating this listing.
Yeah.
But then again, it is now on to you to go ahead and deliver on their expectations and promises.
And how Mr. Khandelwal said, right? With great power comes
great responsibility.
Spider-Man.
With that, we are responsible to leave you on this show of Chartbusters. And on the other side, the team of Trading Hour comes up next.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Fatakia. You know, yesterday we snapped that 3-day losing streak, saw stellar gains towards the second half of the trading sessions. But today we are not continuing that. And it also is the monthly expiry week. Tomorrow we have the expiry, the end of the month, the end of the expiry as well when it comes to the month. So interesting moves is what we're expecting ahead of that. It's been quite volatile, you have to say. Usually it's seen on the last day of that weekly expiry, but this entire week has been volatile. But for now, if you look at the Nifty, absolutely flat with some negative bias. The major underperformance, so to say, is coming in on the mid-cap. So that index is down 0.3% as we speak. We did see that recovery that came by in Nifty. That happened with the mid-caps as well. But overall, the market mood is towards being very quiet. If we talk about the small-cap index as well, down 0.2%. And there are some sectors, the likes of Nifty CPSE, Nifty Infra, they are in the green. Of course, those big numbers from L&T, better than what the street was expecting. That's the reason that index is getting some support. We do have major movers coming in from the Nifty. So L&T, of course, is the top gainer. We have Tata Consumer as well, which is surging right now. And tomorrow is big day for results. A lot of them, Coal India, HUL, M&M, to name a few actually. So major results which are expected tomorrow, ahead of which we'll watch out for moves on these names. But that's about the big names, right? We will also spotlight on top movers in the market. Hormuz has gone ahead to that big wall to tell us all. Hormuz.
Earnings reactions continue to dominate, as you mentioned, right? The list is endless. If you could take a look at the number of reactions that are moving around to the results. You start off with Nilkamal, then being the first one, came out with results last evening and has seen a negative reaction to that. And the volumes are increasing. Now, interestingly, the last 4 sessions have seen volumes in 5 digits, which is in excess of 10,000 shares. And over the last 4 trading sessions, close to 80,000 shares have been traded compared to a 20-day average of just 1,100 shares. So that is the kind of volume activity that you're seeing in Nilkamal today. The other one is Vishnu Chemicals, and that's on the positive side. It's up 12.5% today, was up 4% in yesterday's trading session as well. And take a look at the volume activity here. Just in the first 2 hours of the trading session, we have had 20 lakh shares of the stock being traded compared to a 20-day average of just 20,000 shares. And it's been a one that has delivered positive returns every single year since the end of 2019. The other one is Triveni Engineering, and that's a negative reaction today. It's down in 3 out of the last 4 trading sessions. Another 6% knocked off today. And on very heavy volumes too. 13 lakh shares have been traded compared to a 20-day average of 1.5 lakh. And it's had a good run over the last 4 to 5 years. But this year, the stock is down 25%. And this is poised to be the first negative year that the stock may have since 2018. And lastly, an example of a wealth destroyer, New India Assurance. The stock is up 8.5% today, but don't get fooled by that. It's still down 8% on a year-to-date basis. It listed in 2017, and with the exception of 2023, the stock has delivered negative annual returns every single year. The stock is at 188. The IPO price is 800 rupees a share. So a positive reaction today for New India Assurance, but the broader markets, though, are veering towards the negative side.
Oh, they are. It was such an interesting list, Hormuz. Thank you so much for bringing us that data. So those are some broader market movers that we are talking about. But let's talk about a new entrant on D Street. IndiCube Spaces made its D Street debut today with a discount at a discount. The listing price was 216 rupees versus issue price of 237 rupees per share. The company provides managed workplace solution and has a strong presence in Bengaluru and 13 other cities. To discuss more on this, Rishi Das, who is the chairman, executive director and CEO at the company, is joining us now. Rishi, good morning. Thank you so much for joining in. Now that you are listed, you can give us more sense of what the broader market picture and the future growth is looking like. You have seen a 35% revenue CAGR over the last few years. Is this something you will be able to continue going forward? And while we talk about the top line, bottom line is something that investors want to know more about. As per the P&L, when will you get into black?
So, thank you so much, first of all, giving me the opportunity to come here. And I think our sector has been growing very well, and the industry has been growing at least 20-25% year on year. And if you look at the CBRE forecast for the next 2-3 years, that looks likely that this will grow at that. and we have been growing better than the industry average. So we have every reason to believe that we should be having good, robust growth in the coming time. Plus, I will also like to emphasize that we have almost 33% of the space that we will be occupying over the next 6 to 18 months. And that portfolio should allow us to have a lot of headroom for growth. And overall, I think we should see great performance coming forward, yeah.
And what about the bottom line? You said you're profitable when it comes to a different accounting standard, but with what you report, with those accounting standards, by when will you be seeing a black on the profitability?
Yeah, so very difficult to put a number to that, as you can imagine. But yeah, like because a lot of our properties are on long leases, and typically what we have seen for a given lease, basically like after 8th or 9th year, if it's a 20-year lease, the accounting, as per the accounting standard of Ind AS, the tides turn. And since we have a good portfolio, which is now almost like more than 5 years old, and we continue to grow. So I think in the foreseeable future, we should turn it. But if one were to look at like year 23, we have paid income tax. Year 24, year 25, we have paid income tax. So we have been PAT positive all these years typically. So I think it's more and like that's what as per our roadshows also we have tried to explain to investors that how and what is the right metric. And as we will be releasing our results, we will be providing investors with the comparative on both the accounting standards, so provide them more clarity. So we are very healthy at EBITDA level. Our unit economics metrics, if you look at our occupancy, is north of 85%, which is very, very good in our industry. So I think all that points to that we are building out a very sustainable, robust growth engine. And that's, to be honest with you, that should not be a worry for any investor. What you are seeing as per the accounting standard, a loss kind of a thing.
Rishi, congratulations firstly on your listing. You're now a public company, so well, you will be asked for numbers. And, you know, geographic concentration is one thing that has been of note in your numbers. 60, almost 2/3 of your revenue comes from Bengaluru. Are there plans to diversify to other major office markets of the country? And what are the plans on the annual for this year?
So we are diversifying. If you see, like a year back, we were just in about 10, 11 cities. Now we are 15 cities. So we are growing. And if you look at, of course, Bangalore is the largest market. And if you are aware, like 30% of the real estate that India absorbs annually just gets absorbed in Bangalore. And Bangalore absorbs perhaps the most amount of real estate as a city anywhere in the world. So definitely we have a pivot towards Bangalore. We see that more as a strength. Having said that, if you look at a city like Chennai, we have almost 1.5 million square feet of space now, followed by Pune. We are going very fast in Coimbatore and a lot of other tier 2 cities. So going forward, see what is happening is that we have to appreciate the fact that work is going where people are. Not the other way, like my generation went where work was. So I think that shift is a very secular trend. And IndiCube clearly is looking at riding that wave and trying to expand within cities and in a lot of tier 2 cities as well as we grow.
Okay. Rishi, what is the revenue per square feet currently? What has been the growth so far? And what will the levers be for growth from here on, apart from adding the portfolio that you've been talking about? 8.3 million square feet will be the total asset under management. Will you look at some places with higher margins, any premium places or spaces that you'll be offering to clients?
So we have a very healthy mix of office spaces. If you see, as you rightly said, out of 8.3 million square feet of portfolio, 6.3 million of portfolio is operational. And we have a good headroom of more than 2 million square feet that is going to get added over, as I told you, over 6 to 18 months. So there is quite a good growth potential that we are likely to see. Sorry, I forget the second part of the question. Just can you repeat?
No, I wanted to understand what has the revenue per square feet been? How much has it grown?
Yeah. So I can tell you in terms of seat, like typically we market seats in locations like Outer Ring Road, kind of locations in Bangalore between 8,000 to 9,000 rupees a seat. And seat for us is about 45 square feet on an average. So if you go by that logic, about 180 to 200 rupees is our revenue realization per square foot. That's what we realize, yeah.
All right, Rishi, thank you so much for sparing time joining us. Congratulations once again on your listing, and we hope to chat with you once you come out with your numbers as well. The management of IndiCube, the second listing of the day. The stock listed at a discount is slightly extending its losses now, 11% lower now compared to its issue price of 237. The other one though, GNG, listed at a 50% premium, still holding on to gains of around 43 to 44%. Take a short break here on Trading Hour. All things commodities on the other side with Manisha Gupta. Welcome back. All things commodities now. Manisha Gupta is here with us, and to put the spotlight on crude that is being on the boil yet again. $72 plus now for Brent, Manisha.
Oh, well, absolutely, yes, Hormuz. It was 2% of gains on Monday, 3% up on Tuesday, and we are holding at $72 a barrel right now. If you look at the last 1 week, we've seen prices gain up by 6%. And for the month of July, the crude oil prices are now 8% on the higher side. It's trading at a 5-week highs as well. And there are various factors supporting the markets. One, it has to do with improvement in the global trade sentiment, with so many trade agreements being signed and more perhaps on table with some timelines coming in. This tells you that the economies will do better, and the global economic growth, or rather global demand growth for crude, perhaps could be in the supportive side there. Second important part really comes in from Russia, where Trump has now said that he's giving them 10 days to agree on ceasefire or perhaps face secondary sanctions. Now, we already have seen European Union put an 18th package of sanctions on Russia, and the 18th package mostly was on oil and gas and energy in sense of Russia there. There also is a corresponding statement coming in from the US Treasury Besant saying that if the sanctions do come in on Russia and the deal with China until then is not done, then China could perhaps be sanctioned as well for buying Russian oil. So various statements going around, and that clearly seems to be supportive for the prices there. Apart from that, it also has to do with the OPEC Plus statement where they say, or the conversations within, that after increasing output from the month of May until September, October could be a month of pause. That has been supportive. But in focus clearly is the PMI data from China that comes in tomorrow. It also is going to be the Bank of Japan monetary policy meeting. That is tomorrow. And today you have the US Fed meeting. So the next 24, 48 hours are going to be quite eventful, and that is where the markets will take cues from.
All right, so that's all about crude oil prices at 5-week highs. Thank you so much, Manisha, for joining us as always and telling us what's happening in the world of commodities. A reminder for our viewers now, though, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, a premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. You're still tuned into Trading Hour. It's a good time to get a technical check on the markets. Mitesh Thakkar is joining us now for just that. Mitesh, good morning. Thank you for joining in. What's your take? What would be the next important level? We are seeing a lot of volatility, that recovery that came by, then it's getting sold into. What are the charts suggesting?
So, my belief is that, the immediate downside may be limited to about 24, 500, 550 zones. And because we haven't got a very strong reversal sign, I think on the upside also, it could be a range of about 25, 250 thereabouts. It looks like basically the market could be starting a new range between this 24, 550 odd levels to about 24 to 25, 250 odd. So that's the kind of outlook on the index. On the stock side, though, I have a buy on CESC Limited, which is capital equity. Keep a stop at about 176 and, look for a target of around 180. And the other one is Bank of India. Target of 182. And the other one is Bank of India, which I would recommend buying with a stop at 114, targets of 120 plus.
All right, Mitesh, thank you for joining in with your views on the index and on specific stocks as well. But there has been a very sharp recovery over the last few minutes. So it's good time to go across to Mangalam to see if there has been any dramatic shift in the F&O data. Mangalam.
Well, there hasn't been a dramatic shift in the F&O data, but the fact that there was an uptick which was imminent was visible yesterday as well. The question is whether we go ahead and, regain that momentum as we move towards expiry, or do we just consolidate at lower levels, or after having seen that up move yesterday itself, consolidate at current levels or not. So you look at the Nifty Bank as well as the Midcap Index. The Midcap Index is slightly lower, even as the Nifty is hovering closer to that 24,900 mark. The 24,900 call writers, they're still not facing the jitters. In fact, they're constantly writing more options out there. So 24,900 call is something that I'm definitely watching out for. If the market sustains above that 24,950 mark for a bit, then these call writers will have to cover their positions, and a move similar to what we saw in yesterday's trading session may take place. But until then, we are looking at just some consolidation. The 24,850 call writers, they're also fairly active for a premium of 90 rupees, telling you again that, around 24,940 to 24,950, there is some supply which is likely. However, what this up move has definitely done is given confidence to people to go ahead and write the 24,800 put, telling you that the support for the market has moved higher. Yesterday's low was just around the 24,600 mark, but today that's moved higher to around 24,650, 24,700, because that's where we've seen a lot of put writing at 24,800, and the premium out there tells you between 24,700 and 24,750 there is support. So broad range, 24,750 on the lower side for the Nifty on the way up until 24,950 is taken out considerably. We can't expect further short covering. So that's the broad, consolidation that the index is likely to face. But a couple of stocks, they are on our radar. L&T continues to do well from yesterday. Yesterday, the up move was ahead of numbers on the back of an order win. And now order inflows are strong, so a lot of long positions being added on L&T as we speak, and that's also taken the Nifty higher. And the second stock I'm looking at is Tata Motors, because, ever since the start of trade, it's been under pressure on, on the news of a potential acquisition. The company has not come out with any clarification, but the street has taken a lot of short positions and on that counter ahead of that news itself. So were that news to come by, it will be very interesting to see whether those shorts unwind their positions or not.
Okay, yes, there's a lot of news flow as well on Tata Motors. Thank you so much, Mangalam, for joining in with that F&O update. By the way, the surge that we're seeing from the lows on Nifty is coming because of Reliance Industries and Infosys as well. Both these stocks have recovered from the lows of the day, and they are supporting the Nifty from the lows. So watch out for that one. There's a major recovery that we're seeing in the markets currently. But you have to remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour, and it's all about IPOs now. Let's talk about Sri Lotus Developers in Realty. The company is eyeing D-Street debut. The IPO has opened today, will end on August 1st. The IPO size is nearly 800 crore rupees, issue price between 140 to 150 rupees per share. Anand Kamalnayan Pandit, who is the chairman and managing director, along with Sanjay Jain, who is the CEO at Sri Lotus Developers and Realty, is joining us now to discuss more and to understand about the company as well. Gentlemen, thank you so much for joining us today.
Thank
and
you for having us.
93% of your total projects come in from redevelopment, and only 7% is coming from greenfield development. Tell us, how does accounting work here? Because usually when we talk to real estate players, it's more about how are the bookings going on. How does redevelopment differ from that? And what is the margin differential that you earn versus, say, a greenfield project that you will be coming up with?
Sure. So first of all, I'll introduce my company. We are in a micro market of Mumbai, operating in luxury and ultra luxury space, and that also in redevelopment space. In generally redevelopment space, people are in aspirational or premium category. We are in luxury and super luxury. So when it comes to redevelopment of societies, as we know, we don't have to pay for land. That's the main hurdle or advantage, I would say, in our case. Also, second advantage, we are not carrying much issues with legal, because their buildings or societies are standing there since many years. So these are the two major advantages what we are having. And otherwise, when you take a greenfield project or maybe a land, then you run a risk of title maybe at some time, or maybe some approval issues. Here, we don't find that. So because of that, and also since all these societies are generally have taken away those prime land in the locations. So all those prime land we can get. So these are the advantages for us. And also our sale becomes easy because society old tenants who come back to the society, they generally need more extra space or more apartments or more office space. So our even, I would say about 10 to 20% our material is sold to them. The model is we go to society, old societies, we make the partnership with them, we remove their whole building, we make a tall high-rise building, and percentage of that, generally about 35 to 40% of that new building, we give them back. And remaining portion we use for our recovering our cost and make the profit out of it.
Okay.
So that is why, we are like a net debt-free company. We don't need debt. Even up to the extent that we have got 300 crore fixed deposit as on 31st March, which is very unlikely with the real estate company. So we are slotting our company, not a hardcore real estate company. We are, I could say, we are more like a specialty chemical company rather than a chemical company. And we are like a product company in real estate space. So we make product, we make a high-end product, fully loaded product. And we complete all our projects faster, 2.5, 3 years. And that is how our business model is.
Gentlemen, thank you for joining in. Congratulations on your IPO as well. You have a major concentration towards the western suburbs, right? But now with the western suburbs being the way they are, and the eastern suburbs, particularly Thane and all those areas coming up as rapidly as they are, have you thought of moving towards those areas as well? Because the demand for more than premium housing or more than entry-level housing has increased even in those areas.
Yeah, I mean, as I said, we are more in luxury and uber luxury space. So we are right now concentrating on western part, and now we have entered into town also. And our philosophy is that we want to take one micro market, and which are micro market which offers at least 50 to 60,000 square feet per square feet kind of pricing. Only those markets we are moving right now. And we don't have to, we have no marketing. We have never done any marketing. We have never advertised. Maybe probably first time in my life we have advertised today, because our IPO is open and we have to give that mandatory advertisement. Otherwise, no advertisement, no hoardings, no social media marketing. We have never done any printing of even brochures. No big launches. So what we do is we focus on our high-end product and on customer and customer service. So slowly, every micro market we establish ourselves, we get those kind of premiums and move forward. Yes, answering your question, yes, tomorrow if we find a potential in other micro markets like Eastern Suburb, Thane, we'll be more than happy to move there. Since we are an asset-light model, we are completely asset-light model, except one project, which is 7% constitutes of our total portfolio. We don't have any land. So because of that true asset-light model, we are that flexible. We can go anywhere, any micro market.
So, I was looking at your numbers. Now, since you do not have an accounting issue, I believe you do not go the completion method. It's as per the stages, right? As per the P&L. EBITDA margins at FY23 were 12.8%, moved to 52.6% in FY25. Is it the right way to look at those margins? And will you be able to maintain these numbers? Because that's a sharp surge that we're seeing now.
So we are following the percentage completion method. So in 23, 24, 25, the average sale price is increased. And because of that, the EBITDA margin is much higher. And we are continuing on all the other projects we have taken. We are aiming the same margin can be achieved.
So it'll be around 52% is what you're saying, even going forward?
We are thinking about that. So we can achieve the same margin.
So your square foot per square foot pricing will be around 50 to 60,000 going forward?
Right now, depending on the project, because commercial and residential, both we have got projects. So depending on the project, depending on where we are located, it's between 45,000 to 65,000. That's the price range we are working on.
Now we have 13 projects that are listed for execution, if I get that number correctly, compared to awaiting approvals. In those projects, what kind of revenue recognition are you expecting, and by when do you start recognizing revenue from those projects?
So total 16 project is, so 5 is upcoming, 5 is ongoing and 11 is upcoming, out of which 7 project that will be around estimated sale of 7 lakh square feet will be launched in the current year, and the total balance 12 lakh will be launched next year. So that is the total gross development.
Okay, so what is the idea on growth then when you're looking at higher square foot projects going forward? So the top line, what kind of growth are you expecting there? And in terms of, since you're an asset-light model, so you won't be looking at a lot of capex, the pipeline will be asset-free. So what is the plan with the cash that you have? Will you be giving it out as dividends? Will you be reinvesting it back in the business? Because it won't be requiring that kind of reinvestment as well, since you're just taking buildings and redeveloping them.
Yeah, so two separate things. One is taking care of our investors. Yes, at the appropriate time, we'll take that decision, how to share those prosperity with existing investors. And as far as our proceed is concerned or our profit is concerned, yes, we will be plowing back into the business because we want to grow this business. Since last 6-7 years, we have done many redevelopment projects in ultra-luxury category. And that model has proved very robust and very solid. And according to one report, almost 30,000 buildings or societies are about to go for redevelopment. So we have got a huge market which is ahead for us,
Okay. Fair to say that from 560 crores in FY25, you would go up to say 900 or 1,000 in the next 3 years?
Difficult to say that forward looking,
Yes.
But whenever after listing, when we'll come here, we'll give you the guidance.
We'll get all the numbers from you.
We'll give you the guidance. And we are a very unique company. We do not have any RERA case also. As I said, technically we are net debt free. We don't have even a RERA case. Our ROE is very high. Our EBITDA margin is also very high. And we do very fast execution. And because of that, that brand equity we have built, that in luxury space, we make projects very fast.
Got it. Makes sense. And we understand compliance issues, so you can't give us forward-looking statements, but definitely we'll ask you all of that once the stock is listed as well. Thank you so much, gentlemen, for joining us today and telling us about your company. That's about Sri Lotus Developers and Realty. The company is largely into redevelopment, most of it, 93%. So interesting business model there. Time for a short break now. Management of Allied Blenders will join us next to discuss their Q1 numbers and more. Stay tuned for that.
Welcome back. In conversation now with the management of Allied Blenders. Alok Gupta, who is the managing director, is joining in to discuss the road ahead for the company and the quarter gone by. Alok, good morning. Thank you for joining in. You know, your premium and above segment has done very well this quarter. It's been a strong start to the year. 55% of your top line came from this segment. Majority of your volumes came from this segment. what is the kind of mix that you envisage for the full year and the kind of growth that you are anticipating for this segment in FY26?
Thank you for inviting me and for the performance on the P&A segment. We are targeting P&A to contribute to about 50% of our overall sales. FY24, we were at 37%. So over the last 4 quarters, we are already at 46 in Q1 of this financial year. So we are targeting to get the P&A salience to go up to 50. The value share from P&A is already up to 55%, and they should further consolidate about 60% of the revenue coming from the P&A segment.
Okay, and what kind of growth will you look at in FY26 from the P&A segment?
We are hopeful to target a double-digit growth from the P&A segment. We've already seen in Q1 a growth of 44% coming in, but overall we are looking at high double-digit growth coming from P&A.
Okay. Alok, a large deal happened in the space recently with Tilak Nagar making that acquisition. Do you think there'll be more competition in this space? And what kind of market share are you seeing in some of your major brands?
Well, I think it's not my place to comment on the competition. If I was to see it through a consumer lens, consumers prefer one brand over the other. So eventually, we believe it's a high-cost acquisition. Therefore, we believe there will be discipline in terms of how the brand is taken to the market. So eventually, the war will be fought with the consumer. Who wins the consumer gets the market. From a market share perspective, in the prestige whiskey segment, we have 3 brands, which is OC Blue, Iconic, and Sterling Reserve B7. Iconic continues to be our growth engine. We did 5.7 million cases last year, and it has got a very strong ARR, and we are seeing buoyancy in other 2 brands. So we'll continue to acquire market share. So the battle has to be fought with the consumer. That's all I would say.
Alok, there were recent developments, right, with the Mansion House launch and the Savoy Club Spirit brands, where the Bombay High Court had restrained you from doing so and had ruled in favor of Tilak Nagar Industries. What's the future course of action that you plan on taking in this regard?
The matter is sub judice. Unfortunately, I cannot provide more color to it. But needless to say, the projections that I've shared in terms of either our volume growth or on our gross margin or on the forward EBITDA does not factor any future gain that may or may not come from these 2 brands. So our entire plan is independent of these 2 brands.
Okay, got it. So there's no indication on by when there'll be final decision on this?
Like I said, unfortunately, cannot provide you color on this.
Got it. Any clarity on the net impact of Maharashtra excise duty impact? It is less than 10% of your overall volumes, but you had indicated there could be some changes. What's the final take?
Well, the final take can only emerge once we have a clarity on the MML policy, which is yet to be announced. The only thing that has been announced so far is the excise duty that will be applicable to MML. But the final contours are yet to come through. So until unless we do not have full clarity on MML, forming a view is difficult.
Now that we have done with the first quarter and it's been a very healthy start to it, Alok, what are your realization targets that you have set for this year and your volume growth target as well for the overall business?
So I think 4 broad themes that we have spoken about consistently over the last 4 quarters continue to focus on profitable growth. We're looking at a double-digit volume growth and a mid-double-digit value growth coming on back of solid P&A performance. We'll continue to focus on gross margin improvement through 3 basic means, which is focus on cost. So far, the environment has been neutral to positive. The FTA would be a big boost to our margins. So we are hopeful that in this financial year, maybe by Q4, we'll get final controls on implementation of the FTA. And third really is the investment that we made in our backward integration program, which is in moving our ENA capacity from 1/3 to 70% on back of acquisition did in Maharashtra, the malt plant and PET. We are looking at gross margins to improve further. And therefore, we should see EBITDA equal or higher than the Q1. But more importantly, the overall borrowing is down. And we have also been able to correct our borrowing rates on back of 2 re-ratings that we have done. We are now A with the positive rating. So we see a positive impact on net retained margin on PAT. So that really is the commentary on how I see the next 3 quarters.
All right, that's a clear picture. Thank you so much, Alok, for joining in today and telling us what the plans are going forward and what will be the growth levers for the company as well. Time for a short break now. We'll get you more on the markets on the other side of this short break. Stay tuned.
Welcome back. Interestingly, today's intraday high for the Nifty is 24,902. So we crossed yesterday's high and we crossed Monday's high as well. But as has been the case over the last few sessions, the index has failed to hold on to elevated levels. It will be interesting to see if the second half brings about a bit of a turnaround in today's trade. But of course, there are a lot of movers though. 5-star Business Finance recovered from the lows yesterday, but it's still down almost 4% in today's trading session. Zen Technologies is locked in yet another lower circuit today. So not good going down for Zen Technologies, seeing some profit booking from elevated levels. CRM Silk Mills is down 5% as well, as is Shankara Building Products. There are some names that are bucking the trend as well. We've spoken a lot about the losers. Take a look at Bliss GVS Pharma. That stock is up 16%, is the top gainer on the BSE Small Cap Index today at the highest point of the day. And just as we speak, earnings have started to trickle in for the day. You have Nesco's numbers flashing at the bottom of your screen, a 37% jump in its revenue, a 28% jump in its EBITDA, and take a look at the spike that the stock has seen, 6.5%.
We keep seeing those boards outside Nesco, right? This exhibition, that exhibition. So I think that is something which can be seen in the numbers.
If you visit Nesco now, the amount of eateries that have come up in Nesco is unbelievable. The number of eateries that have come up there, and more are coming up as well. So the number showing in the numbers as well for Nesco, sharp surge in revenue as well as its EBITDA, and 6.5% higher on that stock as well. Take your leave on this edition of Trading Hour from Sonal and me. Thank you for watching. Halftime report on the other side.
Stocks seesaw between gains and losses after Trump hints at imposing tariffs of 20 to 25% on India. Industrials, IT and Pharma see small gains, while auto drags.
L&T reports an order book of over 6 trillion rupees at the end of the first quarter. Strong revenue and profit growth though margins don't see any notable improvement. The stock, however, climbs the top Nifty gainer today.
Tata Motors is expected to buy a 27% stake in Italian CV maker Iveco from the Agnelli family in what promises to be a big acquisition for the group after several years of consolidation. The stock slips on the M&A risk.
India's second depository in the two-player segment, NSDL, has today launched its IPO to raise around 4,000 crore rupees via sale of share by existing investors, including IDBI and NSE. The pricing at a discount to the peer CDSL is reflective of its financial metrics.
You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Ekta Batra as well as Vinny Motiwala. Well, the market's moving between red and green just the way Vinny and Ekta are right now, but more on Vinny's side than Ekta's. The 50 points higher on the Nifty, 0.25% higher. But a bunch of earnings on our radar right now. Let's talk about Asian Paints. Met expectations. The street is believing that maybe the worst is behind. The management speaks about demand improving. In fact, I caught up with Amit Singhal, who's the MD and CEO, to discuss the quarter gone by and, most importantly, the demand trends going forward. Hear him out.
I think the quarter has been definitely much better in terms of looking at the overall demand conditions. As we have seen, I think April and May panned out much better than June. June was a hit bit because of a little bit of the early monsoons which set in. But overall, we felt that the quarter was much better in terms of demand as we have seen from the previous quarters. We saw a good tick in the urban and the rural centers as well. To that extent, I think there are some shoots of recovery which we are able to see in the urban centers as we go ahead, and we only hope that this would kind of remain. I think the monsoons have been very, very stable, and I think that's also kind of cheered up the rural demand in terms of what they anticipate in terms of something which is going to be stable overall to that extent. I think industrial, institutional demands have been much better than retail in terms of what we have been seeing. So overall, I think all round, from a relative comparison, the demand conditions have been much better, leading to a much better volume growth in terms of what we've been able to deliver this quarter.
You've called out high single-digit volume growth and value growth for this year as targets. Can you explain this a little to me in more specificity? The reason why I ask you is because, you know, there is a negative price mix of roughly 5%. So if you're growing volumes at high single-digit, should we assume revenue this year will grow only mid-single-digit?
So overall, if you see, I think the industry has not grown last year as well. So I think the overall industry is operating on relatively lower basis to that extent. But despite that, given the fact that the uptick in the demand doesn't seem to be like a surge, it is something which is just coming up to that extent. I think we are obviously seeing it from a little bit of a cautious lens in terms of going forward. So as we go forward, we still expect that the industrial, the institutional, which is the B2B business, will do definitely much better than the retail. And given that anticipation, we feel that possibly the value growth in terms of would lie at a mid-digit level in terms of going forward.
Got it. Value growth at mid-single digit, volume growth at high single digit. What about margins? You've maintained that 18 to 20% band, but the way things are, it appears that it's difficult to get to 20% in the immediate term. So should the street work more with 18% than 20%? Or do you think 20% towards the second half of this year is possible?
See, if you look at the consolidated level, we have delivered about 18.2% this quarter, which is sequentially higher than what we delivered last quarter. On a standalone level, the PBDIT margins are closer to about 19.4 in terms of what we are seeing, which is again much better than the sequential quarter in terms of what we look at to that extent. I think one of the big focus at Asian Paints has been that we've always looked at cost excellence. We have looked at possibly seeing that how we are able to look at going forward a sustainable growth, which basically has the margins intact in terms of the way we go. But I think there are all engines firing in terms of looking at that we would like to have a good growth going forward to that extent. And therefore, I think it is quite okay to kind of maintain that margin brand of 18 to 20 in terms of what we have taken to that extent. And I think we are putting a lot of measures in terms of differentiated strategies, brand saliency, and so on and so forth, which could kind of really look at giving us a little bit of a sustainable top line and looking at a decent band of margins in terms of what we're aiming at.
Do you believe the worst of market share loss is behind you, and from here on you'll at least hold on to your current market share, if not lose further?
Definitely, that's the intention in terms of going forward. I think all energies, all strategies in terms of what we are putting into the market are geared towards that. We have seen a surge in terms of the brand saliency. In terms of going forward, our share of voice has gone up in the market in terms of how we are looking at. Our approach has been always consumer-led and looking at something which is differentiated, something which is innovative in terms of what comes in the market. And given this intention, we feel that our various initiatives, whether from a point of view of institutional, whether retail, or even the surge in industrial in terms of what we are seeing, all of them should kind of augur well in terms of this environment as we go forward.
We've spoken about the earlier competition many times before, but this time around, JSW has gone ahead and acquired AkzoNobel as well. Do you think anything will change? Because you know both the companies, they've been around for a while. Do you think together they could be a different animal than what they were individually?
I don't think so really, because I think today there is an acquisition which has happened. I think as the acquisition happens, it goes through the entire area of consolidation, how they look at their brands kind of consolidating in the market overall to that extent. One thing which might change is that the whole area of the, the institutional and the industrial would get a little bit more competitive in terms of what we would see, given the fact that Akzo had some strengths in that area as we have kind of looked at earlier. But overall from the market, I think it's just a consolidation which is happening. It's 1 + 1 becoming 2 and not 1 + 1 becoming 4.
Okay, let's talk about the other one then, because, they believe that you have done some uncompetitive practices. They've approached the Competition Commission of India as well. You on your part have also, made your statements. Where do you stand on that?
See, overall in the market, we've had earlier complaints also 3 years back, and we came out unscathed out of that, given the fact that Asian Paints is definitely a far law-abiding organization. We believe in terms of looking at working with ethics and values in the market, partnering the stakeholders very strongly in where we go. We have a very clear code of conduct in terms of the way we work, a clear competitive policy in terms of the way we progress ourselves in terms of going. So we are very clear that for us it is business as usual in terms of what we are doing. These things will happen in the market to that extent, could be also reactions of what possibly the challenges some of the new competition is facing in terms of going ahead. But as we go ahead, we have really said that we will comply with the legal processes in terms of going forward and see in terms of saying that our conduct in the market is something which is above board.
So you believe that just like the earlier times when you were unscathed, this time around as well, there should not be a big problem?
I think the proof lies in our working. The proof lies in terms of the way we kind of conduct ourselves, and that is what the market trusts, and that is we believe firmly in terms of taking that route.
All right, and final question before we let you go. What explains this persistent, focus on home improvement? Because it's been many, many quarters where the revenue contribution hasn't been as much. From a stock market standpoint, the valuation contribution hasn't been as much as well. In fact, some of the acquisitions that you've made, you've had to write down value on that as well. Yeah. What explains you still sticking around with that? Because, more than the numbers, it's just the management bandwidth becomes a bit, challenging here.
No, I think one of the big areas why we are pursuing this is the fact that, given the fact that we appropriate home as a strategy very, very strongly, and we believe clearly that, the corporate positioning of Har Ghar is definitely centered around home, and therefore we are appropriating home decor in a very strong way, because going forward, we feel that that is one area which really keeps the brand separated from the rest, who are possibly operating in the same band, which is only about functional products to that extent. I think the whole area of emotional in the home is something which is very, very important to that. And that is the whole strategy in terms of bringing home decor in, because we are saying that we are moving from a strategy of share of surface to share of space within the homes to that extent. Yes, I think the last quarters have been not very, very good. But to that extent, we are trying to look at some consolidation. We are looking at in terms of some targeted approach which are there, because the segments which we are there, I think are very, very important to us from a point of view of whether it is kitchen, whether it is from a point of view of lighting and the point of furnishings and so on and so forth to that extent. I think we are not giving in so early in terms of just going for it, but I think there is a separate vertical which works, which doesn't really interfere with the core vertical. So I don't think so it is something which is taking toll with respect to the management bandwidth to that extent. It is something which we are really putting like a startup within to that extent in terms of how we are going. And we are kind of confident that as we go ahead, we will turn around the business in some time as we go ahead.
So then let me flip this around and ask you a final question. Do you have big internal targets here? If you could reiterate that for us. And if you are so bullish on this, then maybe take a few more bolder bets instead of just these, smaller bolt-on acquisitions, etc. If you, believe that there is growth here.
See, I think the current environment, you have to kind of go along in terms of the way the current environment is. I think the overall demand conditions for the entire industry, whether it is overall the consumer durable industry, the FMCGs industry, we are not saying that it is so bullish in terms of the way it is going. I think there will be a time in terms of where we would like to take a punt in terms of going forward. But I think it has to be the right environment, the right demand conditions in terms of what we need to kind of do. So I think we would possibly do a calibrated kind of work in terms of taking this category ahead and not really jump into it at a time which might not be very opportune.
All right, we take that point. That's the management of Asian Paints speaking about good demand conditions right now. More importantly, they may make a few bold bets in the home improvement space going forward, but waiting for the right environment. Stock holding up, but the stock of the last few minutes has definitely been Avenue Supermarts or D-Mart, because the analyst meet is currently underway. And the key takeaway from all the analysts that are there is that the company has been talking up store expansion. And remember, one of the quibbles that the analyst had was that the stock company hasn't been expanding stores at a pace as brisk as the street was expecting them to. And now that they're talking about doubling down their efforts on store expansion, the street likes it. Remember, it's a stock which has limited float. So as a result of which, and it's underperformed as well. So any move on any side is usually exaggerated on Avenue Supermarts. But the fact that managements get a little excited about store expansion has the street fairly excited, and the stock up 5%.
Okay, all right, Mangalam, thanks for that. So that's Avenue Supermarts. That stock is up around 5-odd%. Remember that they did announce a store opening just yesterday in Punjab, and they have a total of around 426 stores opened at this point in time. That's Avenue, up around 5-odd%. For the markets at this point in time, it's still quiet, very range bound. No definitive reaction or direction at this point in time either way. We'll take a short break, but a reminder for our viewers as we do that: unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty managing to hold on to 24,850 levels. Obviously, had a lot of listings that happened today as well. We had IndiCube, a muted listing that's come in there. On the other hand, GNG Electronics, that's the one which saw a good listing. More than 40-50% as of now is what the gains is what it's holding on to as well. But talking about IPOs, we do have Blackstone as well as Sattva Developer sponsored Knowledge Realty Trust, which is going to be coming out with a 4,800 crore IPO, opening on the 5th of August with an offer size of 4,800 crores. Like I mentioned, this is going to be to discuss in terms of the IPO offering, the business outlook. My colleague Reema caught up with Vijay Agarwal, Managing Director at Sattva Group, Ashish Mohta, who's the head of real estate acquisition India at Blackstone, as well as Shirish Godbole, Chief Executive Officer at Knowledge Realty Trust, to talk about the outlook for the company. What are we expecting there? Listen in to an excerpt of that conversation.
So largest is the right word. Arima, we are 62,000 crores gross asset value. We are 46 million square feet, 3,500 crores of NOI. A very large and diversified tenant base across the best markets in India, Mumbai, Hyderabad, and Bangalore. So that's, in my mind, you sort of dovetail that with what's happening in the office markets today. You've seen the best absorption. We have the highest portfolio occupancy amongst every other REIT. We just think this is the right set of attributes that brings KRT together.
Shirish, let's get to the numbers then. Right? In your RHP, you're projecting about a 12.5% increase in the net operating income from FY25 to FY29. Take us through the math and the assumption.
So we are projecting a 13% CAGR, as we call it, as compounded annual growth rate of each year for the next 4 years. And 60% of that, 13%, 60% of that is actually through contracted transactions. So these are leases in place or new leases we're signing or expansions we're signing. So the good news is most of that growth is built in. The remaining 40% is through either leasing up some of the vacant space we have 91% occupancy, as you said, as well as a mark-to-market potential. Another beauty, as Ashish was pointing out, but the attractive part of our portfolio is that number of our leases are below market rents, and we have a potential to raise those rents 23%. So that, along with the lease up, makes up the remaining 40%. 60% is contracted revenue. And so that's the 13% growth compounded annual each year.
And what is the kind of dividend investors should expect?
So we have a stabilized yield that we are going to provide to our investors, beginning with 7.2%. It grows quickly thanks to this compounded growth. It grows quickly to 7.7 the following year, and then 8.2, and so on. So we have a very good dividend distribution strategy as we go forward. Plus, there should be some more capital appreciation. And therefore, a total return in the mid-teens is what we hope we can provide to our investors.
And this 7 to 8% yield, how would it compare with the other REITs?
So, today, it's obviously a moving target, the market's trading, but Embassy, which would be one of our competitors, Mindspace, are both trading at a sub 7%. In fact, Mindspace is a sub 6% yield. So we think our 7.2% is a very attractive yield as we provide it to our shareholders.
The other thing, Reema, just on the dividend yield part, I think that's pretty relevant across REITs, is that it has the most tax efficient distribution structure. So when you talk about the dividend yield, call it broadly about over the next 3 years, you're looking at about a 7.5% yield. Post tax would be close to about 7-ish. Okay. Right? So the leakage is very little. You compare that to an alternative fixed deposit investment, T-bills, you lose almost 30%. Sure. Right? So the leakage and therefore the post-tax dividend yield to the investor is the most efficient. And I think that's the biggest selling point here from an investor perspective.
Now, I can see that some of your tenants are global giants. You've got Apple, Cisco, Amazon. You've got large domestic front offices at the Birla Group. So explain to us the difference between KRT and the others in terms of your tenants, in terms of the lease structure, in terms of the location.
Very small percentage of our tenants are actually from the ITES industry. And that's the big differentiator with us. Our top tenants are all global capability centers and not ITES
Can you give numbers?
So that's a big difference. So, 29% of our total space is occupied by the top 10 tenants. And if you take that in comparison to some of the other competitors, the IT/ITES number is a lot higher than what we have, which is none. So in our top 10, 0% is from IT/ITES. They're all global capability centers or front office space as we have in Mumbai, but none of them are IT/ITES. And that's a big differentiator
And
versus the
GCC
others.
would contribute how much?
So GCCs as a whole contribute about 45%. But in the top 10, I would say it's a big 75% of our top 10 are GCC.
Mr. Agarwal, now you're a veteran in the real estate industry. You've got, I think, 80 million square feet. Now, India's office and residential strength, especially in cities like Bengaluru, has been underpinned by the Indian IT industry. Now there is fear that with job losses picking up in the tech sector, and who knows, tomorrow even GCCs could lay off because of AII. Do you think there is a risk to India's real estate market as a whole?
Rima, that Indian real estate has been not only on IT and ITES, it has been, as Siris has mentioned that one, it has been all the sectors are growing in India very well, because you name the pharma, consultancy and your GCCs, your education sector, every sectors are in growing path. Our India story has been last 10 years and the next couple of decades will be very, very progressive. Not only the office space, residential space is also has been going in a big way. So we don't see any problem. As Siris has mentioned, our exposure in IT, ITES has been very minimum. Other sectors, GCC, consultancy, pharma, financial sectors, all are been much bigger, these things. So we don't see any risk in that.
Ashish, 46 million square feet right now in terms of an office space. What's the pipeline looking like?
Look, I think a couple of things. One, most of our assets that were high quality and readable are part of this portfolio today, right? And that's the same for Mr. Agarwal as well. I think all of the Satwa assets that could have been rated today are in this portfolio. Alongside that, there are a bunch of ROFO assets. That's something that's been identified on the Satwa side. Additionally, I would say that I think what we've seen in Nexus, right, is been the fact that with a brand neutral platform, you have the ability to add more assets from developers who don't have the scale necessarily to do their own REIT, right? And I think that's what we want to sort of position KRT for. If you look at debt levels today, we are at about 19%
This is
LTV.
post the debt reduction.
Post the investment.
And 19% of your gross asset value.
That's correct, right? So it is one of the lowest LTVs out there, which gives you a lot of headroom to acquire assets without diluting. But I think 46 million square feet can easily become 90 million square feet over the next 5 to 10 years.
Okay, so that's Knowledge Realty, 4,800 crore IPO hitting the market soon. Just want to point out for the markets, well, it is range bound. Just want to point out one particular stock which is in focus today. That's Dr. Reddy's, which should come up for you. It's recovered from the day's low, but nonetheless, it is in focus because Novo Nordisk, which is the Danish pharma company, which is basically the innovator of Ozempic as well as Wegovy, those blockbuster weight loss drugs, has in fact cut its guidance. So they're not expecting as much growth as anticipated earlier. What they are saying is that they are now expecting 2025 sales growth to be anywhere between 8 to 14% versus 13 to 21% previously. And that's because of the slowing sales in Ozempic and Wegovy. Now remember that why does Dr. Reddy get impacted is because they will soon be entering the market on a generic basis. So, and along with many other companies such as, the other generic filers, but nonetheless, Dr. Reddy's is expected to be a front runner for this. So that's the reason why you're probably seeing the stock down around 0.8%. We'll take a short break, but remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset at 1 p.m. for the Big C and Global Lens at 8:30 p.m.
But it's a good up move that we've seen on the markets. The Nifty closing in on that, 24,900 mark. Does it cross past and stay above that or not? What are the options data indicating? Let's go across to Nigel, who's joining in with all things F&O at midday. Nigel.
Well, that's right, Mangalam. It's good to see some green on the screen. I thought I'll be the lone person who'll be wearing green today, but at least we have some green on the screen, both on the Nifty as well as on the broader markets. And at the start of today, I was mentioning that the rollovers are yet to pick up, both the Nifty as well as the Nifty Bank. Rollovers on a D-2 or 2 days before expiry was relatively lower, but that's gradually picking up now. So that's a factor that you should be tracking as well, because still yesterday it was relatively lower. The India VIX, it's cooling off, and this series hasn't been a great one for the bulls. But the good news is the volatility index or the fear index hasn't really spiked up, and that continues to remain subdued, sub that 12-odd mark. The PCR, we had mentioned 2 sessions ago, at around 0.64, it's in an oversold zone. And, yesterday, once we went around 24,600 odd, from there we have seen a bit of a bounce. And the PCR has moved from around 0.64, it's moved to around 0.83 the last time I checked. Because, we are seeing put writing that's come back into play. Some of those call writers as well, they are moving out. And that's why you're seeing the PCR has bounced up. Now, a couple of levels that we're going to be tracking, going by the options data. 24,900 call, that's fairly active in today's trading session, and the premium has moved up marginally. From around 53 rupees, it's moved to around 62 rupees. So out there, there could be some writing as well, given that you have expiry that will play out tomorrow. On the downside, the 24,850 put, well, that's added a good amount of open interest out there. And the premium from around 85 rupees, that's come down to around 50 rupees. So there is some writing out there, and the put writers, they are in the money right now because they're eating into that premium. Now, looking at the levels, just tying in the levels with the options data, the crucial level to track for today is 24,950, going by the action we're seeing at the 24,900 call. So that's important. And the day's low also is going to be important, which is at around 24,772. And that perfectly ties in with the writing that we're seeing at around the 24,800 put. So those are the 2 crucial marks that you'll be looking at for today. If the Nifty can somehow get past the 24,975 odd, you'll be feeling more confident. And the first reference point on the downside, as I said, is around 24,770 odd. The crucial factor to track is going to be both the big boys of the Nifty. The Nifty Bank, till the last time I checked, it was still doing a relative underperformance. It needs to get past the 50 DMA, move towards the 20 DMA, because that's been the one that's been in good form actually in comparison to the Nifty, and it's lost its way in the last couple of days. So that's important. And the other one is Reliance Industries. Today as well, it's more or less flattish, but yesterday it bounced up close to around 2%. It needs to get closer to around that 1480 odd mark where you have the 20 as well as the 50 DMA. So both these two hold the key. For the time being, a bit of a bounce. Follow through is something that the bulls will be looking forward to, because tonight we'll be hearing from the Fed, and any kind of optimism, any kind of dovish signal will be good from a bullish perspective. Back to you guys.
Absolutely, Nigel. Thank you so much for that. Follow through is what everyone will be watching out for now. But a lot of stocks that are buzzing in trade as well. Now, obviously, Avenue Supermart, we just spoke a short while ago, 3% up in the last 30 minutes is what we've seen coming in. But Vivek is here to tell us which are the other stocks buzzing in trade and why.
Thank you so much for that. Again, most of the stocks today that we're highlighting moving largely on the back of results reactions. What is it that the street is cheering, or in certain cases not liking as far as the results were concerned. First stock on the list has to be the top Nifty gainer, the capital good infra space, major L&T doing very well as far as results were concerned. Order inflows extremely strong, much above what the street was anticipating. On the back of that, stock higher by 4.5%. This is on top of the 2% up move that we saw in yesterday's slightly muted market. On the other hand, another stock, from this particular space itself, GE Vernova and TED, perched at the upper circuit, a very strong beat to what the analysts were penciling in. Order inflow very strong, showing robust visibility in the coming quarters. The other stock on the radar is one from the Pharma pack, Jubilant Pharmova. Yesterday there was a one-off in the result. On the back of that, you did see profits actually dip, but the company in the call has said that the CDMO side of the business is scaling up. Stock higher by over 6% today. Bank of India, earlier today we had the management on our channel. They have told us that the NIMs or the net interest margins have bottomed out as far as Q1 was concerned, and they see an upward trajectory from this time onwards. They also see close to 9,500 crore of gross recovery in the coming quarters. Stock higher by almost 3% today. And Coromandel International, good set of numbers, been a couple of days, but today one of the top gainers as far as the NSE 500 was concerned. On the other hand, quite a few laggards as well. Top amongst them being Tata Motors. The street is actually eyeing a very large acquisition announcement to be made soon from this particular name. A large European company is what the Tata Motors said to be eyeing. Street a little wary on this large buyout. Info Edge, a very large or a significant downgrade coming in. BofA Securities has double downgraded this particular stock. Stock lower by almost 2% today. Hindustan Unilever, while you just mentioned DMart, one of the top gainers, this particular stock, Hindustan Unilever, one of the top drags as far as the FMCG pack is concerned. And Five-Star Finance, this particular stock continues to see significant selling pressure. Remember, the results were very weak where asset quality deteriorated quite significantly.
All right, Vivek, thanks a lot for that. So those are a bunch of stocks which were buzzing around. What we'll do is take a short break, take a break from the equity market itself, come back on the other side. Manisha Gupta joins in with all things commodities. Kunal Shah of Nirmal Bang with her.
Welcome back, and Kunal Shah heads commodities and currencies at Nirmal Bang, and he joins us live on the show right now. Kunal, hi, thank you for joining in. And it's about the crude oil prices because we are up by 6% in the past 1 week. We're inching very close to that $73 per barrel mark. From where we stand and the way factors and fundamentals and events are unfolding, do you see further gains?
I think it's more to do with Donald Trump indicating that they have given 10 days window to Russia to make a deal on Ukraine. And if that doesn't take place, India and China, if they continue to buy oil from Russia, they'll be having additional sanction and additional tariff. So I think this is something, which is driving oil prices. We've seen the numbers where we've seen in last 1 month, Saudi Arabia have bought oil from Russia. These are the key indication, if this actually materializes. I think it's more to do with the fear-driven rally in oil prices rather than actual fundamentals. People are worried whether US imposes another round of sanctions on Russia. That time will tell, but I think market is discounting that. So there's a possibility in this kind of scenario where Brent can hit $75 and WTI can test $72. So for the time being, we have to remain on the long side. and expect that market will build this kind of geopolitical premium in prices of oil. So near-term trend continues to remain positive. If the Russian crisis gets resolved, US, whatever pressure they are applying, if you see ceasefire announced by Russia as far as Ukraine is concerned, then suddenly you will see a fall. But till then, the prices will remain at elevated levels.
Kunal, since you follow currencies very, very closely, that's a flash running in on the bottom of our screen, which says that 0.5% of a decline in the Indian rupee, that's the lowest point in the day. And correct me if I'm wrong, but 85.20 is the high that we saw for the currency. And from there, we're trading at around 87.34 on the screens. Where do we go from here?
I think it's just a matter of time where, see, the fundamental trend of the US dollar is definitely on the downside. You've seen the big, beautiful bill is going to contribute to another $3.5 trillion of debt to the US. So the dollar index is going to, come down very sharply. And hence, I believe that whatever short-term depreciation in the USD-INR pair is going to be very short-lived. So maximum another 30, 40 paisa or maximum 50 paisa weakness from here. But from then onwards, rupee should again gradually strengthen and come back to levels of 85 and then 83 and kind of that. So I'm optimistic about the outlook on Indian rupee, and the short-term aberrations will be short-lived.
All right. Kunal, when you say 85 and an 83 as a possibility as well, are you willing to give a timeline for that?
I think looking at the way the things have shaped up in next 6 months, I'm expecting at least 150 basis point of rate cut from the US. And considering that the possibility of 83, 84 in next 6 months to 8 months is very high. So I'm pretty optimistic about the outlook of Indian USD-INR pair.
Talk to us also about gold and silver prices, because we are looking at lower lows onto this one. July really hasn't done much when it comes to precious metal as a space.
I think it's going to get interesting. So after the rally till the month of April, the prices have consolidated in the month of May, June, July. Okay, we've seen a good consolidation taking place where the upside was capped. $3,450, $3,500 is where the upside was capped as far as gold is concerned. And on the downside, we are not able to see gold going below $3,300. So we are seeing gold trading in a range of $200, $250. I think now the major focus will be shifted on the Fed commentary today. Whether Mr. Powell is going to be dovish or not, that's one of the most important catalyst or the drivers for the price of gold going forward. We expect going forward some dovish stance from Fed may be adopted, because whatever tariff-related inflation we are going to witness, that is going to be a one-time. So let us say if there is a, on an average, 20% hike in the inflation, okay? So if that is the case, then the hike in inflation will be just momentary. So 20% impact on inflation because of the tariff, that is not going to be forever. So I think the dovish stance can be seen by the Fed going forward. Today's commentary, I'm expecting Fed to remain more dovish, and that can be positive for gold and silver both. So I'm expecting gold and silver prices to rally post today's FOMC meeting. And I'm not very bullish, but 34.50, those kind of levels for spot gold can be witnessed in days to come. So I think today the possibility of gold and silver moving up is very high. Silver fundamental itself are very bullish. So silver is going to head towards $40 and gold 34.50.
Okay, key will be to watch out for the commentary that will be coming in from the Fed this evening as well. Thank you so much, Kunal, for joining us, as well as Manisha for joining us for this interesting chat as well. But on that note, we're going to slip into a very short break, and we will connect with the management of Gateway Industry Parks after this break. Stay tuned for that.
Welcome back. A stock that has been buzzing around all through the morning and this day so far is Gateway Distriparks, up around 10% after reporting a good set of numbers in the first quarter. Consolidated numbers, obviously, further aided by Snowman's merger. Let's talk about the overall performance of the company going forward. Samvid Gupta, who's the Joint Managing Director, joins in now. Samvid, good afternoon. Good numbers coming in. Let's get out the basics first. What was the EBITDA per TEU for your rail and CFS business in the first quarter? What's the target that you have for this year on EBITDA per TEU and volumes for both your rail and CFS business?
Yeah, hi, good afternoon. Thank you for having me on the show. So the rail EBITDA per TEU was about 9,100 for the quarter. CFS was at 1,500. So there was a slight decrease in the rail because of lower double stacking as well as lack of exports. So there was some imbalance and increased empty running. CFS improved after a few quarters. It's come and crossed 1,500 again. So the target is that within the next couple of quarters, we should get back on the rail side to 9,500 per TEU, and CFS should hover around 1,400 to 1,500. On the volume side, we are looking at a double-digit growth for the rail side. CFS also has seen some improvement in volumes, and that should continue about the 5-6% mark.
Okay. Samvid, hi. Welcome to the show. Just wanted to understand that what was your double stacking this quarter itself, and what are you targeting in FY26?
So it was 39% this quarter. Year on year, it was about 32% Q1 last year. So we've seen a big improvement there. But still, our target is closer to the 43-44% figure, which is achievable. But in Q1, there were some restrictions, especially towards Mundra Port. So we saw higher single stacking going on. But within the next couple of quarters, we will see improvement on that.
Okay. Samant, good afternoon. You just highlighted a volume number. I just want to clarify again. Volumes for CFS, you said, would be in the 5 to 6% range, right? Because earlier you were expecting 2 to 3%. So 5 to 6% is what we are watching out for in FY26?
Yes, that's correct.
Okay. And also in terms of current utilizations, what is that across streams? You have around 5 ICDs, 5 CFS as well, and you're planning 2 more locations, new locations as well. What is the outlook there?
So on the ICD side, we buy land way ahead of its time. So our capacity utilization on the developed side would be about 60-70%. As we get closer to about 70-80%, we develop some more of the land, and it's basically paving of container yard or maybe adding some more equipment so that we have enough leeway to whenever the volumes come in that we can handle it. So that's on the land side. On the rail side, we have enough capacity to handle about 40,000 TEUs per month. Currently, which we're doing about 33,000 to 35,000 in some months at its peak. So both ways we have enough capacity before we decide to expand more.
All right. And are you still interested in selling the CFS business? Because I remember you all were looking to focus only on the ICD business. And if there was a buyer for the CFS business, you all would be happy offloaders.
Yeah, it depends on the valuation. We had some offers, but they weren't up to the mark. So only if the right offer comes in, we'll look at selling the CFS business.
What, according to you, is a right offer? I mean, if you could give us a rough ballpark basis, the business that you do and, peers are valued at a certain price. So what would be an attractive enough offer for you?
So it's not just a valuation of a multiple of EBITDA. There is a real estate value. There is a premium for giving 4 or 5 locations together. So we don't have an exact figure in mind, but in the past we've mentioned closer to 4 digits at least.
Okay, closer to 4 digits is what you'd look at. Quickly, before we wrap up the conversation, any further stake addition in Snowman that you would be looking at? It currently stands at around 50-odd%.
So that was our initial target. We're not against the idea, but we at the same time don't have any immediate plans to increase the stake as well.
And the dedicated freight corridor, is that on cards earlier than expected?
Maybe in Q4 is what we're expecting. The target right now is December 31st, but I think based on ground level, what we've heard, it might spill over to February or March.
And you've maintained market share or gained market share in some of the ICDs that you operate in right now?
Sorry, the voice got cut a bit. I couldn't.
So your market share, you've gained or maintained?
We've maintained. NCR has been stable at about 17%. We've gained in the Uttarakhand belt, but the macro market has not grown as much, but we've increased our market share there.
Okay, you've increased your market share there. And overall, in terms of margins also, what are we watching out for FY26?
Same about 9,500 for the rail vertical EBITDA per TU and 1,500 for the CFS vertical. So it gives
Okay.
rough margin of 25%.
Okay, 25% rough margin is what we're watching out for. Okay, Samvid, thank you so much for joining us on the show. That was the management of Gateway Distriparks. But on that note, we're going to sip into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Watching us here on Halftime Report, the stock of our last hour or so has been Avenue Supermarts, up nearly 6%. The management in the conference call has said that they are likely to improve or increase store footprint by 10 to 15% every year, expanding their store acceleration, particularly in North India, a sign of things to come when they had opened their first store in UP Major earlier itself. And Navil Larona, who is likely to step down as MD CEO, make way for Anshul Asawa, will particularly handle North India real estate expansion over the next few months. That has the street excited. And finally, they will double down on investment on store expansion, considering what is happening across, including that in Q-commerce. The street likes it, the stock higher, management fairly aggressive. Good growth coming in for Griefs Cotton at the bottom of your screen as well. 50% revenue growth, or rather 50% EBITDA growth. That stock too, up around 6.5%, a big spike post their numbers. We leave you on this edition of Halftime Report. Stay with us on CNBC-TV18. Business Lunch comes up next.
The markets trade higher in a narrow range. US President Trump hints at imposing tariffs of 20 to 25% on India. Infra, banks and metal stocks see gains, while realty and auto are the big drags.
L&T reports an order book of over $6 trillion at the end of Q1, and revenue and profit growth, though margins don't see any notable improvement, the stock climbs.
Tata Motors is expected to buy a 27% stake in Italian CV maker Iveco from the Agnelli family in what promises to be a big acquisition for the group. After several years of consolidation, the stock slips on the M&A risk.
India's second depository in the two-player segment, NSDL, has today launched its IPO to raise 4,011 crores via sale of shares by existing investors, including IDBI and NSE. The pricing at a discount to peer CDSL is reflective of its financial metrics. Hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Thoria. And joining me is Hormas Fatakia. Good afternoon to you, Hormas. So far, it's seeming like a good day for trade. The bulls are fighting back hard, and we might be, on course for maybe ending the second straight day in the green.
The bulls would definitely be hoping so for that. And as long as you are in the green, the bulls would not have any reason to complain, despite the fact that we are still struggling to cross that 24,900 mark on the upside. But there are enough and more movers. But since you were on the subject of IPOs, the two major ones that have opened for subscription today, NSDL being the first one and Sri Lotus Developers being the other one. We just heard from Sri Lotus a few hours ago. The Sri Lotus IPO, as we speak, has been fully subscribed within 3 hours of the first day of bidding. And NSDL is almost there too. 97% subscription so far for NSDL as well. So the IPO market remaining healthy. The markets on our own, the equity markets, continue to consolidate. But of course, there are plenty of stock-specific movers, Vamakshi. We're counting down to some big earnings today as well. Tomorrow promises to be an even bigger day, not just for us, but also for the global markets as well.
Tomorrow, especially for Sudarshan, right? A lot of auto companies reporting their numbers. Indeed. And in fact, just speaking about IPOs, look at the listing that happened today. We did see two companies have had stellar listings in today's trading session. They will also come up for you on the screens, and you'll just see how remarkable the IPO market has been. GNG Electronics is up almost 42%, and IndiCube Spaces is down almost 11%. When we talk about result reactions, we've seen a stellar set of numbers that have come through, especially from Bliss GVS Pharma. That stock for now is up almost 17%. New India Assurance is another counter that is doing exceptionally well. GE Vernova is one other counter, reported its numbers last evening. Almost it's a beat as far as expectations are concerned, and the stock has been locked in the upper circuit of 5% since the get-go. But moving on then, another company that reported strong set of numbers is L&T. Net profit surged almost 30% to 3,617 crore rupees on strong revenue growth, which were higher than what the market was expecting. We now have Vivek joining us with the earnings fine print. Vivek?
Well, Larsen & Toubro, capital good infra, giant has actually gone ahead and surpassed what the street was anticipating, especially in terms of execution as well as the order inflows. And that's a very healthy start to the year as far as L&T is concerned. So robust order inflows, very strong execution. Consolidated order book now has crossed 6 lakh crore as far as L&T is concerned. Looking at the numbers themselves, revenues higher by 15.5%, EBITDA higher by 12.5%, margins the only blip in the overall picture at 9.9%, profitability higher by almost 30%. Now, when you're talking about the core EBITDA margin, remember the company had given a guidance in the range of 8.3 to 8.5. However, that came in at close to 7.6%. But the management has not changed the guidance, indicating that Q2 as well as H2 is expected to be much higher in terms of the core margin improvement that is expected to be seen. The order inflow was at 77,000 crore rupees in Q1, a 41% uptick on a year-on-year basis. Remember, the company has given an order inflow guidance uptick of just 10% for FY26, and analysts believe that there could be a slight uptick in the guidance in the coming quarters. Now, the other couple of important things, order prospect pipeline at 14.8 trillion rupees for the remainder of the year. And more importantly, remember, there have been reports indicating that the company is looking to divest one of its power assets, that is Nabapa. The company yesterday informed us that given the right price, they were not averse to selling this particular asset.
Indeed, L&T, the outperformer of the day, 5% higher now on the stock, the top gainer on the Nifty in today's session, and what has been a very strong start to FY26. But moving on to some other stocks that are on the move, while L&T is the top gainer, Tata Motors is on the other side of the spectrum, is the top loser today, and talks have emerged on potential acquisition between Tata Motors and Iveco. Parikshit is joining in with more details on this. Parikshit, tell us, what does this news entail? It promises to be the first major acquisition by the Tata Group after almost a decade now.
Yes, and the acquisition is likely to be around $4.5 billion. That's what it's going to cost Tata Motors to acquire a majority, a controlling stake in European truck manufacturer Iveco. They will be buying a controlling stake from Italy's Agnelli family. That's what we're picking up. And there have been advanced talks over the last few weeks, and the Italian media is reporting that a final decision will be announced today by the boards of the two companies. What will this do for Tata Motors? Apart from a strong domestic market, this will give them access to Europe, North America and Latin America. 70% of Iveco's revenues come from Europe. So this will be a big gainer for Tata Motors, so to say. They will also get a manufacturing base in Europe. They would get access to future technologies. So in the long term, this could be a positive for Tata Motors. We believe that an announcement is imminent. The talks have been on, and this, of course, will be big for Tata Motors, especially the commercial vehicle business after the demerger.
Well, thanks so much for that, Parikshit. The shares of Tata Motors for now are down almost 3.2%, the top Nifty loser today. But moving on then, G&G Electronics had a very strong debut on the bourses, like I just pointed out a couple of minutes ago. Its shares listed at a 50% premium to its issue price, and post the listing, we spoke to Ajay Panchodi, who is the director at the firm, to understand their revenue mix and business outlook. Let's listen into that conversation.
Last year it was 75% international and India being 25%. We don't see a significant change going forward as well. We see that the absorption on both sides and overall markets on both sides will grow and lead to a continued proportion more or less similar. We will be debt free, and that gives us a huge opportunity.
From one listing to another, G&G listed at a very hefty premium, but IndiCube listed at a discount, and it was an issue price of 237, listed at 216, now at 210. So still some losses coming in comparison to the issue price. We spoke to Rishi Das, who's the chairman, executive director and CEO for the company, on the road ahead. Listen to what he had to say.
I will also like to emphasize that we have almost 33% of the space that we will be occupying over the next 6 to 18 months, and that portfolio should allow us to have a lot of headroom for growth. And overall, I think we should see great performance coming forward. Yeah. If one were to look at like year 23, we have paid income tax. Year 24, year 25, we have paid income tax. So we have been PAT positive all these years. Typically, so I think it's more, and like that's what as per our roadshows also we have tried to explain.
Staying on with the primary market action, we spoke of listings and over to IPOs now, and it is NSDL. The IPO has almost been fully subscribed now. 99% is where it stands. The nervous 90s is NSDL, Vamakshi. Tell us more about this issue, right? It's a direct comparison with CDSL on the financial front. And of course, it's a pure OFS, right? So how much are the existing shareholders making?
Well, absolutely not bad for day one, right? Day one of subscription for NSDL. NSDL is set to hit the markets. It's a 4,011 crore IPO, Hormaz, priced at 760 to 800 rupees per share. It's a pure offer for sale, meaning that no fresh funds will go to the company. Only existing shareholders will get the money. Now, at the upper price band, NSDL will command a market cap of around 16,000 crores with listings slated exclusively on the Bombay Stock Exchange. So let's decode the NSDL IPO. Now, NSDL was set up in 1996. It is India's very first securities depository and remains the largest. It oversees the highest number of issuers, active instruments, and total asset value under custody. Think of it as a bank but for securities, your stocks, bonds, mutual funds and more, all safely held in demat form. Now the business goes beyond the depository, and NSDL runs two wholly owned subsidiaries, NSDL Database Management, which delivers e-governance and tech solutions from SEC Online, insurance repository to digital onboarding, and NSDL Payments Bank, which offers digital banking, prepaid cards, merchant acquisition and third-party product distribution. But NSDL doesn't operate in isolation. It's locked in a duopoly with CDSL. The differentiator, NSDL leans on institutions and unlisted companies, while CDSL thrives on India's booming retail wave. The numbers also tell the story. In FY25, NSDL reported revenue of 1,420 crore, growing at 18% CAGR since FY23. Yet the margins lagged 26.4%, with profits at 343 crores and ROE of 17.1%. CDSL, on the other hand, with a smaller 1,082 crore revenue base, is growing faster, has delivered 527 crores in net profit with a margin of 57.7% and a stellar ROE of 29.9%. And the valuations actually reflect this trade-off. At 47 times FY25 earnings, NSDL comes at a nearly 24% discount to CDSL 61 times. So who's actually cashing in? Legacy investors. IDBI Bank alone will take home 1,778 crores, NSE 1,440 crores, SBI 320 crores, HDFC Bank 161 crore and Union Bank 40 crores. For some like IDBI and SBI, returns stretch up to almost 400 times. But don't mistake this for a total exit. Post-IPO, IDBI and NSE will each still hold around 15% stake, with SBI, HDFC Bank and Union Bank retaining meaningful stakes. So they're essentially booking gains, yet keeping skin firmly in the game. And to wrap it all up, NSDL is a story of steady growth, however, with leaner profitability, and that is reflected in its current valuation discount to CDSL. Hormaz.
Interesting developments there. Still at 99% is NSDL. So we'll of course keep you posted as to when. He's still looking for that elusive single, the field restrictions in place. So it will be interesting to see when the full subscription happens anytime from now. Of course, by the way, the Sri Lotus IPO though is fully subscribed. Take a short break. More on the other side. Stay tuned. Welcome back. Let us now bring you the latest update from the India-US trade talks, which seems to have hit a roadblock. President Donald Trump has said that India may be hit with a tariff rate of between 20 to 25%, but he also cautioned that the final levy has not been finalized yet ahead of the 1st of August deadline. Here's what he had to say.
India is preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be for India?
They are going to pay 25%.
Yeah, India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so. Look, they're my friends, and he's my friend.
Is the deal with India finalized?
No, it's not.
Okay, so what rate are you expecting?
Well, we're going to see. We're going to see. But India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and you just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
Well, that was the President of the United States talking about the trade deal that US could potentially have with India. But moving on to the Federal Reserve then, the 2-day Monetary Policy Committee meet ends today, and the Chairman Jerome Powell will announce the decision later tonight. CNBC's Steve Leisman joins us with the key expectations.
The Federal Reserve is expected to hold rates steady at its meeting this week en route to an expected September rate cut, and respondents to the CNBC Fed survey seeing a three-way tie in the race to replace Fed Chair Jay Powell. Here are the Fed expectations. 100% say no cut in July, but 27% think the Fed should cut. That reflects some agreement with the two Fed governors who many think might dissent at this meeting. 65% expecting the cut in September. The chance of recession falling to 31% from 38% in June and 53% in May, amid more clarity on the tariff impact, along with somewhat better GDP, now at 1.4%, up from 0.8% from the May low. Take a look now, the current rate outlook from the Fed, from respondents. 4.4 is the current, goes down by about 2 rate cuts in, this year, 2 more next year, showing the Fed is still remaining above the neutral 3.3% rate, even with a new Fed chair. But who that next Fed chair will be, well, that's anyone's guess. We have pretty much a three-way tie here. Kevin Warsh at 24%, Treasury Secretary Scott Bessent at 24%, Hassett at 22%, and then Fed Governor Waller at 14%. Bessent has said the president could pick a new Fed chair as soon as December. That would be just a couple months earlier than either former Fed chairs Bernanke or Yellen were nominated. The Powell's tenure or term ends in May.
Take a short break right here on Business Lunch. More news and updates continue on the other side.
Welcome back. You're watching Business Lunch on CNBC-TV18. Well, the IMF revises its global growth estimates for 2025 and 2026 higher than its April estimates on the back of lowering risks and hikes India's growth forecast for FY26 by 20 basis points, saying the external environment is more benign than earlier expected. My colleague Ritu brings us all the details. Ritu?
Well, India remains somewhat of a bright spot in an otherwise cooling global economy. According to the IMF's latest World Economic Outlook update, India's growth forecast holds steady at 6.4% for both FY26 and FY27, which is higher than the April estimates, making India one of the fastest growing major economies. In calendar year terms, India is expected to grow at 6.7% this year and 6.4% the next year. Now, the fund attributes this resilience to a more favorable external environment and sustained domestic demand as well. Globally, growth is projected to grow at 3% in 2025 and 3.1% in 2026, which is a slight upgrade from the April forecast, but still below the 2024 outcome of 3.3% and the pre-pandemic historical average of 3.7%. The boost, IMF says, is largely driven by front-loaded trade activity ahead of the expected tariff hikes, easing financial conditions, and fiscal expansion in some key economies. Growth in the advanced economies is forecast at 1.5% in 2025 and 1.6% next year, while emerging and developing economies are set to expand by 4.1% this year and 4% the next. Global inflation, however, is expected to ease to 4.2% this year and thereafter to 3.6%, with significant cross-country variation. But the IMF warns that the risk to this global growth outlook is tilted to the downside. A return to higher tariffs, unresolved trade tensions, and rising geopolitical conflicts could hit the global supply chains and fuel commodity price spikes. On the upside, though, a breakthrough in trade talks could improve confidence and spur investments. And so the IMF urges policymakers globally to reduce uncertainty with transparent trade rules, very targeted industrial policies, and credible fiscal frameworks. Central banks, meanwhile, says IMF, must stay nimble as inflation and trade shocks will evolve.
Ritu, thanks a lot for that. Now, strong waves as high as 4 feet hit Alaska, Hawaiian shores after a magnitude of 8.8 earthquake struck off Russia's east coast. The earthquake damaged buildings and injured several people in the remote Russian region. Japan's weather agency upgraded its warning, saying that it expects a tsunami wave of up to 3 meters to reach large areas of its coast. Japan has also urged residents in affected areas to evacuate immediately after the first tsunami wave hit the Hokkaido island.
Well, that's all we have in this edition of Business Lunch. We're leaving you with a green-looking screen only as far as the benchmark indices are concerned. The mid-cap and the small-cap end of the market not doing too well. But with that, it's a wrap. Mid-cap radar comes up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. And Vivek, what a day it has been. So much volatility. It's been a range of 130 points on the downside and the upside as well. And that continues to be the case for some trading sessions now.
Absolutely. Very stock-specific market, very volatile trading session, and stocks largely reacting to the kind of earnings that they're showing, especially as far as Q1 is concerned. But we have a lot lined up on the show, some important corporate conversations. So let's start off with the top headlines. Stocks seesaw between gains and losses after Trump hints at imposing tariffs of 20 to 25% on India. Oil and gas, FMCG and ITC gains, while auto and metals track. Midcaps lag.
GE Vernova T&D jumps on the back of a stellar Q1. Net profit more than doubles while margin improves by over 800 basis points. The company also sees a 78% jump in exports.
Bank of India trades higher after reporting a 32% growth in net profit due to strong credit growth. The management tells CNBC-TV18 repo rate impact has been taken on 60% of the bank's book.
Triveni Engineering under pressure after reporting their Q1 numbers. Company's net profit declines 86% while revenues and margins expand versus last year.
Avenue Supermart's gains after the company in its analyst meet reveals that it is likely to expand store footprint by 10 to 15% every year and accelerate store expansion, particularly in North India.
Okay, all right, those are the top headlines. It's the mid-caps which are under pressure right now. That index is down 150 points. So let's go across to Hormuz, who's standing by with the list of mid-cap movers that we have on our radar today. Hormuz.
Well, their mid-cap index may be under pressure, but there is no dearth of gains in the broader markets. And the gains are on the very heavy side as well, almost double-digit gains. Jubilant Pharma is one of them, 7% higher on that stock, came out with results a few days earlier. Sumitomo Chemicals is up 6%, Godfrey Phillips is up 6%. And if you take a look at the earnings reactions also, of course, that is presenting a mixed picture with both gainers and losers. New India Assurance now up 12%, and GE Vernova after strong results is in a 5% circuit through the session, and Triveni Engineering is down 7% in response to its results. Some of the newsmakers, Avenue Supermarts, the news just came in from its analyst meet with regards to some store expansion plans. The stock is now up 7% as we speak. Five-Star Finance recovered from the lows of the day yesterday, but is now down to the lows of the day today, 5% lower here, and Nilkamal too being an earnings reaction, 6% lower on that stock. Stocks doing well on the volumes front, and they too look at Bliss GVS Pharma 17% higher, Vishnu Chemicals 10% higher, Gateway Distriparks, IOL Chemicals is up 9%, all of them moving on very strong volumes in today's session, and stocks that are at a 52-week high even in a wobbly market like this. At Foseco India, of course, 13% higher on that stock. Moltec Packaging has given up most of the gains, still holding on to a 6% advance, and Sirca Paints is now up 4%, a 52-week high for this stock as well. Back to you guys.
Thank you so much for that, Harmal. The neat list and recap of all the stocks in the broader end of the markets that are making the moves today. But before we slip into a short break, here's a reminder for our viewers. Unlock a world of exclusivity, expertise, and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, and master classes, along with curated lifestyle benefits. Welcome back to Midcap Radar. Well, the first management of the show today is Aeroflex Industries. The company had a slightly subdued Q1. However, we have the management with us to discuss the prospects for the rest of FY26 and also their recent foray into the liquid cooling for data centers. We are now joined by Asad Daud, who's the MD at Aeroflex Industries. Thank you so much, Asad, for joining us. Well, first up, we'll start off with the numbers. FY26, a slightly subdued start along expected lines, so much uncertainty. But, you had earlier indicated that FY26 will grow better than FY25, which saw 15%, almost an 18% growth. So on the back of that, would you now revise your guidance downwards?
Yes, the first quarter was not as per our expectation, obviously because of certain parameters which is beyond our control. But as a company and our entire team is putting in all the efforts in order for us to achieve our targets for the entire year. So although first year was down, but with the new businesses and especially with the new sector that we are entering into, we are confident that we'll be able to achieve the targets for the remaining 3 quarters of the year. So I'm still optimistic for for achieving our targets for this year.
We'll be doing 18% revenue growth in FY26 and margins between 24 to 25%. Is that something which is achievable?
So in terms of our margins, our EBITDA margins for this year would be somewhere approximately in the range of 21 to 22%. The margins of 24 to 25% is expected over the period of the next 2 to 3 years. However, with like I mentioned, with our new capacities coming up, the bellows plants starting to see traction from the last quarter onwards, I think we'll be able to achieve our targets, especially in terms of our margins over the next few quarters.
Asad, you mentioned briefly the entry into the liquid cooling as far as the data centers is concerned. You also got an order of close to 7.5 crores from an American corporation. What is the corporation? Any more orders? What is the kind of pipeline that you're seeing in that particular space? And will it be restricted to the US market?
This is a long-term contract that we have signed with the with the company. The first order is the one that we have received. It's going to be supplied actually. So it is signed with the US with the Indian subsidiary of the US company, and the supply would be in India. So specifically, these are advanced flow control solutions for liquid cooling systems in the data centers. And this is just the first order as part of the long-term agreement that we have with the company.
Okay, so what would the total addressable market be here? What kind of investments will you have to make and the asset turn that you're expecting on that?
So if we see the entire liquid cooling, the market size for the liquid cooling in the data centers, that's approximately about $4.5 billion as of right now. It's growing at a CAGR of 20% year on year. So, by the math, in the next 5 to 6 years, this market would almost grow to 4 to 5 times, or almost to 20 billion by 2030. So we see a significant potential in this segment. And in terms of our investments, so a lot of our machineries from our bellows plant we are utilizing for this particular project. Also, we are procuring some new machines for that. Since it is a confidential agreement with the with our customer, we'll not be able to share specific details in terms of capex or in terms of margins.
Understood that. But structurally, is it largely in line with the kind of margins or that you do with the rest of the business, with the rest of the customers, or will this be significantly higher compared to the core business? And the second question is, last time you had indicated that you expect quite a lot of demand coming in from the domestic market. Q1, that really hasn't panned out. Q2 and H2, how do you see the prospect pipeline? What are the kind of orders that you are bidding for?
So in terms of the margins, so the margins in the new segment will be in lines with what margins we have as a company overall. In terms of our domestic business, so actually, the domestic business has grown by almost 30% in Q1. It is just that our export business has seen the decline, and hence that is the reason for the dip in the numbers of Q1. So we are seeing very strong demand coming in from the domestic business. Also, this new project would also help in increasing the sales of the domestic business because it's a domestic order. So we are extremely bullish on the domestic market, and we are seeing significant growth. We've already seen significant growth in Q1, and we expect this entire year to see significant growth in the domestic market. It is just the export market where, due to a lot of reasons, we are we had seen the decline, but we have seen that slowly. From this month onwards, we're starting to see a bit of normalcy coming in, and I'm sure in the next few months, with all the tariffs issues being resolved, I think we'll be able to see back on the growth trajectory very soon.
Okay, we take that point. Asad, thank you so much for joining us and telling us what can be expected from the quarters to come by. They maintain their FY25 guidance, and in terms of margins over the long term as well, between 24 to 25%. But with that, we'll slip into a break. Remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back to Midcap Radar. Well, the choppiness continues as far as the markets are concerned, but one particular company that we are looking at is one from the infra space. J. Kumar Infra Projects yesterday reported a steady set of Q1 numbers. We're joined by Nalin Gupta, who's the MD at J. Kumar Infra Projects. Thank you so much, Mr. Gupta, for joining us. Especially when we are looking at Q1 FY26, what is the kind of order inflows that you received? And going into FY26, are you on track for 8,000 crores of inflows that you had guided the street to at the end of Q4?
Well, so the company bagged orders worth around 4,700 crores in FY25. And in the Q1, we haven't clocked any new orders, but we are very hopeful of bagging orders worth around 2,000 crores approximately in Q2 in this coming quarter. And overall, we look at bagging orders worth around 6,000 crores for this financial year, closing our order book close to 21 to 22,000 crores for FY26.
Mr. Gupta, you spoke about receiving 4,700 crore worth of orders in FY25, which was lower than the guided figure of 6,000 to 8,000 crore rupees, right? What was the reason for that? I'm asking you because do you think those could be some of the issues that you could see in FY26 as well?
Well, so that's why if you look at the order book, we have been mentioning about 6,000 crores and not 8,000 crores because what's important for J. Kumar is the bottom line. So for us, we are very particular that we bag orders with strong bottom lines. We don't intend to take orders just for top line. So, and J. Kumar sitting at an existing order book of around 21,000 crores is quite a robust order book to take care of my top line and a decent growth of 15-16% for the next 2 to 3 years. So if you look at FY24, J. Kumar bagged orders worth 10,000 crore plus. So it with the current or existing order book itself, we don't need to be going below the, we don't need to underbid. So that's how, means I would say that we bagged an order book of 4,700 crores. And this year also we'll bag orders worth around 6,000 crores. So we are pretty comfortable in terms of the order book. And there was some slowdown in terms of the government inflow of orders. So I would say that with this current scenario, we are very sure that around 6,000 crores worth of order we should be able to bag in this coming year.
Okay, Mr. Gupta, that is very clear. So 6,000 crores of order inflows, fresh order inflows is what you are now penciling in for FY26. Well, at the end of FY24, I remember seeing most of the investor presentations. You had given us a couple of key guidance or key parameters to track. Number one was the order book was expected to be in excess of 25,000 crore. You were targeting $1 billion of revenues, and you also had an operating profit margin expected to be in the range of 15 to 16%. Are you now tweaking that guidance?
Well, so let me tell you about the top line. Firstly, as you have rightly mentioned, we had given a target of a $1 billion revenue company when the dollar rate was 75. But I think you will appreciate the dollar rate has gone up to 85. So we are surely in terms of the earlier guidance that we have given, we stick to it. And this year we expect a top line worth around 6,500 to 6,600. So in FY27, we should be almost close to the target that we had given when the dollar was 75. With regards to EBITDA margin, yes, the company has been already making in the Q1, if you look at the margin, the company has made a EBITDA margin of 14.6%. So, which is a growth of 15% on the previous years. So we have been growing in terms of the EBITDA margin also, and our continuous endeavor is to ensure that in the coming 6 to 8 quarters, we should be able to increase this by 1%, taking it from 14-15 to 15-16%. And that would be due to the operational efficiency that the company has been following. So we are pretty much comfortable that we should be able to achieve this.
Got it. That's on the margin number where you're expecting a 1% improvement because of operational efficiencies. So then let's talk about some of the big orders or big pipeline plans that you have. One of them, of course, is Goregaon Mulund Link Road. What is the percentage of completion here? And in terms of margins, how do you look at this particular project? I know we've spoken about it earlier, but since then, numbers in terms of input prices have changed a lot.
Well, so I would say that GMLR is a project, one of its kind. It's one of the largest diameter of tunnel to be constructed in India. and the project is well on track. We have already set up the entire casting yard for casting of these tunnel segments, and we have already casted more than 200 rings by now, and the casting yard is fully functional. The site is fully prepared. The TBM, there are 2 TBMs that we are procuring for this project. One of the TBM has already reached at job site around 60%, and the brake bulk push we are expecting in the first week of August. Even the second tunnel boring machine is ready for its FAT test, that is factory acceptance test, which should happen in the first week of August. So my entire team related to that project would be going for the inspection. So and the margins on that project being a very complex job, we are very hopeful that we should be able to make a good set of numbers in terms of top and bottom line there.
Thank you so much, Mr. Gupta, for joining us. It's a very short conversation this time around, but we hope to get you a little sooner. Some of the important projects, especially as a Mumbaiker, is something that we are looking forward to early completion. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. In terms of the market, 24,850 levels right now is what the Nifty is managing to hold on to, 0.2% of gains over there. Sensex holding on to gains of almost 180 points in trade as well. Mid and small cap, a bit of an underperformance that's coming in over there. But we're seeing a lot of reactions in terms of earnings that we're seeing coming in today. Also, let's pull up Avenue Supermart. Their analyst day call is going on right now, and we did see a sharp spike up coming in the stock. Why? Because they've spoken about store additions. Right now, the stock is holding on to gains of around 7% as well. But talking about earnings, we have Pharma that reported a weak set of numbers in Q1. The revenue was down 29% sequentially. Margin saw a decline in terms of single digits as well. To talk to us more about their quarterly numbers, we have Nandini Piramal, chairperson of Pharma, joining in with us to talk to us about that and what the company should be watching out for, what we'll be keeping an eye out on. Now, the company is sticking to its guidance in the mid-single-digit revenue terms and mid-teens margins as well, year-on-year basis for FY26. Now, this is suggesting a pickup in terms of the next 3 quarters, especially in terms of margins. Nandini, good afternoon. And, can you actually tell us what we can expect in terms for the next 3 quarters from the company here?
Yes, we are sticking to our overall guidance of mid-single-digit revenue growth as well as mid-teen EBITDA and year-on-year growth in net profit. For us, Q1 is generally a very soft and quiet quarter, and Q4 is the highest quarter, and that's just how our customers actually like to buy products. So overall, I think we expect there will be H2 will pick up significantly over H1. And we think we're on track to meet that guidance so far.
On track to meet that guidance, but Nandini, the company has also indicated that it is on track to achieve that FY30 aspirations that you'll have of $2 billion revenue with 25% margin. How challenging is this environment, you would say right now, to achieve this? What is the risk here?
Currently, yes, there is uncertainty in the US market, and it is, I would say, a lot of it's due to inconsistent biotech funding that hasn't quite recovered as much as it should have. But I think as the year goes on, there will be more certainty, and people will kind of continue to make biotech investments. And again, we're pretty confident, and we believe that our aims of FY30 are achievable. It's $2 billion in revenue, a margin of 25%, and significant growth in net profit. We also, I think, are committed to continue to reduce debt. And all of this currently is organic.
Nandini, let's shift focus now and talk about your CDMO business. Now, what is the current order book over there that you have, especially for the next 3 quarters? Also, how has biotech funding crunch in the US impacted the business? And are you seeing any signs of recovery or improvement in this funding environment?
Overall, biotech funding has been inconsistent over the last year or so. That has led to a prolonged decision-making and a slowdown in decision-making cycles. However, I think where the CDMO business without the destocking event still grew at mid-teens, and so that we are seeing that's a continuation and a faith in our products and our ability to service our clients. Our network is very balanced across the US, UK, and India, and I think we believe that that gives us a good way of helping serve our clients to get medicines to patients faster. Over the last quarter, I'd like to say we've seen a broad pickup in growth and performance across both the US and UK, and that's helped balance the growth and the profitability for the company.
Nandini, Complex Hospitals was flat on a year-on-year basis in Q4, but has finally seen a pickup in, and is expected to see a pickup in the second half of the year. Can you tell us what has led to the flat performance? What is the pickup that you're predicting as of now as well?
I think overall, I think for us, generally, Q1 is a soft quarter. I think we expect we've got our new site online in Digwal, Telangana at the end of April, and over the year, we expect that on a market-by-market registrations to come through. And after that, then we will do orders to institutional hospitals and governments over the year. So some of the slowdown is due to timing differences, as we expect institutional orders to pick up more in H2 rather than in this quarter two.
Nandini, just the last question from me, especially in terms of power brands and e-commerce, that led the growth that came in the consumer health segment this quarter. Are you expecting this growth to sustain going forward as well?
I think we'd like to think so. I think we've been focusing a lot on, how do we actually do good promotions and good products. For us, our power brands have been doing well. And I do think that the Indian consumer likes the products that we're selling, and we think that they actually help serve their needs and provide great value for money.
Okay, Nandini, thank you so much for joining us this afternoon on CNBC-TV18, giving us an insight in terms of what we should be expecting from the company in FY26. But that is Piramal Pharma, but we also had First Source that reported their numbers as well. And Prashant, an interesting set that came in from the company.
Well, IT is an interesting space, isn't it, Vinny? And, it's been somewhat tough. We've had many managements joining us talking about, of course, the big talking point, which is AI and what is it doing to existing models, profitability, etc., etc. So First Source is the company that I'm talking about for now. So they've reported a decent set. Profits are up about 5% on a sequential basis. The company is guiding for FY26 EBIT margins in the 11.25 to 12% range. And actually, if anything, on the top line revenue front, they've upped their guidance. Mr. Sanjeev Goenka is now joining us, chairman of First Source Solutions. Mr. Goenka, great to have you with us on CNBC-TV18. Good afternoon. It's always good to see you, sir. You're, the world's going one way, you're going the other way, if I can put it that way, in a good way. You've upped the journey. Go on, sir. Go on.
It's about actually increasing revenues and increasing margins. And we're doing this successfully. And we hope to continue this trajectory going forward. This year looks good in terms of revenues. It looks better in terms of margins. You've just highlighted our guidelines for margins. And what's very good for us, I think, is the deal wins. Last year, we had $434 million of ACV wins. The first quarter, we've had $95 million of ACV wins. Our pipeline today stands at $1.1 billion, which is at least a 40% higher than it's been in the last several quarters. And our win to pipeline ratio is about 54%, which is also very healthy. So that is all auguring very well. And the whole un-BPO campaign, the whole un-BPO move is working extremely well. So where we are using AI along with conventional BPO, I think the whole thing is working. And if you see our headcount, it's remained constant, but revenues have gone up. So productivity has gone up effectively.
No, absolutely. So you're now saying revenues for the full year, just to get the basic numbers out of the way, will grow 13 to 15%, sir, in FY26. This compares to 12 to 15%, which was the number earlier. So, it's a slight, the range moved up just a little bit, right?
So, well, this is what we are giving as our guidance, but I think we are getting very good traction with customers. And the very fact that we won $434 million of ACVs last year, a significant amount of it will translate into revenues from this year onwards. So this will not have a full year impact, but it will start having impact, a greater and greater impact as quarters go on. So that in itself gives us a significant upside in terms of revenues.
You've done a bunch of acquisitions as well, right? I mean, I think there were 3 acquisitions you did in FY25. In July, you've acquired another company, Past Due Credit Solutions. That's a UK-based company. Could you give us an overall sense of, as all these acquisitions are fully integrated and you do what you, I mean, in terms of scaling up and sort of putting your people in, and what will these 6 acquisitions sort of contribute? In FY26. Just give us a scale or the size of the business you're expecting from these.
So this is Past Due Credit Solutions gives us an entry into the UK public utilities market and the government segment. So water and those kind of utilities. So our acquisition cost is roughly about 22 million and the revenues are similar. And we expect to scale this up to, over the next few years, we expect revenues to double. And margins are reasonably good. We expect margins to increase. There is possibilities of cross-selling, like we did with the Sensex, which we acquired last year. And cross-selling is becoming a big thing. So I think the net revenues are growing higher than we had expected. Margins are growing higher than we expected from these acquisitions. And they're giving us either access to a new set of customers or they're giving us a greater footprint in the areas that we are. And some of them are giving us footprint, for example, in areas like South Africa, where we wanted to enter. And that gives us a ready-made base. And then you have existing clients who are willing to offshore to, say, a country like South Africa. And that's where, for example, an acquisition like a Sensex comes in very handy.
Mr. Goenka, I'll come to AI and sort of workforce, etc., in a bit. But in the fourth quarter, you hit the $1 billion 4-quarter revenue run rate. I mean, well ahead of what you sort of guided for. Is there a new number for us, sir? A new target that you can sort of share?
We keep setting ourselves higher and higher targets. But I think we will stick to our target to the street at this point in time, though our internal targets might be slightly different.
That's a hint. That's a nice hint, but not revealing too much. Mr. Goenka, let me ask you this. We saw this recent deal, WNS and Capgemini, in the BPO space. So many tech companies that we speak with tell us that BPO work, along with so much else, is essentially going to be fundamentally transformed because of AI. You did say you've launched, un-BPO, right? Which is, you're saying, well, you want to focus away from labor arbitrage to technology arbitrage, etc. How far along are you? What will this require? Will the effort required to deliver the same amount is going to go down dramatically. I mean, depends on who you ask, 20 to 40%, in some cases more. How will this, where are we in that transformation, in that journey on the BPO side?
The whole AI journey is a new journey. It's a very young journey. So we are at a good point in that journey. But to say we have completely evolved would be a gross overstatement. I think it's evolutionary on a day-to-day basis. We did acquire we made a small tuck-in acquisition with Jaipur-based, which is with very high-tech AI professionals. We are doing specific things in that area. So one is simple AI, when you use AI for repetitive tasks, which are routine. But the other is to use AI for forecasting, to use AI for actually adding a much more higher value to your client. And that is all in the process of beginning to help. I mean, and in terms of the value additions we are doing to our clients, it evolves every day. It's growing. And I think it is something that will keep evolving, will keep growing, hopefully.
You think, Mr. Goenka, your stated guidance is to improve margins by a certain amount every year. You think it's possible, or you think fundamentally AI in a way is deflationary? Because I mean, if the work you do requires a lot less effort, at some point the customer on the other side is going to say, well, please pass on the benefits to me. So in that sense, I'm just asking direction of travel without getting into specific numbers on margins.
It's about sharing the gains that you get. It's not only about retaining everything. It's also about reducing costs. It's also about adding revenues with the same workforce. It is about, for example, our attrition rates have gone down by 13% in the last 8 quarters. So that's a significant margin driver. Our onshore-offshore ratio has gone significantly in our favor. So about 80% of the new seats that we've added in the last couple of years have been offshore rather than onshore. So all these things are helping. And so we are learning to share data with our clients and tell them that there is a benefit in it for them, there is a benefit in it for us, and it's a very healthy, happy conversation.
So margin expansion towards your mid-teen target, I mean, that stays as is?
Absolutely. Absolutely.
That's great to hear. I mean, I had a bunch of other questions, but we will pick up on some of these as we go along. It's a conversation we need to have. I mean, earlier today, I had a discussion, Mr. Goenka, with two sort of technologists based out of India. They were based in the Valley. And the topic was, can we have our own sort of, deep tech? It was a bit of a cheesy, clickbaity title, but I think, can we have our own OpenAI out of the country, right? But I think it's the topic is real, and the discussion needs to be had, which we will do so here on CNBC-TV18. Fast evolving sort of landscape as far as tech is concerned. Mr. Goenka, thank you very much for joining us today. Really appreciate it, and look forward to many more.
Yeah.
Okay, well, we'll take a quick commercial break here. We're going to come back and focus on some specific stocks on the other side. Stay tuned.
Welcome back to Your Stocks on CNBC-TV18. Let's just quickly mark KPIT Tech because they reported their numbers just a short while ago. Net profits came in at 172 crores versus the poll that we had was 200 crores. So a bit of a miss that came in on profit front. EBITDA overall on a quarter-on-quarter, overall on a quarter-on-quarter basis was down almost 10%. Margin saw a bit of a contraction. So we saw the stock that did see a dip coming in and then a sharp spike up. Now the stock is trading at the day's highest point. It's up 2%. We're going to be waiting out for anything in terms of the guidance, the press release that comes in as well. But as of now, we're just seeing the numbers, but the stock has seen a sharp spike up. Margins, EBIT margins have come in at 15.4% versus 17.3% that was in the last quarter. We'll keep an eye out on more details on this front. But let's move on from earnings that are reported to earnings that we're expecting today. And that is Tata Steel. Now, Nigel is joining in with us to give us what we should be expecting this time from Tata Steel. Good afternoon, Nigel. The stock is not doing anything exciting, but numbers, anything great that we could expect?
Well, if it's not doing anything exciting, then hopefully the numbers at least will have some kind of a positive surprise, which may not be the case, but at least the commentary is something that we'll be looking forward to. To run you through the numbers, on the top line, we're expecting a degrowth of close to around 6%. However, the EBITDA number will come up by close to around 6%, which means that there'll be some margin expansion. Let's take it piece by piece. On a sequential basis, the average selling prices will improve. Particularly here in India, it's up by roughly around 2,500 rupees on a per ton basis. That's because of the flat steel prices that have moved up. So realizations will move in their favor. In addition to that, you'll have the European business as well that will be gradually moving towards the break-even point. And remember, it's been reporting $40 to $50 per ton as a negative EBITDA on a per ton basis. Standalone volumes, well, it'll be down by close to around 15% on a sequential basis. That's because they undertook a shutdown, a maintenance shutdown in the past quarter. And also, the export volumes actually have been very, very jittery owing to the uncertainty on Trump's tariffs. There'll be a decline, though, in coking coal cost, which should come down by close to around $10 per ton. So the reason that we're seeing that the EBITDA in the India business particularly will improve is because coking coal costs will be low and realizations have improved. For the UK business, the losses will reduce, while the Netherlands business will report a solid EBITDA per ton, which means that the European business in all probability will be in the vicinity of plus $5 per ton to negative $5 per ton. That's the EBITDA number on the European business. The India business, the crucial number we're looking at, is around 14,500 rupees per ton. We'll keep an eye out on the numbers. Normally, I have a date at around 6 p.m. later this evening, so we'll get you a first take on that. But numbers not expected to be that great, but outlook is going to be important on debt, pricing, and demand. Back to you.
Okay, outlook is what we'll be keeping an eye out on. Numbers may not be that great, but outlook will be key to watch out for Tata Steel. Now, let's talk about Interglobe Aviation. They are also expected to report their numbers today post-market hours. Talking about the numbers, even here for Interglobe Aviation, we're not expecting a great set of numbers. Now, why? Obviously, there were three factors that will be impacting the numbers this time. One is impact because of the India-Pakistan border issues. That was during Q1. Other than that, plane crash that took place in Ahmedabad, so some bit of an impact of that. We had Middle East geopolitical tensions that were continuing that impacted those air traffics. Rerouting was happening with there. So that was the impact coming in there. Now, other than that, net profit, that is expected to see a drop coming in. Why? Because, there could be lower compensation that comes in from Pratt & Whitney. So that is something, because of that, the profits will be lower. Now, other than that, there was a tepid demand that is expected this time. So because of that, passenger load factor could come in at just 86%. Previously, it's been higher than that. Also, X of fuel cost. We're seeing elevated cost. We're expecting to see elevated cost X of fuel. So weaker yields could come in, and because of that, we could see some bit of an impact in terms of profitability as well. Fuel cost, yes, obviously crude prices were fairly benign. But now, we've seen that volatility coming in, so will be key to watch out for in terms of the commentary that comes in from there as well. Keep an eye out on those geopolitical tensions. What are the trends shaping up there? Aircraft on ground, that is also something that we'll be keeping an eye out on. So that is Interglobe Aviation. But let's look at M&M, because the board is to meet to consider earnings advance to today from tomorrow. So that is an important update. M&M will be announcing their Q1 numbers today. So we will keep an eye out on that. They were expected tomorrow. As of now, the stock has seen a bit of a fall. We'll watch out for, what is the reason behind this. But they have advanced their earnings meeting, and we will be keeping an eye out on that. Earnings expected today for M&M. Let's keep an eye out on when those numbers come out as well. But, with that, we're absolutely out of time on this edition of Your Stocks on CNBC-TV18. Thank you so much for tuning in. Up next, you have Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwanese index is now trading with gains of close to 1%, but the Hang Seng is trading with losses of around 0.5%.
India has been a good friend, but India has charged basically more tariffs than almost any other country.
And the resistance is 24,998. We put that level out yesterday as well. Only once the market gets above that, you can say that maybe the decline is complete. To begin the day, we are above the 25,000 mark. That's good to note.
NSDL doesn't operate in isolation. It's locked in a duopoly with CDSL.
We see that the significant market, India, continues to grow, and so does the global market.
The performance, so to say, is coming in on the mid-cap. So that index is around 0.3% as we speak.
We have been growing better than the industry average.
The acquisition is likely to be around $4.5 billion.
It's the mid-caps which are under pressure right now. That index is down 150 points.
Okay, it's a very, very busy day as you sort of saw a sampling of the day so far. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Reema here, and Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, good afternoon. Busy day, but still very range-bound when it comes to the index today.
And so much news flow, right? You've got L&T on the way up, still going strong, 5% higher. Tata Motors on the back of a potential acquisition, down nearly 3.5%. Look at the reaction in KPIT Tech. That stock is flying, 5% higher. There is news in Avenue Supermarts. And M&M has said that the numbers will now be today post-market hours instead of tomorrow. So it's all happening today, Nigel.
Well, that's right. And good to see, right? I think in the last 24 hours, you've had close to around 8 to 10 earnings reactions that are positive. Asian Paints, L&T, as you mentioned, KPIT Technology, the stock that has fallen 35-40% from the top. That is well fairly positive. Smaller names, GE, Vinova, you had a Hind Rectifier. The stocks have given you 10%, 15% in a matter of 2 days. So at least some encouragement coming in there, because still Monday evening, I recall that everyone was moaning and groaning that these numbers are not looking good. Last 24 hours have been good. Let's hope this form continues.
Moaning and groaning.
True, right?
You're right. You're right. Anyway, let's quickly run our viewers through what's lined up here in the next 60 minutes or so. Lots of stock-specific action, as Nigel said. So you've got Avenue Supermarts rallying on the back of optimistic commentary. Management highlights prospects of doubling down on increasing its store count while ramping up investments for the same. Tata Motors is the next one, top laggard on the Nifty Street, weighing a $4.5 billion acquisition of Italian truck maker. L&T, from the word go, has been doing good on the back of very strong first quarter numbers. Margins, so not really an issue so far for the market, at least today. Order book is in focus. And of course, the Pharma pack is in the spotlight. And this, of course, after Novo in the US session overnight raised concerns about too much competition as far as weight loss GLP drug segment is concerned. So that is essentially what's coming up here. Lots of previews as well. Mahindra & Mahindra should be out by 3:30 today, as Reema just said. Tata Steel and Interglobe are the others, which will post after market hours. So we'll get you previews going forward as well. I think just a quick word on the Nifty 24,872. It's all about single stocks, but I'll just say one thing. You want the market to, I think intraday, right to the word go, we did cross the 25,000 mark or roughly there. 25,000 is a 61.8% retracement of the decline, the recent decline. You want to close above it, and then perhaps the market starts to look a little better, starts to look a little higher going forward. So that's the picture at this point in time. Let's quickly run you through some trades. Mitesh is joining us with what he'd want you to do. Mitesh, good afternoon. Tell us on the Nifty, on the headline indices and specific stocks, what are the trades?
Yeah. Good afternoon, Prashant. So on the index, as you rightly said, not much is happening. We are not getting any kind of a strong reversal signal as yet. And my belief is that we might even go to about 24,950 or levels. That's where the first pivot comes in on the upside. And then beyond that, even 25,250. But it looks like a market which might just, spend some time in this range of 25,250 on the upside broadly to about 24,550 or thereabouts. So it's a market which is not giving direction-wise. But given the fact that we are oversold, the PCR is slightly on the negative side, you can still trade, with a positive bias, at least if not on the index, on the stock side. So in that sense, I have a buy on Sun Pharma. In fact, Pharma as a pack is looking pretty good. So Sun Pharma is a buy with the stop at 17.15 for targets of around 17.70. And the other one is Tata Communication, which I would recommend buying with the stop at 17.44 for targets of 18.10.
Got that. Let's talk about Avenue Supermarts. That's surging in trade. Mangalam is here to tell us more. Mangalam, there was an analyst meet.
There was an analyst meet, and in uncharacteristic DMart way, it was extremely aggressive, because what were one of the quibbles that the analyst had about the company? That they are not expanding stores fast enough. And that's exactly what the company said, that, they are going to accelerate their store expansion. In fact, 10 to 15% addition every year is what they are going to see to their overall store footprint. And that has the street fairly excited. The stock is seeing an up move of almost 7% right now. And more importantly, they said that they will accelerate their store expansion, particularly in the northern part of the country. Remember, we had pointed out when they opened their first store in Uttar Pradesh, Maine, that, this is the first of many that is likely to come there. And this is exactly what will happen. For all those who are worried about what Neville Narona, the current MD CEO who steps aside for Anshul Asawa, will do, Neville Narona will be the one who will lead the company in terms of its North India real estate expansion over the next few months. So that has the street fairly comforted as well. And they will double down on investment on store expansion, considering what's happening around, and more importantly on quick commerce as well. So they're not going to compromise on return metrics. And there is case for DMart stores, offline stores, to take place. The only thing that the street was worried about, that they aren't expanding fast enough. And here, the company said that they will go ahead and expand fast enough. The stock had been under pressure. It's been a beaten down name. Every time quick commerce does well, DMart's the one that gets impacted the most. But now, after underperformance on that counter, some aggression shown from the management, see the result. It's up 7%.
Oh, absolutely. And what a move today from Avenue Supermarts. Mangalam, thanks very much for putting that in perspective. Well, let's discuss this and more with Prakash Diwan, who's with us on the first leg of the show. Prakash, great to have you on. So that's the real question. We haven't seen DMart do this in a long, long time. Not sure if it's just the management change or the hope that, things are past the bottom. What's your sense? And now, at such levels, do valuations offer some comfort at least?
Good afternoon, Sylvie. So I think the first thing is they're this time around they're singing a tune that the market loves to hear. So that's where the market's celebrating this sort of a announcement, a slew of announcements. But to answer your question on valuation, I think it's still expensive, given the fact that all of this is going to take much longer than what you would love to see on the numbers. When the results came the last time around, just a few weeks back, it was very clear that DMart will have to reinvent itself if it really wants to justify the valuations, which have always been premium. And any softness in valuation would become an opportunity to buy if you are looking at all of this to pan out in the next 18, 24 months. But whether to buy it at 7.5% up move, the answer is you could probably get better levels as well. So I believe it's great. The story becomes much more robust, but the time to open up the book and read the story will probably be a bit later once the market digests all this exuberance.
Got that. By the way, look at KPIT Tech. Now the numbers are fairly disappointing. The company has reported a revenue decline of 3.2% on a quarter-on-quarter basis. And this is the first revenue decline for the company in I don't even know how many quarters, perhaps not in the last 4-5 years, since the auto ER&D space started picking up momentum. So numbers are disappointing. In fact, many estimates, I have estimates from JP Morgan, Kotak, they were penciling in a revenue drop of 2.5%. So 3.2% is lower than expectations. And the margins, the way we calculated, have also dropped. Again, this time, the company has not given a full year guidance. Remember, KPIT would always give you an annual guidance. But in Q4, 3 months back, again, citing uncertainty and the corporate behavior, etc., they decided to abstain from giving a guidance. They've not given a guidance, but what they have said is that we're confident of growth in H2, led by our top 25 clients, and expect to have growth momentum as we exit the year. So the numbers to my mind are weaker than what we were anticipating, but clearly the management sees things are improving. It's a negative growth of 3.2%, but they are seeing growth coming in the second half of the year, and maybe that is something that the street likes. And anyway, remember, the stock has been a bit subdued in trade. But that's about KPIT Tech. Let's talk about M&M. That's all set to report numbers later today. Sudarshan now joins in to tell us what the street is expecting this time. Sudarshan, do we know first why it's been advanced?
So I assume that one of the directors of Mahindra & Mahindra has passed away, and that's the reason company has decided to advance its board meeting that was scheduled for tomorrow. Now the board meeting is today, and the company will be most probably announcing earnings around 3:30 p.m. So how the earnings will look like? We are expecting a steady set of earnings from Mahindra & Mahindra. Revenue would be led by healthy volume growth, and tractor business, that is going to, so basically healthy tractor mix will lift the margin. If you talk about the headline numbers, profit is expected to increase by 22%, might come around by 3,180 crore. Revenue too may see an increase of 26%. EBITDA can jump by 23%, and margin may remain healthy and can come in above 14%. It may come in at 14.5% versus 14.9%. Remember, in passenger vehicle segment, one segment that continues to see healthy growth, that is the SUV segment. And SUV forms the entire PV for Mahindra & Mahindra. That's the reason its volumes remain strong. So overall volumes for Mahindra & Mahindra in Q1 were up 13% year-on-year and up 14% sequentially. That includes tractor also. If we just talk about the auto volumes, that were down 2% year-on-year, but on a sequential basis, here also the volumes were up almost 17%. And if we talk about the tractor segment, tractor volumes have increased by more than 50% year-on-year and up 10% sequentially. Now, recently we have seen that so many companies have taken price hike, and that's the reason realization is seeing just a fall of 3% year-on-year, but on a sequential basis, there might be a significant improvement and can come in around 10% higher than the last quarter. Now, in the commentary, what exactly would be focusing on? First, what does companies say about the demand ahead of the festive season, and how is the demand looking especially for tractor segment, and if there is any inventory or on the discounts, what does exactly company say? Because it will be the first company after Hyundai that will be reporting earnings in the auto sector.
Okay, all right, got it. Thanks very much for that, Sudarshan. Indeed, it's been the flag bearer of the auto sector, Mahindra & Mahindra, the one stock that has consistently created wealth, despite the the environment being very, very uncertain for overall autos, PVs included. Stock spiking even as we speak. Prakash, well, this has been your favorite. I keep saying that, I keep repeating. 2 years back when we spoke about it, it's over 800 rupees. It's been a phenomenal journey, but people always wonder, I mean, how much more? Is it more? Is it too late? What would you say?
I think should be the growth is still very, very clearly visible, and it continues to promise and hold a lot of promise. I don't see any reason why, if it's become like 3x or 4x from where we discussed a few years back. In fact, it's the tractor segment that I'm so positive on, and given the fact that this time the monsoon has been timely and fairly well distributed, imagine what happens once those numbers start kind of adding up. And you have another player in that space, Scotch Kubota, which has kind of taken a little bit of a pause in terms of getting their house in order. But M&M marches ahead with Agri. It has a great traction that it's been able to generate on the EV pack. And remember, they are the ones who are the most insulated from any global vagaries. You have no issues whatsoever related to exports and tariffs and all of that. A lot of the other players struggle, whether it's Maruti, whether it's Tata Motors. So you have a domestic play. You have a management that's very focused on growth and on margins. I don't see any reason why this. Of course, we'll wait for the numbers to be more specific in terms of what to anticipate on the stock. But absolutely greatly poised for a run that will continue for the next 12, 18 months as well.
Okay, all right, got that. Let's focus on the other auto name then. Tata Motors, that's the top Nifty loser. Talks have emerged that Tata Motors is a potential, Tata Motors and Invico could be in a potential deal. Parikshit joins us to break that down for us. Parikshit?
Well, this deal has been in the works for the last 1 year, and Tata Motors has been looking to buy a controlling stake in this Italian company, Iveco, which is a large CV maker with 70% of its revenues coming from the European market. Now, what will Tata Motors get with this? Well, it will get access to key export markets in Europe, North America, and Latin America as well. It will get access to futuristic technology, which is important for the company going forward. This deal is likely to take place at $4.5 billion. We believe that both sides will come up with an approval today. When Iveco was reached out to, they said that talks have been in advanced stage to sell both their defense business and their commercial vehicle business. The commercial vehicle business is, of course, going to be acquired by Tata Motors from the Agnelli family of Italy. So we're hoping for an announcement to come in the next few hours, but this will be the largest ever announcement by Tata Motors after the acquisition of JLR.
Okay, all right. Thanks a lot for that, Parikshit. Prakash, what do you make of it? You know, automakers, steel makers, where they go to bite big, the market punishes them. You know, you have Tata Motors that's under pressure because of that. The street believes it's being too aggressive. But as we saw last week, for an alcohol company like Tilaknagar Industries, they can go and have a big bottle. You know, they are going for an asset that's far larger than their size. Let's leave Tilaknagar aside and that deal. Tata Motors, will you view it as a negative?
So I'll tell you, Nigel, the reaction of the street is more out of confusion, more out of anxiety. I don't think there's anything proven yet or empirically establishing a negative impact of this proposed acquisition. But given the fact that Europe is slowing down globally, it's going to be difficult to muster a market share footprint of IC engines, particularly on the CV sides. There are a lot of questions, and it brings back the fears that Chorus, the acquisition of Chorus made. When you do something very large, it takes years to make sure that everything goes off right. So I think they've just managed to get a balance sheet which is leaner, and this will end up kind of reversing that. So from that perspective, it's a lot of concern. But I don't think it's too early to call this as negative. But I would believe once you get more details, things will probably be clearer. This is a reaction. This is more of like stay away till things get clarified. So that's the thing. But I don't think it's right to call it negative at the same time.
Yeah, we need more numbers, far more clarity in terms of what that asset is like, debt levels, etc., sales, turnaround. Need a lot more information, and hopefully we'll have that if this indeed comes through. Stay on, Prakash. We have to talk about the Nifty winner today, and that's L&T. It's finally come out hitting all the right notes in the first quarter. Strong numbers coming in, top line growth, margins are steady. And of course, that order book is looking better and better. Vivek is joining in. Vivek, so what's the verdict? I mean, the price action really tells you how happy the street is.
Absolutely right. Going into the results, what is the key concern? Number one, order inflows, especially given the fact that falling oil prices was something that the street expected could lead to lower orders as far as West Asia was concerned. Clearly, that is not the case this time around. So what is the key points to watch out for, especially as the earnings takeaway is concerned? Number one, the order inflow is much above what the street was anticipating. And this does not include the order that the company actually mentioned in yesterday's press release, which was a mega order that they received again from a West Asian client. The good part is this time around, they managed to bag one large BTG order. This is from the domestic market. So robust order inflows, execution has been quite strong, quite steady. The only blip, of course, has been margins haven't expanded. The core margins haven't expanded to the guidance that the company has given, but the management has not revised the guidance, indicating that they continue to remain confident that Q2 and H2 execution will be good with higher margins. Consolidated order book extremely strong, has crossed 6 lakh crore. So revenues higher by 15.5%, EBITDA higher by 12.5%. Margins the only blip, around 30 basis points lower on a year-on-year basis. The consolidated margins, profitability higher by 30%. Now the core EBITDA margin, something that the street tracks very closely, has come in at 7.6. What is the management guidance? The management guidance was at 8.5%. So 90 basis points uptick is what the management has to make up for in the remainder of the 3 quarters. Consolidated order inflow, as far as this particular segment is concerned, at 77,000 crore rupees, up 41%. Remember, the management guidance is just about 10% for FY26. Two important numbers to cap. Number one is the order prospect pipeline. 14.8 trillion is the order prospect pipeline for the remainder of the 3 quarters. And also, one important development as far as divestment of non-core assets is concerned is the Nabha power plant. The company says that in case they get a bidder at the right valuation, they are open to divesting this particular asset.
Thank you very much for that, Prakash. L&T, after this 5% up move, numbers look fine, strong deal win, steady execution. But margins, as Vivek was pointing out, still a bit of a sore point. After this gain, where do you stand on L&T?
So, I probably might sound a bit biased in a favorable way that even after this run-up, I don't think L&T is getting its fair due in terms of market price valuations. If you recall the quarter earlier than this, this is when the numbers came out and we were in the midst of Operation Sindoor and the market mood was not so robust enough to reward it. And actually, the stock hasn't done anything from that quarter to this quarter. So it tells you that the price hasn't started penciling in a lot of the salience that the numbers speak. The internals are so positive, and if you keep adding the optionalities, particularly from the defense side, from the shipbuilding side, there's so much that we've not yet seen get converted to realization. So when that happens, of course, the margins will also improve. This is at an expanded book that you probably see the margins suffer a bit. But I really wouldn't be worried about this on a quarter-on-quarter basis because the long-term trajectory from where this company could go to, I think it's still kind of undervalued. So there's lots that's available. And remember, a lot of the ETFs would want to park themselves into this once the money comes into India. And as and when that happens, you'll probably see a very sharp re-rating. So good times to look at if you buy on this current level or buy on dips. You can choose your risk reward, but essentially a very good spot at which it rests at the current moment, given the numbers and the strength going forward.
Okay, all right. Prakash, we'll leave it there. Thank you very much for running us through all of those names and your views as well. Always appreciated. Markets, by the way, are up about 48, 50 points still. Just a quick reminder for our viewers. Unlock a world of exclusivity and expertise, influence. Become a member of CNBC-TV18 Access. Our premium members-only experience on CNBC-TV18.com. Membership includes access to the flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, curated lifestyle benefits as well. So go check it out on the website, CNBC-TV18.com.
Welcome back. Shares of New India Assurance are flying in trade. I think it's up 13-14% on the back of their numbers and positive management commentary. Yash joins in. Yash?
Well, the numbers were posted by the company post-markets yesterday. The stock was positive in today's morning trade. But then the management commentary happened at about 12:30 to 12:45 thereabout, and it was pretty strong. I'll take you through the internals of that management commentary. First of all, as far as growth itself is concerned, the premium growth, management expects FY26 premium growth to come in at 15% as compared to 6% that happened in FY25. They also expect a combined ratio improvement of 300 basis points. Now, of course, as far as the internals are concerned, what we spoke to the management exclusively after the con call, the management expects health loss ratios to reduce by 2 to 3% in FY26. This could happen on account of A, move towards retail health, and second, repricing of health portfolio. Second one, motor loss ratio is expected to reduce by 2 to 3% again in FY26. That could happen because of movement to passenger vehicles from commercial vehicles. Also importantly, commercial lines, which is fire, marine, so on and so forth. The management expects, reduction in loss ratios there between 6 to 21%. The expectation from the management is that for FY26, the loss ratios in commercial lines could come in between 75 to 90% as compared to 96% in FY25. Finally, some qualitative remarks coming from the management as well. They expect Health Ministry to take certain steps to regulate hospitals in the country, which could be beneficial for the health insurance portfolio. They also expect significant improvement in incurred claims ratio in FY26. Finally, they expect some movement in terms of increase in motor third-party premiums coming in FY26 in some shape and form.
Yash, thanks very much for that. That's excellent sort of summary of what the management has said, and the stock is excited. But just FYI, as Nimesh points out, there is, the free float in the company, publicly available shares to be traded is about 5%. 95% is locked up. Government and insurance companies own 95% of New India, and the public float is only about 5% or so. So be mindful of that when you look at very sharp moves, not just with New India, but for any company with such small free float out there. Hormuz is here as always with the unusual movers. Hormuz, over to you.
There are plenty of earnings reactions today, but there are some interesting names in this list as well in today's session. Look at Bliss GVS Pharma is the top gainer on the BSE Small Cap Index. It's the biggest single day gain now, this 18% move that it has had since August of 2021. And it has seen over 1.5 crore shares already traded at this time of the day compared to its 20-day average of just 3.2 lakhs. So another volume-led mover. Foseco India is the other one, is the second straight day of gains. It was up 2% yesterday. It's up 12% today, and it has already seen 1 lakh shares already traded compared to a 20-day average, which is just 2,000 shares. So it's not a very liquid name, but still it's seen very strong volumes in today's session. Reddington is an earnings reaction. It's down almost 7% after the results, and it has declined already in 5 out of the last 6 trading sessions now, and it's close to 45 lakh shares already being traded compared to a 20-day average of just 12.5 lakh shares. So it's a volume-led mover. On the downside is Reddington India. Some of the others in this list is Pennar Industries, and that too is among the top losers on the small cap index today. It's declined in 3 out of the last 4 trading sessions, but it has delivered healthy returns to its shareholders every single year since 2020 in terms of positive annual returns. And I don't want to puncture the excitement around this name, but New India Assurance, of course, Yash just mentioned what is happening to the stock. But despite this 15% move, the stock is still down on a year-to-date basis. And ever since it listed in 2017, the stock has delivered negative annual returns every single year starting 2023. So it currently trades at around 200 rupees. The IPO price was 800 rupees. So it shows the value erosion here. Less free float, of course, as Prashant just mentioned, but there are some of the movers in today's session, most of them heavily volume led.
All right, Hormuz, thanks very much for that. Very, very sort of tight list of stocks that we need to keep on our radar. Deepak Shenoy is with us, founder Capital Mind. Deepak, good to have you with us here on the program. Thanks for joining us. Deepak, do you have a strong view on markets themselves? Generally, there is a sense of apathy. Earnings are coming through mid-cap. I mean, especially when you parse through specific stocks, there are some rockets out there, very strong numbers. But otherwise, overall, there is a sense that maybe, things are going to stay, just sideways for a while. The point is, if there's no real trigger, the direction of travel perhaps could be sideways to slightly lower. The last decent correction we had was started in September of 2024, and that was about 15% or so from the highs then. Could we see something like that?
Prashant, actually, it's been quite one of those challenging things. The market doesn't like to go down too much, despite a war, etc., etc., etc. But at the same time, you have, no good news seems to be taking up the market as well. So I think there's a bit of fatigue. Usually it happens during, there is a downturn, there is a bit of a consternation towards the last high, and until people are exhausted of both the selling and the buying, as long as that is there and there's no fresh triggers in place, markets generally don't, show their trend meaningfully. This is actually usually a very good time from an investor perspective, because when everything is uncertain, that's when you're getting some, cushion on valuations in certain either stocks or sectors or even in the broad market in certain categories. So you should always invest, or look to invest at a time when markets don't know where they're going, and then perhaps as trends form, then you can actually increase as time goes on. But I expect, another few months of this back and forth behavior to sustain, after which I think, we'll see a trend. I hope that trend, kind of comes in towards the end of the year.
By the way, those are Power Grid numbers on the screen. And first glance, they don't look too great. The top line is lower than estimates as well. The EBITDA figure that we were working with was around 9,600 crores. We'll just see what the company has done. Profitability is also slightly lower than estimates, and the stock is seeing a sharp slide now as we speak. So it's not been a very great quarter or good start to the year, at least it looks like, for Power Grid. Deepak, hi, good to be speaking with you. Since I'm just discussing the stock, I know you don't talk individual stocks anymore, but I mean, the reason why this stock has been liked by a lot of people in the market is that it's seen as a great way to play the whole power cycle, because while with generators there could be problems here and there and you decide whether renewable or thermal, the grid always needs investments, and you need a strong grid irrespective of what is the kind of power. And so therefore that disappointment is showing up on the stock now because the numbers are not that hot. Do you like power as a space? And if yes, where would you place your bets?
That's a good question, Surbi. I think the problem with power has been there are too many areas, right? There's the power producers, there's the transmission, there's the grid, there's the financing companies, and so on. By and large, we've found that power is going to be one of those sectors which will play a huge role going forward. And given India has got kind of a little more diversified in whether it is, the sources of power go from coal to as much as nuclear to natural gas and a couple of other places, solar, and the generation sources have changed. That needs a more robust grid, because solar is going to be very highly operating during the day, wind is going to be operative during certain seasons, so you need a grid to be more efficient. So grid companies by definition should be interesting, but I don't think they will be allowed to be ridiculously profitable. I mean, 80% profit margin is already ridiculously profitable. But I think overall, we should not expect that because they end up becoming a grid, that they will be allowed to make supernormal profits. That over time, their monopolies will force the government or other players to bring down margins to more manageable levels. And this, I would say, happens to pretty much anyone who has monopolies in any space, whether it's a stock exchange, a power exchange, or anything like that. Over time, things will change. So I think you have to have a spattering of investments in distribution, in transmission, in grid, in finance companies. And the power sector by itself is going to be a huge source of growth in the next coming years. I don't think you can bet on any one of these to say this will be the only place that will grow.
All right. Hi, Deepak. Good afternoon. Good to see you in. What about the large insurance company that you have been tracking, the government-owned one, the life insurer? I think you had a positive stance on that. Do you continue to hold on to a positive stance?
Yeah, I mean, of course, now we're in the mutual fund, talk individual investment. The PMS continues its investments. I think the life insurance space is relatively, has not grown as meaningfully as it should have. But I think whether it's a large public life insurance company or whether it's the private life insurance company, I think the idea is that the investment setup is set up to attract investments both from people who are going into life insurance as an investment and also the mutual fund space and the few other investment spaces there are. So primarily they will ride high on capturing more from the investment part of insurance. Unfortunately, that is significantly why people put money into insurance plans as well, that they want their money back. Whereas mostly in life insurance plans, you don't want your money back because that means you're dead. But in India, it's a different source of income. So I think as much as we've seen, more and more companies are moving towards non-participating policies. More and more companies are moving towards whether it is ULIPs or others. The scope of this remains interesting, but I haven't seen the growth yet. It will take, I think, another 4 or 5 years for this part of the sector to grow meaningfully. Though profit growth for some of the largest insurance company has been very robust. We've seen that 40 or 50,000 crore profit come in. It's just not translated to high dividends for shareholders or anything meaningful from an acquisition perspective yet. So let's see where that goes. I still think the sector has a lot to hold.
Deepak, thank you very much for joining in today. By the way, the two new listings, it's a tale of two cities. IndiCube Spaces is down nearly 8-9% as we speak. This is a company which provides flexible co-working space. And on the flip side, G&G Electronics, which basically sells refurbished computers, second-hand computers, they refurbish it and they sell it under the brand name of Electronics Bazaar, is having a pretty good session, 40% up and still counting. But let's get a handle on the futures and options space and the trends there. Mangalam joins in.
Well, the market's consolidating. The Nifty is mildly higher, but that's about it. It's just mildly higher, facing some sort of resistance as we move closer to that 24,900 mark. That's exactly what is taking place in the F&O space as well. So if you look at, the frontline indices, the Nifty and the Nifty Bank is the one which is struggling to cross paths is 50-day moving average. The mid-caps, by and large mixed. You have almost as many number of stocks which are advancing as the number of stocks which are declining. So if you look at the active options as we move towards the expiry session tomorrow, the 24,900 call, those writers are fairly active in today's trading session. But because there is some support that we are expecting, the 24,850 put writers are equally active as well. So 24,900 call, premium of 50 rupees, telling you that upwards of 24,950 as we move towards 25,000, there could be some sort of resistance. And at the lower level, the 24,850 put has a premium of 50 rupees as well. So between 24,800 to 24,900 is where the narrow range is what the street is anticipating that the Nifty could consolidate. Either move or a move on either side, or the way up or down, would determine where the trend moves in tomorrow's trading session. But more importantly, a large number of open interest is at the 25,000 call. So if the market sustains above the 50-day moving average for the Nifty, we could see some short covering. But speaking about the 50-day moving average, the Nifty Bank, the 50-day moving average is just about 200 points away from where that index is right now. So 56,376 is an important mark to conquer and stay above for any sort of up move. Through the day, a lot of stocks are in focus. The last hour or so in particular belong to D-Mart. The stock is zooming ahead, up around 7.5% on the back of aggressive commentary coming in from management in the analyst meet, and a lot of long positions being added on that one. And KPIT Tech reported its numbers. The stock zoomed ahead. A lot of shots were caught on the wrong side. So there is some short covering pop that one can see on KPIT Tech as well. So consolidation for the frontline index, but a lot of individual stock movers is the order of the day when it comes to F&O.
Thank you very much for that. And as we get into break, remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts, their impact on Indian businesses, giving you unparalleled insight. So tune in to CNBC-TV18 Prime every day, 12 noon for the Global Reset, and 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Well, keep an eye out on BEL. Ria's on that call and she's trying to get in further details. But as of now, we've got the initial commentary that's coming in there. The management says they're awaiting the request for proposal for quick reaction surface-to-air missile. And the fear was that it's going to be delayed. But now they're saying they're confident of receiving the order in Q4 FY26, and it may not slip into the next fiscal year, Q1. So, just keep an eye out on that one. We'll get some lines as well from the con call. That will flash for you on the screen. But we are having a green day. And it's time for D-Street Chatter. Nimesh joins us to tell us what is he picking up. Nimesh, how are you reading it?
Nigel, a decent pullback in the last couple of days, and we've been pointing out, right, every time when the PCR goes to 0.65 odd levels, you see a bit of a pullback for technical reason, but it pulls back, and that's what it is. Not much in terms of momentum. This market clearly lacks momentum now, largely on back of lack of institutional buying. Even today, the flows are quite mixed, is what I understand. Again, there are sharp reactions to earnings, and that's likely to continue. But I guess the bigger worry or the biggest concern for the market seems to be the Indo-US trade deal. That's something which we don't have a clarity on. Yeah. And I guess that's why the market is a bit nervous as well as to what's going to come there. From a sector point of view, I guess it's the PSUs which continue to outperform. Even today, I understand there is selective buying in the PSU basket. So that's the trend. But overall, there is lack of buying momentum. And that's why you're seeing a very range-bound trade for the last couple of days.
All right, interesting. But individual stocks continue to remain in focus. As you said, earnings reaction, stock-specific action. What are you picking up?
So in terms of individual names, the first on my list is Saurashtra Cement, something which Nigel tracks very closely. It's been buzzing in trade today. Big move, 11-12% up, large volumes as well. And the street is penciling or anticipating some corporate development very soon. So that's the first stock there. The second stock is Premier Energies. That's been buzzing post-earnings. But again, I understand the flows have resumed and there is buying interest from large institutions in premium energies today. So that's the reason why that's buzzing in trade. The third stock is Camlin Fine. It reacted very sharply on the downside in the last few weeks. But today, the stock is locked at 5% upper circuit. I understand the selling pressure from a leading PMS is largely over, and hence you've seen a bit of a reaction on the upside today. And the last name is AU Small Finance Bank. For the last couple of days, some bit of momentum has picked up. There is volumes as well and delivery-based buying. And I understand a leading domestic mutual fund has been a buyer of late in AU Small Finance Bank. So that explains a bit of uptake in that stock in the last few days.
Okay, interesting list, Nimesh. Thanks very much for that. So there is a bunch of stocks to keep an eye out on. Mitesh is back with us with what to buy or sell today for a reverse trade when we come back tomorrow. Mitesh, what do you have?
Prashant, Asian Paints, I've been liking the stock since last few days. The stock has completed a correction and is now, getting into some kind of a bounce back mode, if not starting of an uptrend. So Asian Paints is a BTST for me. Take a stop loss of roughly around 2400 and look for target in excess of 2450. And L&T, I think, very clearly good numbers and the price reaction is good as well. So L&T is something which should gain in the coming few days. So BTST here as well. Keep a stop at 3655. Look for targets of 3685.90.
All right, got that. Well, before we get to Tata Steel, just a quick word on Saurashtra Cement, which Nimesh spoke about. They have a plant located in Gujarat. Rough capacity is around 2.8 million tons. Why is this asset good more than anything? It's got good limestone. So, whoever is the candidate, in case someone is looking at it, well, that's going to be, the big selling point. And also on a rough EV per ton, it trades at around $55 to $60 per ton, even a little bit lower actually than that. So just did a rough math on that particular asset. As Nimesh says, Street is anticipating something for the time being, large volumes, stock bursting away. Let's focus on the number that I'm going to be tracking later this evening. Tata Steel. The numbers are going to be important, but commentary is going to be even more important. Top line, there'll be a degrowth because volumes have been a little bit softish and pricing as well on a year-on-year basis have been soft. However, EBITDA number will be do better because there'll be a recovery in profitability in Europe as well as in India. So margins will improve. Let's run you through the key factors. For the India business, well, volumes will be down because they had a maintenance shutdown and also exports were curtailed in the past quarter. However, the realizations will improve by around 2,500 rupees per ton, particularly on flats, which they have a fair bit of exposure out there. Input costs will decline as well. Coking coal costs should come down by close to around $10 per ton. So put this together, the India EBITDA per ton will come in the ballpark 14,500 rupees per ton. Europe, well, it'll continue to struggle, but at least it'll start moving towards the break-even line. For Europe, Netherlands will give you a better EBITDA per ton, maybe around $40 per ton, while the UK business will continue to struggle, though there'll be a lot of fixed cost reduction out there. So put the piece together, that's Europe as well as UK as well as Netherlands, put it together, Europe could deliver a minus $5 per ton to a plus $5 per ton. That's the broad range. We'll also keep an eye on commentary, demand, pricing, debt reduction. Those numbers due, I think, by around 6:30 to 7 p.m. later this evening. But the other one that we'll be getting, far sooner than that is Interglobe Aviation. Vinny joins us to give us a quick preview. Vinny.
Hi, so for Interglobe Aviation, also we are expecting a weak set of numbers in Q1 FY26 this time. The revenue growth expected at 8%, EBITDA margin 8% growth on a year-on-year basis, while EBITDA margin, that is also EBITDA, we are expecting a 6% growth. Now in terms of yields, they are expected to come in at 5.11 rupees per kilometer, which is a decline from what we saw in the last year, 5.24. What are the factors impacting the numbers this time? We'll see the impact of India-Pakistan border issues. The other one is going to be of the plane crash that took place in Ahmedabad. That was an issue. Other than that, Middle East geopolitical tensions and developments and rerouting of flights, that also became a concern for the company. So 3 major issues that came in during the quarter. Now, obviously, what we're watching out for is going to be in terms of the net profit, because that is expected to see a decline versus last quarter. You would see that decline. Why? Because Pratt & Whitney compensation, that is going to be lower now from this quarter and onwards. There was tepid demand, so overall some bit of a subdued performance because of that as well. And key factors that we'll be keeping an eye out on, update in terms of geopolitical tensions, what are the demand trends, air traffic data points, as well as in terms of air ticket prices as well. Other than that, aircraft on ground will be key to watch out for. They brought it down significantly. Now, what is the target for FY26 will be a key factor to watch out for. And the performance of their business class as well as the loyalty program will be an important factor. And international expansion plans is also a key for Interglobe Aviation.
Okay, all right, Vinny, thank you very much for that. Numbers later today. So Tata Steel and Interglobe. I mean, we've had, 10 numbers since we started 2:30 closing bell. Just a flood of earnings coming through. We take a break here. We are back. More market conversation on the other side. Stay tuned.
Welcome back. Well, the markets are trading with a gain of just around 30 points or thereabouts. Number of stocks advancing, a little more than the number of stocks declining. But a couple of stocks actually are doing well. We had Welspun Corp. The numbers look quite good. The con call as well. The management is indicating that they can probably supersede their guidance. And the other one is Hind Rectifiers. We're talking about a market that's not doing much. That stock is up close to 30% in 2 days. Mayuresh Joshi of Market Smith India joins in on the show. Hi, Mayuresh. What do you make of this one, Hind Rectifier? I think you have a view. I recall covering the stock and, explaining it to our viewers for purely educational purpose at around 200 crores. Boy, oh boy, today it's around 2,500, 2,600 crores. And it seems they're promising and delivering those numbers as well. But it's not cheap at all. Your take?
Afternoon, Nigel. No, absolutely. I think the kind of moves that the stock has delivered is prima facie based on numbers. And therefore, if you look at this quarter's numbers also, I think the top line growth was steady state. Margin performance, whether you call year on year or quarter on quarter, from 10.7, 10.8, the margins have come in at 11.3 odd percent. And again, the order book is steady state at 1,025 odd crores. Obviously, I think the line of businesses that they are into, railway transformers, is largely a large component of their business, contributing 58%. You then got the railway electromechanicals, which is almost 21%, and then the railway electronic part. So I think a large part of the railway orders that probably come through, and the super specialization that Hind Rectifier probably has, is working wonders for them. Obviously, I think in terms of expectations of numbers going forward, with the execution of their order book, with the expectations of benign input costs, margin should be steady state. But you're absolutely right, Nigel. From a valuation perspective, on a price to book, I think it is very, very expensive. On a price to earnings ratio, very, very expensive as well. And it doesn't give that many dividends. So I think the entire premise that one really bases their argument on in terms of superlative earnings growth, that might continue, but valuations still remain way too high for this.
Okay, got that. Stay on. We just want to quickly talk about the rupee, which is now at a 4-month low. Lata is joining us with more. Lata?
Well, it has been a rather sharp fall. Rupee has been one of the worst performing currencies for a month now. And today it is again the worst performing currency, about 0.75% lower. We rarely see a 1% fall of the rupee. It's almost there. And other currencies have also fallen. But, the Thai baht and the Korean won are all about 0.3, 0.4. This is a sharp one. And that's obviously the mix of events. Crude prices going to $72, dollar index up about 0.3. It's at its highest since June 23rd. These factors are contributing, but the bigger factor really is this incessant, relentless foreign portfolio investors selling. And they are selling not just equities, a point which the equity market doesn't notice. There has been incessant selling in bonds as well. And that has only worsened. Even on the trade front, there is a bit of a worry whether the trade deal will come or not. And added to that, our services exports, which are doing very well, have just lost a little bit of sheen because of what the IT companies are telling us and the kind of results they are reporting. So kind of forward outlook of the currency also is getting a bit of the sheen going off. And, there is again a bond sell-off on fears that the Reserve Bank policy may not be all that dovish and it may not be worth buying bonds at this point in time. So it's just a perfect storm that's going for the rupee, and it doesn't look like the storm has blown over.
Absolutely, that FPI point is well taken, Lata. Thanks for joining in. 14,000 crores of selling in July now. That's what we've seen so far. Okay, let's quickly, do we have time for a question with Mayuresh? Yeah, I think we can quickly squeeze in a question. Mayuresh, some IT stocks are managing to spike like a KPIT Tech and, otherwise it's been a washout season. Are you being a contrarian and buying anything in IT?
Afternoon, Surabhi. No, again, I think a couple of names that we continue holding in our global portfolios are Emphasis and Coforge. Our own sense is that largely the result season for IT has been very, very disappointing along with commentaries. But I think both these companies gave decent set of numbers. And again, I think the kind of work specifically that Emphasis is probably doing when it comes to AI, which obviously has become a huge buzzword, they have been investing in specific domains over the last few quarters, and their investments are actually started to pay off. And therefore, I think, in my opinion, emphasis is something where our belief is that earnings can still continue holding out very, very strongly, even in the next few quarters. A large part of the pool in terms of the earnings matrix will probably come through not just from existing clients, from client mining that they're probably doing in new geographical areas as well. So I think expensive stock, but again, one stock that we continue holding in our global portfolios.
By the way, Mayuresh, just coming to you, just a quick tease out, right? In a short while, my colleague Shireen will be in a conversation with Salil Parekh, top boss at Infosys. So that's coming up in a few minutes from now, 4 minutes or so, and counting down. That's a conversation you don't want to miss. IT. It's all about IT and what's happening in terms of the future, AI, jobs, everything. So that's a conversation which will come up in just a bit from now. Mayuresh is with us. Mayuresh, the other sector I want to just quickly talk about is chemicals, right? And second day running, big move. I'm not sure if this is regards to China announcing cuts in capacity, but it's a whole new set. Zuari, Coromandel, Sumitomo, Vishnu Chemicals, IOL, a stock like Epigral, which is up 7-8%, Vishnu Chemicals, and I could go on. 2 days is running now.
Absolutely, Prashant. And I think it's a combination of both the factors put together. One, I think the news related to the Chinese part, which probably has given a fillip to these stocks. But again, I think better monsoons this time around and expectations of better throughput coming both in terms of volume offtake as well as farm gate prices remaining strong with input costs remaining benign. I think that's a good combination to have if you're probably looking at better operating performance. Now, with better monsoons, the expectation is largely that even the Rabi season can be better off as well. And therefore, the next few quarters for agrochemical companies might be better off as we speak. And therefore, this is one space that we have remained extremely constructive on at Markets with India. Stocks like Coromandel, Deepak, Paradeep is something that we continue holding in our global portfolios. Our own sense is that volumes, steady state margins should show steady state improvement as well going forward. And therefore, reported earnings should probably be better off in the coming few quarters as well. So yeah, remain constructive on agrochemicals.
30 seconds response slightly unfair, but M&M will report shortly. Indigo will report post-market hours. Any thoughts on these two?
So continue remaining constructive on M&M. I think the expectation largely is that there should be steady state volume growth, specifically in their key domain of SUVs. The tractor segment should probably hold up as well, again, with better monsoons holding up. And therefore, the consolidated performance should be better off. So again, from a compliance perspective and a disclosure perspective, M&M and Hyundai India is something that we continue holding.
Okay, all right, Mayuresh, thank you very much for that. Let's quickly wind down what's been another quiet day of trade, very range-bound. The Nifty finally going home with a gain of just around 25 to 26 odd points. Today's winners definitely included an L&T. Actually, not just L&T, even beyond the index, the numbers from GE, Vernova, T&D inspired a lot of confidence. It's pulled up a lot of the MNC capex stocks up with it. Siemens Energy, Hitachi Energy, Schneider Electric, all of these stocks are up between 5 and 6%. So that whole industrials complex was looking good in the market today. Beyond that, some buying in Sun Pharma, Tata Consumer, NTPC up about 1% after reporting numbers. Maruti Suzuki and Trent, these were some of the other key gainers. No clear trends on the financial side today. Some of them like IndusInd Bank, Shriram Finance, Kotak, they were all lower. The weakest stock of the day was Tata Motors, 3.5%. Street a little nervous ahead of what could be a big Italian acquisition for the company. Prashant.
Well, I would say it's a neither here nor there kind of a close, 25 points. So if you're looking for direction off of this session today, you won't find very much. But have to say that broader markets, doing their own thing. Lots of it, of course, is results, but there are some themes which are doing well. Chemicals, I think, we spotted yesterday, and that kind of sort of continues to run today as well. New India, by the way, was the top volume traded name today. On the NSE, and there's 5% float in New India. So just quite incredible. It'll be interesting to see number of shares traded relative to the float out there in the market. Should be pretty high compared to anything else out there. DMart and a few others doing pretty well as well. So that's essentially the market today. Didn't really go anywhere. Just under 25,000 is where we left off, and that's an important technical level that we've been sort of highlighting as well. As promised, let's now toss across to Shireen Bhan, who is in an exclusive conversation with Infosys' CEO Salil Parekh. Shireen, over to you.
Well, this is the big story this week. The Indian IT industry is again at an inflection point. There are new opportunities, but there are also challenges in the form of AI. Infosys is the only major IT company in India to report revenue growth in the first quarter, and I'm talking about the Big Five. Infosys saw sequential growth of 2.6% in constant currency terms. All other tech companies in the Big Five saw their sales contract. Growth is moderating across the sector after a sharp surge fueled by the pandemic. Employee strength at India's top IT companies also been on the decline. TCS, meanwhile, has announced 12,000 job cuts, the largest that the industry has seen so far this year. IT industry body NASSCOM has warned of more potential job cuts, citing the shift away from traditional service delivery to more product-aligned delivery models. Industry body NASSCOM says, and I quote, "In the near term, this shift may lead to some workforce rationalization as traditional skill sets are re-evaluated," end of quote. Well, joining me now to discuss the growth blueprint for Infosys and the future of the Indian IT industry is Salil Parekh, the CEO of Infosys. Salil, always a pleasure. Many thanks for joining us here on CNBC-TV18. I can't help but start by asking you about the questions that are being raised about the Indian IT services model. We've just seen TCS announce job cuts of 12,000 at this point in time. NASSCOM, as I just pointed out, has talked about rationalization as far as workforce is concerned. What is the problem, Salil? And are you also starting to see some of this trickle into the workforce at Infosys? Will you also be looking at job cuts, job rationalization as well?
So thanks, Shireen, for having me here. It's always good to be on this program. With respect to what we are seeing, last week we announced our results. As you shared, we had growth in the quarter, we had growth year on year. We had strong growth, for example, in financial services, in manufacturing, energy utilities segment that we have. We had good growth in Europe. We had very strong large deals at $3.8 billion, one mega deal as well. And what we see, all of that is coming from, first, there's a strong attention to AI. And there, Infosys has built over the last several years a very strong approach into AI. Today, we have 300 agents which are doing work within our clients. So that gave us a good traction. Second, to do AI well for large companies, there are two big foundational elements. One is data and one is cloud. And both of those are areas where we have tremendous strength. We saw very good growth, for example, on the cloud side. Then what we saw is a lot of clients are selecting Infosys as they go through consolidation decisions. So all of that gave us a good traction and gave us the growth with which we increased our growth guidance for the full year. In terms of recruitment, we had a strong recruitment in the first quarter, over 17,000 employees, both lateral and from colleges. And our plan for the full year is to recruit 20,000 college graduates, and that continues. So all of that is giving us a good view into what is going on, and we continue to see all of that change reflected in how Infosys and clients are working. Some of these things we started quite early, our attention to AI, what we've done with large deals. We also work very closely on programs which are mid-size and small, and of course our attention internally to become more efficient on cost.
Salil, thanks for articulating the many measures that you've taken, but I just want to understand if you believe that Infosys finds itself insulated from the pain that your peers are talking about. And to my point about rationalization, you said that you are recruiting. You recruited 17,000 people in Q1, and you're on target, at least at this point in time, to recruit 20,000 college graduates. So while the recruitment continues, is there any effort or any attempt at any effort to look at rationalization on the back of perhaps a skills mismatch or a supply-demand mismatch or more use of AI within the organization?
So there, Shri, there's a couple of elements. So first, our utilization is running at a good level. And with that, we see that all of the people that are joining us are getting deployed on projects. I mean, joining us from college, getting trained, getting deployed on projects, and the people across the whole company at that high level of utilization. On AI, we see two different components to it. So one, we see where there are growth elements. Ones we talked about on data, cloud, which are supporting, and then AI itself, where we see some new type of work that comes in with AI. And the second is where we see productivity, which comes from AI, which gives us more efficiency in doing the work we were doing in the past. When we put all of this together, what we understand from the market today is there is overall expansion in the addressable market, and that gives us a good traction. In addition, we are seeing a good activity with our clients on enterprise solutions. So those solutions where we have very strong skills, we see quite a strong demand, and those continue to roll out. We see good recruitment, good utilization in that. And then what I shared earlier, we see where we are getting benefits of some consolidation decisions that our clients are making. So when we put all of that together, we see that the reskilling that we've started with AI earlier with digital is what is helping us and making sure that our people are getting deployed at a high utilization level.
So Salil, and I come back to the point that perhaps TCS is dealing with some specific issues, but NASSCOM represents the industry. NASSCOM doesn't represent a specific company. Now, NASSCOM's statement talks about workforce rationalization. So I'm just trying to understand where this dissonance seems to be coming from, because you're saying that you don't see that at this point in time. You don't feel that there is going to be a need for Infosys specifically to rationalize. In fact, you believe you're on course to continue with your recruitment plan. So I'm trying to understand where this dissonance is coming from. Were you surprised with the NASSCOM statement?
So there, Shireen, I don't know, what some of the other points of view are. What I was more sort of focused on was where we see what we see within Infosys and within the clients we are working with. And that's some of the information or data that I was sharing. And that's the approach that we are taking, making sure that we support our clients. My sense is we've also started, working on some of these areas quite a while ago. For example, on AI, we've taken a view to make everything inside Infosys AI first. We've built a small language model in financial services. We built 4 different small language models, one horizontal one on IT operations. We're working with most of the major foundation models in supporting our clients. So some of that work has started quite early. But to your point, I'm not sure where some of the other statements outside of Infosys are from.
So let me address some of those other statements, Salil. And the big statement that seems to be cutting across different voices is that there is an existential crisis that faces the Indian IT services model again. I go back to a conversation that your former peer, CP Gurnani, who headed Tech Mahindra, had with us on the channel a few days ago. And he used that Sholay dialogue, says that the model of kitne aadmi hai, that era is over for Indian IT services companies. How do you respond to both? One, that this has largely been linear, man-driven, man-hour-driven model. And two, the fact that this is perhaps an existential moment for the Indian IT services industry.
So there, the way we are seeing this Again, a little bit from the Infosys lens initially. Large companies, large organizations worldwide are more and more using technology. So with enterprise AI, that's becoming even more prevalent. The previous cycle, where we've discussed several times over the past years, was more focused on digital. Today, it's more focused on AI. My sense is technology, as it becomes more central with large companies and with the large, complex technology ecosystems that they have within these large enterprises, becomes more and more important. And Infosys, who has, like, we have a depth in the industry. So you take an industry banking, you take an industry utilities, you take an industry telco. We have a depth in understanding how that industry works, and we have a depth in technology. We bring those together for the benefit of our clients. So with that technology change, with the way that we are driving technology usage within Infosys for the benefit of our clients, I see that continuing to be a good outlook for Infosys with the changes in technology. That's the approach we've taken. That's the approach that we believe remains important for the global enterprises. And that's how we see today, at least what we saw in terms of what we shared last week in the first quarter, what we saw, the growth, what we saw in financial services, in manufacturing. That's the approach that we are looking at, Shri.
Salil, you talked about some of the work that's being done on AI, the 300 agents that are already working at Infosys. You talked about the small language models that you've been able to develop as well. One of the other comments, criticisms that's come in is that Indian IT companies are focused too much on buybacks, and capital should be deployed more on R&D and innovation. Do you believe that given the changes that we are faced with globally at this point in time, that there is perhaps a need to review your capital allocation strategy or capital allocation policy and perhaps do more internally as well, but also look at big ticket or small ticket acquisitions to bolster your AI capabilities?
So there, I think first on acquisitions, without a doubt, we have always have a view onto what type of acquisitions we want to look at. And AI is very much into that strategic domain where we will continue to look. And as we've done, if you look over the past several years, we've done acquisitions that have helped us in advance. For example, we did some acquisitions on SaaS models. We did some acquisitions on engineering services. We recently did an acquisition on cybersecurity. So in that light, AI is part of it. We continue to look at it. In terms of overall capital allocation, the point you made, what we see is what I was sharing earlier with clients looking to us for technology and where that is going. We've then made several investments in reskilling all of our people. So about 275,000 people have been reskilled within Infosys into different levels of AI. We've put investment into building what we were describing, what we were discussing, these small language models. We put investment. We are one of the largest users of GitHub Copilot. We made sure that that is being used to actually develop lines of code which are accepted and used by our clients and internally. For our own product in Finacle, we've used investments to make sure it's more AI ready. And we've been very focused on internal cost and efficiency to make sure that those investments are done while keeping in mind all of our stakeholders and what they are looking for and what we are providing to them. Keeping all that in mind is where we are driving the business within Infosys.
Okay, so you don't see a need to change the way that you allocate capital at this point in time?
So their capital allocation approach, where we return 85% of the capital cash that we generate over a 5-year period, remains what it is. However, we do have an approach within that capital allocation policy of the acquisitions that we talked about, that we discussed earlier.
So Salil, you know, I just want to go back to the headcount comment that came in there from CP Gurnani. Your headcount is down over 12,000 over the last 2 years. Your headcount now stands at about 3.23 lakh at this point. Would it be fair to assume that this is the kind of number that you're going to be working with in the foreseeable future? You gave us some indication of your recruitment plans staying on track, and you also said that you're not looking at rationalizing your workforce at this point. Would it be fair to assume that this is the kind of headcount number that we would be looking at for Infosys in the foreseeable future, the current headcount of about 3.23 lakh?
So there, what I can share with you is, if you look at about a year ago, so end of the first quarter a year ago, which is about the same time like now, we are about approximately 8,000 more employees than we were at that time. Now, again, for this year, we have a growth guidance of 1 to 3%. And with our recruitment, we will continue with the recruitment in support of that growth guidance. One of the other things, in addition to the 8,000 approximately higher headcount that we have from 12 months ago, is we have also improved what we do in terms of revenue efficiency per employee. So those two elements together will continue. Here, with the growth that we're looking at for this year, and we look, as you know, on an annual basis, we will continue with the recruitment, which will support the growth.
You know, I want to talk about the constant currency growth that we've seen, Salil. And while we've often talked about when do we go back to double-digit numbers, growth numbers, is there now, do we need to rework the growth expectations for the sector? Are we in a structural low growth era where even high single digits are going to be a challenge?
So again, I don't have a sort of view on the industry, but as we see the outlook, there were areas of good traction that I was sharing. And then there's the overall macro as we look at what goes on in the various markets that we operate in the US, Europe, Asia Pacific. And there, what we see is from where we were a quarter ago, there have been changes in the economic growth outlook. As that evolves over time, we see large companies are ready and keen to invest in more technology to make changes. And as that happens, we will see for us and our clients more work that Infosys will do. Today, we also see many of our clients quite focused on cost and efficiency, and that's some of the types of projects we're doing. Yeah. This is something that we've seen before. If you sort of look back at some of the things we've seen over the past few years, as that economic growth environment changes, we see more and more attention to for clients, large companies, to make investments in technology, which help them to be participating into that growth. And that's typically what we anticipate will happen as the cycles change.
you're talking about the cycle changing and some of this tariff uncertainty, etc., playing itself out of the system. At the start of the year in January, Salil, you were anticipating, quote unquote, in your words, a demand explosion. And of course, the macros changed. But as you look at the cycle today, what are you hearing from your clients? How much of the tech budgets are underutilized? How much of the tech budgets have not been spent? Are you anticipating, as this cycle, in your words, turns, that there could perhaps be a revenue bump up in FY27 as they get off pause mode?
So FY27, I won't comment on, but absolutely last several weeks before, I was with clients in our US markets, in our European markets. We see there's an interest in the new technology that is focused around AI to get the most benefit from AI. Most of the clients will need strong data foundation, cloud foundation, and there's a very good appetite for that. My sense is there is an interest in that spend as large companies understand how the macro impacts them, how their business gets impacted by it. They will have that interest to put more into large technology programs. And at that same time, there's attention on cost and efficiency which goes on. So that's the way we look at it. Again, without having a specific point on FY27.
No, fair enough. But, I also want to understand, we talked about growth, and I also want to understand about margins, Salil, because, the guidance is about 20 to 22%, and you've had this Project Maximus in place now for the last 2 years, pretty much. But we haven't really seen the needle move too much on account of the many measures that you've taken. So is there scope, is there room for you to be able to eke out more to boost margins any further?
So on the margins, we've put in place a very strong program. What that has helped us to do, and we started that quite early, it's helped us to be ready for what turned out to be a changing environment. It also helped us to make sure that we could continue to make the investments that we have made as we scaled up AI, as we scaled up cloud, as we scaled up data, cyber, engineering services, enterprise solutions. So all of that needs investment, building the small language models. And we were able to do that while making sure that we delivered the margins which we had given as our guidance, and as we wanted to be, make sure that all the stakeholders were benefiting from that.
Salil, I'm going to try and get you to respond in yes and no, and I'm going to throw back to you again comments that have come to us from various quarters, from other CEOs that we've been speaking to. So to start with, do you see this as an existential crisis for the Indian IT services sector? Yes or no?
So, Shireen, my view there is, and I know you want that type of an answer, but my view is technology is becoming more and more critical for clients. AI is more critical. Infosys has invested and built out AI capabilities and other like supporting capabilities, data, cloud, and that becomes important for clients. And for us, we remain well positioned to support our clients.
So my second question then, and again, this is on the back of comments that have come in, concerns on whether this AI wave could lead to a white-collar bloodbath. Do you believe that to be the case?
On AI, again, what we see are two sort of components to it. There's one where we see more work coming in some of the areas we've discussed, and also AI itself helping to do newer types of more detailed analysis. For example, we've talked in the past about examples on credit risk analysis and so on. So more work in the foundation, more work in the AI. That's sort of one component. Another component is there are productivity benefits that come because of AI, which tend to have ways of making things more efficient. As we put all of this together, today what we understand from the market, from external sources, is the overall addressable element of that market is growing. So my sense is with AI, we see more and more work, but keeping in mind both of these trends. Now, AI also is changing very fast. So every day there are new updates, developments, foundation models, and we have to keep pace as Infosys with that to make sure that we are keeping track of both of these components.
Since you talked about AI, the productivity uplift as well, from a client's perspective and from your perspective, do you believe that AI is likely to be deflationary? That's one of the other comments, stroke concerns that we've been hearing of. What could the impact be as far as pricing is concerned?
So two parts. I think on the first part, I go back to how I was sharing. There are two components of AI as a composite. The sense we have today from the market from what we understand, that there is a larger addressable market. And we have to make sure that we keep up with that to do more of the new work and to make sure we get the benefits of efficiency. On the pricing, depending on the type of area that one is focused on. For example, if there's work which is more focused on customer service, the productivity benefit that typically is available there, that is usually shared with our client. And so there, what was being done previously, there is an efficiency to that comes in. Typically, we've seen in many examples, either it's new work that we have won from somewhere else, or we are beneficiaries of consolidation. But if you look at a specific area like customer service or other areas, there is a sharing of some of the productivity benefit.
Okay, a sharing of some of the productivity benefits, which means that you don't exercise as much pricing power as you previously did.
So yeah, there is a sharing of the productivity benefit.
Okay, you talked about a mega deal. You also talked about the large deals that you won. What is the expectation, since you talked about the expansion that you foresee on both mega as well as large deals, and the fact that you hope the macros will stabilize, if not normalize?
So on the macros, so it's not so much in terms of a hope, it's more a point of how it will evolve, and we will watch how it evolves. On the large deals, we had an excellent first quarter at $3.8 billion, a very strong execution on large deals. Some of it, actually, we benefited from consolidation decisions of clients. We see large deals is always a little volatile because they are lumpy, but we see the large deals activity fairly strong. We had one mega deal in Q1. Mega deals are few typically in a pipeline, but we do see mega deals in our pipeline. So overall, the large deals approach will continue with usual sort of what we see. There's always volatility, but if you look at a longer period than a quarter, we should see good traction on large deals.
So, Salil, let me end by asking you, given where you find yourselves today and the measures that you've already taken, you don't see the need for any significant change, redesign, reinvention within Infosys at this point in time? And two, from what I'm hearing from you, would it be fair to say that you're fairly sanguine about growth as well as where you find yourself? You don't sound particularly perturbed or worried. Is that a fair assessment?
On the first, I think the changes are some things that we've put in some time ago with the attention on AI, with the attention on some of the new areas on cloud. And we have to continue to do that. It's not that we don't have to do that. However, we see technologies being more and more critical for large enterprises, and we need to be on top of it. Equally, also some of the things we've started earlier, for example, on the measures of internal cost efficiency, so we remain constantly efficient. In terms of what we see for this year, we have increased our growth guidance now 1 to 3%. And what we see today, for example, as we closed and announced our results last week, we see that's the growth guidance for this year, which will support that we will do this for college graduates, the 20,000 recruitment for this financial year.
I know it's hard to get you to move away from either the quarter or the year or your guidance, but we do appreciate you joining us, Salil, and giving us an insight on where things currently stand for Infosys, but also how you view what is happening for the industry and the many changes that the Indian IT services sector will have to brace itself for. Appreciate you joining us here on the record on CNBC TV18. Many thanks for your time. That's Salil Parikh, the CEO of Infosys, in conversation with us. Believes that there is going to be more opportunity while they continue to focus on cost optimization and cost efficiency, but they're also hopeful that as the macros stabilize at the enterprise level, there will be more expansion of opportunities. A key point being made there on both utilization, which continues to be strong, as well as consolidation. So Infosys winning business perhaps from some of its peers as well. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more. Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. President Trump keeps India on the edge even as the 1st August tariff deadline draws closer. Tells reporters on board Air Force One that India could face up to 25% tariffs in the absence of the deal. Range-bound trade on Dalal Street. The Nifty ends above the 24,800 mark as IT FMCG lead from the front. The rupee touches a 5-month low on the back of a costlier oil and stronger dollar index. The US Federal Reserve is largely expected to maintain a status quo as it announces its rate decision later tonight. However, investors will keenly await Powell's statement for hints on the central bank's future monetary policy. Global markets tread with caution. Infosys CEO Salil Parekh says that artificial intelligence is helping expand the overall market, adds the company is well positioned, remains on the lookout for AI acquisitions, lays out plans to recruit 20,000 graduates across FY26, says there's no change in the company's capital allocation policy. Tata Motors likely to acquire Italian commercial vehicle maker Iveco Group from the Agnelli family, which owns Fiat and Ferrari. Sources say the deal is likely to be valued at $4.5 billion, making it the biggest acquisition for the company and the second biggest for the Tata Group after Chorus. French automation giant Schneider Electric will buy Temesex's 35% stake in the unlisted India joint venture to reach full ownership, calls the all-cash $5.5 billion deal the next logical step in its strategic focus on India. Microsoft restores services to Nayara Energy backed by Russia's Rosneft after it moved the Delhi High Court. Nayara alleged corporate overreach and argued Microsoft is not bound by Europe's sanctions on Russia. Nayara withdraws the petition after Microsoft restored services. Tsunami waves reached the shores of California after a strong earthquake jolts Russia's Far East. Evacuation orders issued across the Pacific, including the coast of Japan, Russia and the US. The 8.8 magnitude earthquake is the largest in 14 years. At least 154 Palestinians have starved to death in the last few months, according to officials in Gaza. 21 people killed overnight as Israeli bombing continues. The death toll in Gaza crosses 60,000. Britain will recognize Palestinian state by September if Israel does not end the war in Gaza. For the top story this evening, President Trump keeping India on the edge as the 1st of August tariff deadline draws closer. Now, during a press gaggle on board Air Force One, President Trump said that India could face tariffs of up to 25% in the absence of a trade deal. Trump also denied the finalization of any deal with New Delhi. Along with India, Bangladesh, South Korea, Malaysia, Cambodia and Thailand are yet to strike a deal with the US. Meanwhile, Treasury Secretary Scott Bessent reiterated that the administration is in no hurry to sign trade deals. Speaking to CNBC, Bessent added that Washington is more concerned about the quality of the deal than the timing. Take a look.
India is preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be for India?
They are going to pay 25%.
Yeah, that India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so. Look, India's they're my friends, and he's my friend.
Is the deal with India finalized?
No, it's not.
Okay. So what rate are you expecting?
Well, we're going to see. But India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and you just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
Now the price of a deal with the United States of America is black and white, completely open markets. He wants to make sure that Americans can sell their goods overseas. He's tired of all those years where it was unfair and asymmetric against us. He wants to right the wrong of the last 80 years of trade policy, and he wants to do it now, and that's what he's doing. So are there deals on the table for him to consider? Yes, but he knows that he can just set the rate and set the price and move on. And he said that over and over again. We put in front of him the deal, he sees the deal, and he decides, do I want to do a deal with India or I don't?
Well, President Trump will decide whether the U.S. wants to do a deal with India or not at this point. The 1st of August deadline almost here. Now, top officials from the U.S. and China, meanwhile, have concluded a two-day meeting in Sweden. but without any major breakthrough on the tariff front. Both nations have agreed to work towards extending the 90-day tariff truce. However, the U.S. Treasury Secretary has said that the U.S. President will have the final say on all pending trade agreements as well as the tariff truce. But let's talk about the day's market action. The Sensex and the Nifty outperforming the broader markets after a range-bound session today. Midcaps closing in the red, while the Nifty bank fell over 70 points. That's the story there, 143 points higher. On the Sensex, a flat close, but nevertheless in the green. Midcaps down just about in the red. Prashant is standing by to wrap up the market action for us. Prashant.
The follow-up that you would have expected, the market ending about 30, 40 odd points higher, but not bad. I mean, could not, the 25,000 mark technically is important for the index to close above. That could not happen, but it's neither here nor there. So that's the kind of close we had. But all about individual sort of names and a flood of earnings-led reactions coming through. But the indices, Nifty Bank, mid and small caps also did not do very much at all, sideways for the most parts. I'll start with large caps. L&T was the big one, 5% outsized move after strong numbers. Sun Pharma was up about 1.5%. NTPC, Maruti and Tata Consumer were the other 1% plus gains today. On the downside, you had Tata Motors, which was down 3.5%. We've been, of course, telling you the reason why throughout the session. Hero MotoCorp was down 2%, and there was Bajaj, which was down about 1% as well. So, between the top gainer or the loser and the number 2, number 3, number 4, big difference both on the upside and the downside as well. In the broader space, advances still outnumbered declines by a sliver. So New India Assurance, I mean, where do you see this, right? 18%, but that's not the story. Number 1 volume-led gainer on the NSE today, and there's only 5% float in the market for New India. And so humongous volumes, relatively speaking. D-Mart, 7%. There was Hitachi, which was up 5%. Zuari, big move yesterday, big move today. Godfrey Phillips was up 5%. Coromandel was up 6.5%. Sumitomo Chemicals was up 8%. Vishnu Chemicals, 10%. And, this is a theme that we highlighted yesterday as well. Chemicals, 8, 9, 10 of these chemical names. Some common, some new. But 2-day running now, this is a theme which actually has been doing very, very well. I could go on, Jubilant Pharma, IOL, etc., etc. So this entire space really buzzing with action. On the downside, Vimta Labs has had a one-way move last 3 days, lost about 8% today. Birla Corp was down 10%. Reddington, Motherson Sumi, Punjab Chemicals, another name, big move yesterday, lost. 5-Star was down 6%. Northern Arc was down about 4%. Moil, and so on and so forth. So enough on both sides. As I said, a little, the advances outnumbering declines by just a little bit. So that's the market action. Not bad, but neither here nor there if you're looking for a directional cue based off what happened today.
Prashant, many thanks. Let's talk about the U.S. Fed. It is set to announce its monetary policy decision later tonight. Fed Chair Jerome Powell and his colleagues have signaled that they favor maintaining a wait-and-see approach at this week's meeting. However, 2 Trump-appointed Fed governors, Christopher Waller and Michelle Bowman, are potential no votes on keeping rates unchanged. If this happens, it will be the first time in over 30 years that more than one governor voted against the Fed chair. Respondents to CNBC's Fed survey don't expect a rate cut. However, 65% anticipate a cut in September. Let's talk about the currency markets now. The rupee falling to a 5-month low today versus the dollar on a slight uptick in global crude prices and incessant selling by foreign funds. The rupee has fallen by 0.7% today to levels last seen on the 9th of April. Lata standing by with more. Lata, a rather sharp fall.
Well, it has been a rather sharp fall. Rupee has been one of the worst performing currencies for a month now. And today it is, again, the worst performing currency, about 0.75% lower. We rarely see a 1% fall in the rupee. It's almost there. And other currencies have also fallen. But, the Thai baht and the Korean won are all about 0.3, 0.4. This is a sharp one. And that's obviously the mix of events. Crude prices going to $72. Dollar index up about 0.3. It's at its highest since June 23rd. These factors are contributing, but the bigger factor really is this incessant, relentless foreign portfolio investors selling. And they are selling not just equities, a point which the equity market doesn't notice. There has been incessant selling in bonds as well. And that has only worsened. Even on the trade front, there is a bit of a worry whether the trade deal will come or not. And added to that, our services exports, which are doing very well, have just lost a little bit of sheen because of what the IT companies are telling us and the kind of results they are reporting. So kind of forward outlook of the currency also is getting a bit of the sheen going off. And, there is again a bond sell-off on fears that the Reserve Bank policy may not be all that dovish and it may not be worth buying bonds at this point in time. So it's just a perfect storm that's going for the rupee, and it doesn't look like the storm has blown over.
Lata, many thanks. Now, Tata Motors may acquire Italian commercial vehicle Iveco Group from the Agnelli family. The company owns brands including Fiat and Ferrari. Sources tell us the deal is likely to be valued at $4.5 billion. Shares of Tata Motors down in trade on the back of this development. Parikshit is standing by with more. Parikshit, the likely contours of this deal.
Well, this deal has been in the works for the last 1 year, and Tata Motors has been looking to buy a controlling stake in this Italian company, Iveco, which is a large CV maker with 70% of its revenues coming from the European market. Now, what will Tata Motors get with this? Well, it will get access to key export markets in Europe, North America and Latin America as well. It will get access to futuristic technology, which is important for the company going forward. This deal is likely to take place at $4.5 billion. We believe that both sides will come up with an approval today. When Iveco was reached out to, they said that talks have been in advanced stage to sell both their defense business and their commercial vehicle business. The commercial vehicle business is, of course, going to be acquired by Tata Motors from the Agnelli family of Italy. So we're hoping for an announcement to come in the next few hours, but this will be the largest ever announcement by Tata Motors after the acquisition of JLR.
Parikshit, many thanks. Now, French electrical giant Schneider is acquiring Temesex's 35% stake in their Indian joint venture. The all-cash deal is valued at around $6.4 billion. Schneider said the move gives it full control of its Indian operations. It will also boost decision-making in its third largest market. We'll head into a break, but up next, tsunami waves reached the shores of California after a strong earthquake jolts Russia's Far East. Evacuation orders issued across the Pacific. That and more when we return. Well, earnings season continues. Indigo's parent company, Interglobe Aviation, has missed estimates in the first quarter. Vinny is standing by to take us through Indigo's numbers. Vinny.
Thanks for that. Yes, a weak set of numbers that have come in from Indigo, but the expectation also was muted. So we were anticipating this weak number to come in from the company. Now, revenue just a growth of around 4.7% during the quarter. EBITDA margin, that's seen a contraction as well of around 100 basis point, more than 100 basis point, 28% versus 29.6% last year. Profits of the company, significant decline on that front, and all these parameters have missed the CNBC-TV18 poll. Now, talking about expenses, which are important, right? The fuel cost, which accounts to almost 40% of their expense, that's again muted during the quarter. Do not forget, crude prices were still benign even during this quarter. Then we have seen in July a bit of a spike up and volatility coming in there. So in Q1, fuel cost was down by around 9%. Aircraft engine rentals, that expense was down by around 21%. Now, surprisingly, we are seeing supplementary rentals, aircraft repair and maintenance, that has gone up by 18% on a year-on-year basis, as well as airport fee charges, that is up 28%. So that is something where we are seeing an increase coming in. This X of fuel cost, where that increase is coming in, has led to overall weaker yields also that we are seeing impacting the profitability of the company. So the yield for the company has, seeing a significant decline coming in at just 4.98 versus 5.24. That's like revenue per seat kilometer is what you could say that would be. Passenger load factor, significant decline, 84.6% versus 86% last year as well. And this all is related by three factors impacting the overall earnings. One, impact of India-Pakistan border issue, plane crash at Ahmedabad, as well as Middle East geopolitical tension led to a lot of rerouting as well as cancellations. That is the impact that came in on the demand and overall weakness that is led because of these three factors in Q1 FY26 for Interglobe Aviation.
All right, Vinny, many thanks for joining us. That's Interglobe Aviation for you. Swiss banking giant UBS doubled its second quarter net profit on a yearly basis amidst a boost from its investment bank and global wealth management divisions. Net profit attributable to shareholders hitting $2.39 billion, beating analyst expectations. Revenue during the period stood at $12.1 billion. CEO Sergio Ermotti told CNBC that tariff fatigue is beginning to affect client sentiment. The IPO of India's oldest depository, NSDL, saw strong investor interest on the first day of bidding. The 4,000 crore rupee public issue fully subscribed in just 3 hours after it opened. The subscription was led by non-institutional and retail investors. The retail portion was subscribed 1.73 times, while non-institutional investors subscribed 2.36 times the portion that was allocated to them. The government is exploring new opportunities for solar exports to the US and the Middle East amidst a slump in demand in Europe. Sources say the government is currently engaging with the American industry bodies to boost exports of solar modules. As per sources, the government is also addressing issues being faced by domestic solar equipment manufacturers. This month, American solar panel makers filed a case against Indian companies accusing them of dumping cheap goods in the market. They also sought to impose tariffs. Microsoft has restored services to Nayara Energy backed by Russia's Rosneft. This after the energy company moved the Delhi High Court. Nayara alleged corporate overreach by Microsoft and argued that Microsoft is not bound by Europe's sanctions on Russia. Ashmit joins us now with details. Ashmit, relief for Nayara, but this is also an interesting case that could be a precedent.
Indeed, an interesting question being raised by Nayara Energy. It's backed by Russia's Rosneft. It was formerly SR Oil. For context, it has a refining capacity of 20 million tons per annum. That represents 8% of India's total refining capacity. And this was the very question raised, that Microsoft has suspended fully paid services tools from Nayara Energy on the back of July 18th EU sanctions. The question that was raised before the Delhi High Court was by Nayara Energy that Microsoft is a US-based entity. Sanctions have been imposed by the EU. As far as Nayara is concerned, it's an Indian entity. So this question that was raised is that can a US-based company deny services to an Indian company on the back of EU sanctions? Now, this question was raised in the previous hearing before the Delhi High Court, and it is in response to that we understand Microsoft counsels appeared once again today before the High Court, where they clarified that they've taken this question into consideration and on the back of that have restored the services going forward. So to that end, this issue has been resolved for now. But Microsoft also issued a statement where it clarified that it's restored, number one, the services, and that it is an active communication engagement with the EU to understand and ensure continuity of services for Indian players such as Nayara Energy going forward. on the back of these EU sanctions. Back to you.
Many thanks, Ashmit, for joining us. Israeli forces continue to bombard Gaza, killing at least 16 Palestinians, including 13 aid seekers since dawn. British Prime Minister Keir Starmer has told his cabinet that the UK will recognise the state of Palestine by September unless Israel takes substantive steps to end its war on Gaza. Ukraine and Russia continue to trade fire. Kiev has said that 17 people have been killed and 42 were injured after Russia attacked a prison in the country's southeast region. Russia, meanwhile, claims that 3 people were killed and more than 50 apartments were damaged in a Ukrainian drone attack. The US president has said that Washington will start imposing tariffs and other measures on Russia by the 8th of August if Moscow shows no progress towards ending the war. A powerful 8.8 magnitude earthquake struck Russia's far eastern peninsula, triggering tsunami warnings across the Pacific region, including Japan, Hawaii, Alaska and California. As per the U.S. Geological Survey, this is one of the 10 most powerful earthquakes recorded globally in modern history. The quake damaged buildings, injured several people in the remote parts of Russia. Tsunami waves exceeding 3 to 4 meters led to partial inundation of the port of Kamchatka. Japanese authorities have asked nearly 2 million people to evacuate coastal areas as at least 3 tsunami waves hit the country. No injuries or damage has been reported there so far. Alaska and California also witnessed some tsunami waves. Flights to Hawaii were either diverted or cancelled. Officials have downgraded the tsunami alerts in Hawaii to an advisory level, but asked residents to remain cautious. Indonesia, Canada's British Columbia and US states, including Washington and Oregon, also remain on alert. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Let's Talk Money.
Hello and welcome. You're with us on Let's Talk Money. I'm your host, Surabhi Upadhyay. This is an important episode because it deals with regulation. Market regulator SEBI has come out with a draft proposal that seeks to alter the rules that govern mutual funds. Now, this is a proposal which includes changes in regulations for thematic funds, sectoral funds, value, as well as contra funds, just to name a few. SEBI is also considering allowing asset management companies to launch a second scheme in the same fund category if the first fund or the first scheme has become too big to manage. So we'll talk about all of this and what these changes could mean for us investors with Feroz Aziz of Anand Rathi Private Wealth. And since Feroz is here with us, we can't let him go without making him give us some fund ideas. So today, Feroz on the show is going to talk about some underperforming funds which could be turning the corner very, very soon. So stay tuned for that. Feroz, great to have you back in the studios. Thank you so much for joining in.
Likewise, Surabhi, it's always a pleasure to be with you.
So I know the hotter topic is these funds which are underperforming and, you know, which ones could start turning around. But before we talk about that, the whole cyclical nature of mutual fund performance, let's spend a couple of minutes because we really want to understand this new SEBI circular. I read through it, fairly exhaustive. It's talking about a lot of changes, categories, what can the portfolio hold, not hold. What are your first thoughts?
My first thoughts are that SEBI has started going deeper and deeper and logical, more and more logical with its decision making. So that's the first thing which if I look at a circular 5 years back to today, the circulars, or at least proposed circulars or proposed draft circulars are so married to the ground reality, and the client's centricity has, if I have to rate this on the client centricity scale, I would say it's 9 on 10. If the 5 year back circular I would have read, there were some collateral damages to a client, but this is a beautiful circular.
Okay.
But there are three broad headlines on which the circular is operating. One is to say what additional leeway can be given to the fund manager to deploy his underutilized cash when equity markets are overheated. That's one.
Yeah.
Second, intersection between schemes create bubbles in stocks. And they smudge the line for a client to decide which one to buy. That's the second area.
Yeah.
The third is bigger schemes.
Yeah.
Again, when there is difficulty to manage, what can a fund manager do? So it solves fund manager problems, market valuation problems, and clients' return being enhanced. If a fund manager is not believing in equity today, and if he has 10% cash, what are his other alternatives other than leaving it in GSEC and at 5-6% is what it addresses. So all three stakeholders, important ones, have been covered.
Absolutely. And you've distilled it down so very nicely for us. I think over 20-page long circular. And those are the three broad pillars that we as investors need to be aware of. So let's take up the first one, where the circular is now willing to offer. By the way, these are not final rules as yet. It's still, I think, a draft proposal. But SEBI is now proposing that, let's say, if you have a large cap fund or if you have a mid cap fund, and there are certain set limits that for a large cap fund, at least 80% must be in large cap stocks. What SEBI is saying that whatever is the residual portion, so in this category, the residual is 20%, say, that, Feroz, that can now be invested in equities, in gold, silver, and I think even REITs, right?
Correct. Yes. So can a fund manager be given a larger canvas? The answer is yes. Will people utilize their full limits? The answer is no. But if we trust the fund manager and his judgment and the asset management company's research, should he be limited to not having gold in the portfolio momentarily? The answer is, I would say that give them the freedom. If you trust them, trust them all the way, not just with equity, because they're not individual. See, asset management companies in India are about 40, 45, right?
Yeah.
It is not like a PMS where there are 500 licenses given. So it's more institutional. Mutual funds are more institutional driven. So it's not just one person driven. Like PMSs could be one person driven. So when there is an institution, there would be somebody running a gold fund, gold ETF. So you can borrow as a large cap fund manager. I would love to borrow my neighbor's fund manager's skill to see whether can I park money in debt at 6% or I think parking that money in gold for a year, the additional 20% will make more sense. So I think I would say this is one step better than giving them a larger canvas to borrow institutional capability.
But they will have to, I'm not sure if it specifies that the fund manager will then have to park the residual portion in the scheme of their own AMC. Is that how it's going to be, or can the fund manager actually buy gold or debt market securities and then add on in the fund?
No, it will not be a fund of funds.
It can't be a fund of funds, yeah.
But just that if you have research on REITs, for example, REITs have finished 6-7 years in India. The first one was Embassy REIT. If there is being research being done for another fund, you can borrow that research and then act on it or not act on it directly. You're absolutely right. It will not be a fund of fund. But I will have research on the same floor.
So you can add that to the portfolio if you feel that that particular main asset class doesn't, it's not necessarily giving the best returns in that period or that point in time. Let's talk about the second aspect, and Feroz, this is a really important one, right? This stems from the flurry of NFOs that we had. Sectoral funds, thematic funds, defense funds, whatever is in flavor, you'll see NFOs coming out on it. So now SEBI is saying that portfolios should not be overlapping each other. Explain to us what is being implied and why it's important.
Sector and thematic funds can be any number. See, large cap fund was curtailed, mid cap fund one. All the categories had one. There was one which is sectorial and thematic. There is no limit on the number of themes you can have, right? You can create any theme for that matter. But if you are creating themes just to have NFOs, not all AMCs do that, but you are sometimes tempted from a marketing and a sales standpoint to create capital market theme and then financial infrastructure.
Financials.
If you say financial infrastructure, then you have all these scams and the Carvies and whichever are the listed, KFINs, NSDL, CDSL, these are all finance infrastructure. That's a theme. Capital market is a theme. Now there's an intersection. So if you are going to confuse the client, at least make sure that there is lesser intersection. So because then everything which SEBI did in 2018 to regularize and reduce confusion, for which we have all seen the benefit, how the industry grew when you don't confuse a person. Like there's a study which says in a store, somebody was selling shoes, right? His art was, he says he sold, when he left two pairs, before he brought the third, people would buy nothing. He would always take back one pair to bring the third one back. So he, at any point in time, a customer was never given more than two choices. The sale doubled. So that's what SEBI did to the mutual fund industry, and we don't thank SEBI enough. That's what it did in 2018. If I had 5 large cap funds, I'm selling less. If there's one SBI has one large cap fund, his sale went up. Because there's lesser confusion. Lesser confusion means more action.
Absolutely, absolutely. So that is one thing that overlaps between these portfolios, whether it's a sectoral funds, thematic funds, or even value funds and contra funds. They should not have more than 50% overlap. That's what SEBI is proposing. The third important proposal that's come forth is allowing big funds to shut down and open up a secondary scheme. And I think this, for large AMCs and their flagship funds, this could go a long way, right? Because they've been complaining that the total AUM is so large that it's not easy, it's not agile anymore to manage the fund.
Absolutely. See, if you just visualize a fund manager, he's already getting a lot of money. He's not able to find so many ideas where he can deploy the existing cash. Now he has, let's assume, 47 stocks. I was speaking to somebody, some CIO. He's personally managing that. He's got 47 stocks. He knows that he wants to get rid of these 5 stocks. Now there is a lack of 5 new ideas which he has to bring in. He has to also see unko SIP 400 crore ki aa rahi hai mahine ki. Where does he put this 400 crores itself is a big problem to solve. And then he has these 5 to exit, and then he has to find credible, better solution than an exit. So it becomes very difficult. So its fund managers' lives have become very difficult to deliver performance. And the sales team of the asset management company is asking performance.
Of course.
And this is why it's a fund manager's biggest nightmare to manage a large fund with influx.
More money
so much money coming on a recurring basis. So I think that's the beauty, that you can launch a new fund. And my biggest fear of launching a new fund was then again people launch new funds and again it will become cluttered. But what SEBI has done very, very sharply is saying that it will borrow the same expense ratio from the first fund. If you're launching a second fund, you have to close the first fund, right? And the fund manager should be different. So all these protect any clutter and confusion which will build up if SEBI wouldn't have done this, or in the consultation paper, 10 years later again we would be solving what we solved in 2017-18.
Which is confusion, clutter, too many overlapping kind of funds. So it seems that all the proposals are getting at least Feroz's thumbs up, and it seems the MF industry perhaps will see it as a positive as well. Final point on this SEBI consultation paper, and what caught my eye, Feroz, was that they are talking about innovation in certain product categories. So mutual funds have these solution-oriented schemes, right? A retirement fund, children's fund. Now this paper is saying that within these categories, you can have 3 different types of funds. So for retirement, someone who has more risk-taking ability can go for an equity-oriented retirement fund. Someone who has a more conservative bent of mind, they can go for a debt-oriented retirement fund. And someone who's in between can go for a hybrid option. What did you make of this? And also give us an overview. I mean, how has the MF industry done when it comes to these retirement solutions? Do they really do the job?
In the current format, no.
Okay.
That's the good part of the change proposed. I'm sure this must be instigated by AMFI because that's... Now, if you look at SBI, SBI's retirement scheme has 2 options. One is the hybrid option with 38% equity and the conservative option with 19% equity. Now, in the wildest of my dreams, I would not plan my retirement using 38% as my maximum equity allocation.
Yeah.
Right? And even if I'm going to retire after 4 years, I will have more than 38%.
You want more equity, yes.
More equity,
yeah,
right?
Yeah.
In a high inflationary economy, your retirement plans, already we have numerous retirement plans running for 3-4 decades by government. All of them are debt.
Correct.
EPF is debt, PPF is debt, small savings is debt, everything is debt, and only mutual fund platform where retirement as a concept is being sold in a solution format has 38% equity in the largest asset management company. Does it require addressing? It requires addressing. SEBI is taking up that. I'm very happy because what Nirmala ma'am, Sitaraman ma'am has done is said that it has given the message saying that मैं आपके पैसे आपको decide करने दूंगी. I will not force retirement solutions on you by changing the new direct tax regime.
Correct.
Right? And she's been motivating them from 2021. If you're doing that and if you're going to take decisions and if you're not going to change your asset allocation, then you might as well have delegated to Nirmala ma'am.
But that is really saying something that till now, the maximum equity allocation in a retirement fund in India, managed by mutual funds, was just 38%. And which AMC was this, Feroz?
See, I'll tell you, the equity, I know of the SBI's, maximum is 38. Now, if you look at UTI retirement fund, which is the oldest retirement fund with 31 years, that also has 38, incidentally. Axis retirement fund has 38. All of them are below 40, but there could be some. There could be more equity, but I'm just looking at the top asset management company, SBI, and they're 38.
And so therefore, the average return over, I mean, have they really, met the mark in terms of what you'd expect from long-term returns from a retirement product?
Okay. So to compare apples and apples, now if I've spoken so much about SBI, 10% is the CAGR, 3-year CAGR for the retirement fund, and their flagship fund, I would call it the SBI Large and Midcap, which gave 22%.
Oof.
Right? ICICI Retirement Fund gave 11.64 for 3-year CAGR, and their flagship fund, which I would call the large cap fund, is 21. So is there a 10% difference? No, HDFC's retirement is 9.96, and HDFC's flagship is FlexiCap, as we know, 26%.
Wow.
Now, if you look at this kind of difference, then when you're calling it retirement, and then their own flagship, I'm not comparing HDFC with SBI.
Else.
There is a 10-15% CAGR difference. And now you extrapolate this for 20 years. The guy will have to cut down his lifestyle by 1/10 to 1/10.
But now we understand, because if the equity portion is capped at 38-40%, then long-term returns, how will you get the benefit of compounding? And hopefully SEBI is addressing that by now offering more flexibility in retirement products where you can have a much higher equity component as well. Okay, on that note, we do have to take a very quick break, but on the other side, we get Feroz to talk mutual funds, specific funds for you to watch out for. This time around, we'll discuss some underperformers and whether there is a turn in performance around the corner.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week Feroz is decoding the latest MF draft regulations for us, which we just did, and now we're going to talk about the cyclicality of mutual fund performance, which makes Feroz believe that some funds which have been underperforming in the last couple of years, they might be at the cusp of a turnaround. I'd love to ask the fund names directly, Feroz, but no, before that, let's do some theory. Has it been proven that mutual fund performance will always be cyclical? And if that's the case, it would become very simple, right? You keep chasing the underperformers and hopefully you make your own money. But people don't want to churn their portfolio every 2-3 years also. So how should we understand the cyclicality of funds?
See, are funds cyclical? It's proved if you statistically want that proof.
Okay.
Because we are all are an animal of mind and heart, both, right? So you open any textbook, will tell you, finance textbook, of course, will tell you that you buy low, sell high. But your heart is making you do just the opposite. See, HDFC FlexiCap was one of the biggest numbers I read, 26% in the previous segment. People who look at that 26% and be buying HDFC FlexiCap. Without forgetting that there were 5 years of HDFC FlexiCap being at the bottom, near bottom quartile, 2015 to 2020, right? 2014 to 20. What happens is, India loves buying past performance. Okay, and I was speaking to Quant, Sandeep Tandon, about a year and a half back. He says, "Yaar, last 15 days of my performance is good, I get more money in the next week." So that's how past performance is dictating our behavior. So using your show, which is of course a very popular show, I'm submitting to each viewer that whenever you get tempted to buy something looking at past performance, be it a stock or a mutual fund, take a break and reflect on it a little more. Okay, so that's called recency bias. This recency bias governs our actions. And I've done 30 lakh transactions, analysis of 9,500 families to say that we have recency bias, which is astronomically high. So now coming to, are funds cyclical? The answer is yes. If funds were not cyclical and everyone was buying past performance, why would we have 600 funds? Would all the money not gravitate towards the top 5 in 40 years?
That's true. That's
right?
true. It would be very simple. Just
Simple,
keep
right?
buying the past performers, but it's not that simple.
So there is cyclicality, is why there are 600 funds and money is distributed everywhere. Now, how do you prove that? Of course, there can be 2 tables which we can discuss to show that. Now, let's look at 1 year, like 2024. If there are best performing funds, best quartile, the top 25%, only 30% of them remain as top quartile for the subsequent year.
They slip.
70% of them go away.
Year.
And 30% remain. If 70 remained and 30% went away, then we won't be doing this segment of the show at all. But 70 are going away into bottom performance. And vice versa is also true. If you look at the worst 25%, 70% of them don't remain the worst and they come into...
They start improving.
They improve. In fact, they improve so much so that 1/3 of them actually move to the best category from the worst category. So past performance is
We should actually put up that graphic also if we have. I mean, if you just take an illustration, and I think Feroz put up some data. For instance, if you look at in the large cap category, the Mirai fund, the Mirai large cap, it used to be an underperformer over the last 2-3 years. But suddenly, there we have it. Look at this. The Mirai asset, this is a large cap fund of Mirai. It was ranked 30 in 2023. And in 2025, now it's at rank 2. And the converse is also true. The HSBC fund, which was doing much better in 2023, rank 14, has slipped to rank 33. So just an illustration to tell us that performance is cyclical. Okay, now point taken. Now, how do we apply this in our fund selection or fundraising process?
So what we do is we try and first also give immense importance to bottom quartile funds. See, all of them don't turn around. Very few turn around. Okay, you have to try and see what behavior does a fund show before the turnaround. If you can catch those behaviors, then you will be able to bet on the turnaround. One big turnaround we bet. In fact, one of the shows in Smart Money about a few years back, we had bet on HDFC FlexiCap in 2021, and that turned around beautifully. What trade did it show? It shows some traits. What is the trait it shows is, when you look at the stocks in the portfolio, those portfolio stocks have come into a super normal value zone. Now, if you look at the quant, large cap, let me give you an example. Quant large cap was one of the worst. It was actually the 34th worst fund out of 34 in the large cap category last financial year. It has only 18 to 20 stocks. He had zero exposure to banks, HDFCs and the ICICIs of the world. So the underperformance came not because the fund manager went wrong everywhere, but it came wrong because you didn't do banks and banks did well in the last 1 year. So point is, what do? You look at the bottom quartile, look at great fund managers and bottom quartile. If I get a Vasan's fund which is in bottom quartile, that's a great lottery. If there is Prashant Jain's fund in the bottom quartile, I would say they will turn around.
So look at the proven stars, fund manager stars, and if their funds are underperforming, then that's one reason why Feroz will definitely give those underperforming funds a very close look. Got that? So Feroz, now let's come to brass tacks. Which are the recent underperforming funds where you have your eye and you think a turn in performance might happen?
I gave quant large cap. I've been speaking about this turnaround. Now it has come to, in this last 3-4 months, it has already progressed, but I would say quant large cap and large cap funds, unlike the usual perception, are the most cyclical. A top quartile going to bottom and bottom coming to top is more prevalent in large cap than in mid caps and small caps. So point is, one is large cap, quant large cap. The second one is Motilal Oswal mid cap fund. It dropped from 1 number in FY24 to 31 in FY25. Prateek, who's the CIO now for the last few years, he has a very, very clear philosophy of bottom-up stock picking. And I personally think he has a reasonably corrected, underperformed portfolio, which he currently possesses. And that, if you look at it stock-wise also, you will get a better target NAV. DSP equity opportunities, these are the 3 turnarounds which I can, with a reasonable probability, 2 of them out of the 3 at least should turn around big time.
And recap for us the traits that make you think, so you said, a great fund manager with an underperforming fund, chances of a turnaround. What are the other traits?
Other traits are a little more technical. When you have an underperforming fund with higher churn ratio, that's a great sign that you're not sticking on to your mistakes.
The bad stocks that are not working or the underperforming stocks, you're turning to change things around.
Fund managers have this big problem of sometimes getting very egoistic about their calls.
I have bought it. It will work.
If you're churning, that means you're being humble about it. You're saying that, I went wrong. It's okay. I'm human. And then you're making changes. Bad performers, high churn ratio. Good performers, high churn ratio will always, good performers, high churn ratios will sustain the performance. Bad performers, high churn ratio will have a larger turnaround.
All right. Very, very interesting insights, Feroz. And it gives us a lot of food for thought in terms of how we're looking at, a lot of us would have these underperforming funds in our portfolio. So before you take that call, think about some of these points, discuss it with your advisor, and then decide what you want to do. Thank you very much, Feroz. As insightful as always. Great to have you in the studios again.
It's an honor.
All right. With that, we come to an end of this week's edition of Let's Talk Money. Remember to keep sending us your queries, your comments. Tell us what else you want us to discuss, and we'll see you on the show next week.
Let's Talk Money.
Hello, welcome to News Center. I'm Parikshit Luthra. US President Trump continues to keep India on the edge as the August 1st tariff deadline draws closer. Answering questions on Air Force One, President Trump said India could face tariffs of up to 25% in the absence of a deal. Trump also denied the finalization of any deal with New Delhi, along with India, Bangladesh, South Korea, Malaysia, Cambodia and Thailand are yet to strike a deal with the United States. The US did manage to sign a flurry of trade deals in the last few days. These include the European Union, United Kingdom, Japan, Indonesia, Vietnam and Philippines. All of them are facing tariffs between 15 to 20%. Meanwhile, Treasury Secretary Scott Bessent reiterated that the administration is in no hurry to sign trade deals. Speaking to CNBC, Bessent added that Washington is more concerned about the quality of the deal than the timing. While export volumes are expected to hold steady, industry warns a significant hit on profits. Textile exporters are already feeling the heat, with US buyers holding back orders. Chemical and leather sectors fear a potential loss of business if the 25% tariff is imposed. However, pharma companies don't anticipate a dip in demand just as yet.
Preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be for India?
They are going to pay 25%.
Yeah, that India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so. Look, they're my friends, and he's my friend.
Is the deal with India finalized?
No, it's not.
Okay, so what rate are you expecting?
Well, we're going to see. But India's been a good friend, but India has charged basically more tariffs than almost any other country. You know that, right? Over the years. But now I'm in charge, and you just can't do that. I think the trade deals are working out very well, hopefully for everybody, but for the United States, they're very, very good.
To take this discussion ahead, I'm now joined by Bhavin Mehta, Vice Chairman at Farm Excel, and Ajay Srivastav, founder of the Global Trade Research Initiative. Gentlemen, thank you very much for joining us on the program. Bhavin, if I can begin with you, how are you bracing for Donald Trump's tariffs? It now seems to be in the range of 20 to 25%. How is this going to impact India's pharma sector and exports to the US?
Great. Thank you so much, Parikshit. I think so. We are well balanced because if you consider the full exports of India, which is around $30 billion, around 55% comes from the regulated market and around 45% comes from the non-regulated market. So we are very, very well balanced between the both of them. And what I foresee is this has been going on from, I think so, more than 6-9 months. And even the tariff which is being proposed is yet not finalized. So I feel it's going to get stretched, and let's see what happens. But I feel we are in a balanced state and things are going to be good for us.
All right. You're expecting tariffs to get stretched. Let me also get in Mr. Ajay Srivastav at this point. Mr. Srivastav, 25% tariff is what Donald Trump is hinting. Will India be able to absorb these tariffs without major impact?
So, Parikshit, two caveats are here. If others are getting, say, 40%, 50%, I mean, what's our relative disadvantage? So everything will be announced on August 1st by Mr. Trump, and then we can talk about this. But right now, if we have to guess about the impact on different sectors, we have to talk sector-wise. For example, there will be no impact on, say, iron and steel, where the tariffs for everyone, all countries, deal or no deal, will be 50%, except probably for Japan. Everybody else will be paying 50%. Auto component, everybody will be paying 25%. So 6.6% of India's exports to US, no impact because everybody will be paying the same tariff. Then, out of our total exports of $86 billion to US last fiscal, there will be no impact on $25 billion worth of exports. Which are these? Smartphones, our largest item, about $11 billion of exports, zero tariff in the US right now. Pharmaceuticals, they are talking about 200% tariff, but right now the tariff is zero. So no impact on that. Then energy products, petroleum products, we export about $4 billion, zero tariffs. So $25 billion out of $86.5 billion, no tariff. $6.6 billion of iron and steel auto component, no impact because everybody will be having the same impact. But there will be impact on other areas. For example, garments. It's not easy to calculate right now, but if I want to talk about garments, then the largest supplier of garments to US is China. They'll be facing 30% tariff over and above the MFN tariffs of say 12, 13, 14%. If we are facing 25% or 20% plus MFN, we are slightly better off than China. Bangladesh, no deal, but they have announced 34% tariff in the letter. So it's worse off than us. So we are better off than Bangladesh. Vietnam, of course, they have a deal with 20%. And there is no MFN because they already have an FTA with the US running from the past 25 years. So we'll be in disadvantageous position compared to Vietnam. But with compared to China or Bangladesh, in garment sector, our position will be better off. So we have to keep our fingers crossed and let's see what happens on 1st of August. Similarly, we can talk about other sectors, but I think I'll wait for your question.
Right. No, I'll speak about the other sectors. You've spoken about garments, which is a large area of exports. What about leather goods for that matter, engineering goods, gems and jewelry?
Yes. Parikshit, leather goods are in the same bracket as garments. They have almost similar tariffs, 8% to 40% in US, and China is the largest supplier, and Vietnam is the second largest supplier. Vietnam has big advantage over us. We supply over $400 million worth of leather goods to US, and these will be impacted. But again, about 20 more suppliers are there. We have to see on August 1st how much disadvantage they face from Trump's side. Then if we talk about, say, gems and jewelry, our big sector, we export about $10 billion of gems and jewelry to US, and diamonds are about $5 billion. But I see we also import cut and polish diamonds worth $2.5 billion from US. So it's possible that diamonds are coming from the US. We are just cutting and polishing and sending them back. To that extent, the diamond sector may not be hit. I mean, half of it, but half of it may be hit. If it's hit by a tariff of say 25%, then it will be a major hit. Similarly, for jewelry, we export gold jewelry of value about $3.6 billion. And this will be hit. You know, most of the jewelry is mechanical jewelry, and mechanical jewelry has a valuation of say 3, 4, 5%. If I'm an Indian businessman, I'll be saving a lot of money if I set my smelter, my shop in US, start doing those things. So exports from India of gold jewelry will be difficult, mechanical gold jewelry. For handcrafted high-end jewelry, of course, the market will remain there because of high margins, but most of it will be affected. Lab-grown diamonds, we export about $700 million. That will be affected. And then I talk about engineering goods. Engineering good and chemicals. You know, here the major suppliers are Canada and Mexico. They already have an FTA with the US, so no MFN tariffs. So MFN tariffs are about 3 to 4% on these these products. And we have to see what tariff Trump decides on Canada or Mexico. We are hearing 30%. If it's 30%, then India will be neck to neck with them. So in that case, we may not have any impact or modest negative impact in that. So overall, I don't see any cause of alarm right now. But we can talk with more certainty once everything is out on August 1.
All right, so you're not expecting much alarm right now. Let me also go back to Bhavin at this point. Bhavin, Donald Trump has told reporters in the United States that he will begin implementing pharmaceutical levies as early as August 1st and increase rates in about a year or 18 months. He has threatened to impose up to 200% tariffs on imported drugs. If that were to happen, what will be the impact on the Indian pharma sector?
Yeah, Parikshit. As I said, that we are very well balanced between the two, because out of the total $30 billion.
All right, we will try and connect with Bhavin once again. Let me go back to you, Mr. Srivastav. Should India keep the option of retaliating open? Would that option be considered right now in the Commerce Ministry?
No, I think we should wait, because Trump is throwing many proposals almost on a weekly basis. For example, he says 10% tariffs on BRICS members. and 500% tariff on if anyone buying oil from Russia. So we have to wait. There is no need for any panic. Let's wait for 2, 3, 4 months and let things settle, and then we can take action. There is no hurry for that. Bhavin.
Right, and now Bhavin is back with us.
Yes.
Yeah. Bhavin is back with us. Let me go back to him, sir. So Bhavin, you were telling us about the possible impact of 200% duties on pharmaceuticals. How will that impact the Indian pharma exports?
First of all, I think so what the clippage that you had shown, he was talking about, say, 20 to 25% duty that he was talking about. In case that also, I feel won't be happening, because he also knows very well after India, as there's no other country to supply the drugs at the quantities that they require, right? So the point is, he also has to go in a very phased manner in case something is going to happen. Moreover, he has given Indian companies or all the companies to set up plants in 1 year's time. And we all know very well that to set up plants, it minimum takes 2 to 3 years, and then the approvals and all that, right? So I'm very sure as 1st August unfolds, I'm very sure something is there in it, and we'll be able to move on and things will be good for us.
Right. But are we seeing companies consider making investments in manufacturing in the US?
Currently, things are still on standstill because everyone is expecting what is going to happen on 1st August. So I guess we are still awaited that what is the outcome on 1st August. And we really don't know in 1st August what if the this deadline gets again stretched up, you know. So I think so it's better that we wait and watch, and let's look on 1st August what is the outcome. And based on that, the companies will decide how they want to move forward.
All right. Let me go back to Mr. Ajay Srivastav at this point. Mr. Srivastav, now, do you expect on the 1st of August tariffs to come into effect immediately? Because some exporters believe that it will not happen immediately. There may be a date when these tariffs would come into effect. And the general feeling is, even if it is a 25% tariff and there is a temporary panic in the market, there is a feeling that eventually we will have a BTA sooner or later.
Parikshit, last time Mr. Trump gave us 1 week's time to implement the tariff. Just 1 week's time. So, yeah, just 1 week time. So he may follow that deadline this time also. And I think we should not hurry for the deal since it has not happened so far. Let's see how he acts on pharmaceuticals, how he acts on BRICS, how he acts on his threat on Russian oil. Because the countries who have done the deal, look at them, what is happening. For example, Japan, I could never imagine they will sacrifice rice for their auto sector. In European Union, my friends are there, we have been talking there. They were saying that we are negotiating MFN tariff, forget about this Trump tariff, we'll get that. Ultimately, for the sake of their auto sector, I'm hearing this, I don't know how far I'm right, but I'm hearing this, that for the sake of their auto sector, they have sacrificed their agriculture. They also agreed to invest $700 billion, agreed to buy $750 billion worth of their oil, energy, despite knowing that US cannot supply all these things. So sacrifices has been very big. What they got in return, just 15, they have to pay 15% still over and above the MFN tariffs. So a bad deal and no deal, very little difference is there. So we should not hurry. We have made our
Mr. Srivastav,
Yes, please.
Right, we've made an offer. What are India's options at this stage? If the 25% tariff is imposed, and which is looking likely right now, if we go by Donald Trump's statements on board Air Force One, what should India do? What would be our options?
So India should be very clear. 95% of US exports to India, they are non-agriculture products. And we have agreed to open everything, eliminate tariffs. So US trade deficit problem should be taken care of. And with this, agriculture, dairy, most of it is our red line. We have made our offer. We should just keep quiet and wait for their response, because we are not in position like EU or Japan to fiddle too much with our agriculture.
Right, that indeed is an important point, and those, of course, are red lines. Should India consider making those big-ticket investment commitments?
So we don't know where do we have the capacity? For example, if Japan is making, they may be making investments in the US semiconductor complex. So in what sectors will be making, I don't know. And do we have the money? I don't think we have the money also to make commitments. We can make commitments to buy some of their oil if it comes at the right price, or some Boeings here and there because we need them. Beyond that, I don't think we have the capacity to undertake to invest. A developing country promising to invest in a developed country their dollars. I think it's far-fetched.
Okay, thank you so much for joining Mr. Srivastav and Bhavin Mehta for joining us with a perspective on the pharmaceutical industry. We're going to take a short break here on News Center. Lots more on the other side. Welcome back. You're watching News Center. Clogged or inadequate drainage systems leading to waterlogging, potholes on roads and decades-old bridges and skywalks showing visible signs of damage may be the hallmark of Mumbai's crumbling infrastructure. But it's not the most worrying. CNBC-TV18 Santya Gora reports that even recently constructed infrastructure projects across Maharashtra failed to meet global standards.
In June 2025, Maharashtra Chief Minister Devendra Fadnavis inaugurated the final 76-kilometer stretch of the Samriddhi Mahamarg connecting Mumbai to Igatpuri, completing the Mumbai-Nagpur Expressway. It cost 61,000 crores against the initial estimate of 55,000 crore rupees. But within weeks of inauguration, travelers began noticing potholes and cracks on the road. This is not the only large infrastructure project in the state to show signs of wear and tear within weeks of becoming operational. The 13,000 crore rupee phase 1 of Mumbai's coastal road was inaugurated in March 2024 and complaints of cracks along portions of the tunnel along the sea wall started pouring in soon after. The BMC says these cracks were not dangerous and part of a mastic layer applied to reinforce the road surface. Meanwhile, expansion and repairs of the 4,000 crore rupee Mumbai-Nashik Expressway has its own share of problems. It's been 6 years, but the expansion work on the Mumbai-Nashik highway is still ongoing. Construction work at multiple spots and huge potholes along multiple stretches have turned this expressway into a nightmare for commuters. And this is just the starting stretch of the 151-kilometer long highway. And despite NHAI collecting over 1,100 crore rupees in toll tax between 2019 and 2024, this is the condition of the highway. Dug up roads, huge potholes, bottlenecks, and hours-long traffic jam. Authorities have identified 9 major trouble spots along the highway that are a result of the ongoing construction. Each of these adds significantly to the travel time. Originally set to be complete by September 2024, it has a new deadline of December 2025, but only 60% of it is done so far. Opposition parties blame corruption for the poor quality of infrastructure despite cost and time overruns.
This triple engine Sarkar is actually a contractor Sarkar. We've seen time and again that huge tenders are taken out for massive infrastructure projects. What are these massive infrastructure projects? Concretization of the roads in Mumbai. Perfectly good roads, tar roads, asphalt roads that were existing in places like Bandra have been dug up, concretized, and then broken again because that concrete has had potholes in it just weeks after that road was concretized. So what they want to do is keep digging, keep giving out new contracts, and keep making money off of those contracts.
Experts add that a lot of the work is substandard and sometimes even an unnecessary expense.
This whole white topping business in the past 3-4 years is really a scandal and almost criminal, what has happened. And also the thing is that I think there is too much of a fascination with these very big high-ticket infrastructure projects, some of which undoubtedly are required. But if you look at Mumbai, it also has the distinction of having the worst internal city roads. I mean, it's a matter of shame what we see on our roads.
The state government, however, assures that the projects are being constructed after thorough study using world-class technology and expertise. Its heavy-duty pipeline of infrastructure projects is not slowing down either. The 80,000 crore rupee Shakti Peeth highway connecting Nagpur with Goa has received the go-ahead. Construction of the 76,000 crore rupee deep-sea port at Wadhavan in Palghar district has also begun. Other mega projects include the remainder of the Mumbai Metro project, the Mumbai Trans-Harbour Sea Link, and the Navi Mumbai Airport. But experts say the authorities will have to do a lot to shore up eroding public confidence in these projects. In Mumbai, Santiago Ra.
All right. The state of infrastructure in the country is a story that CNBC is tracking very closely. We will travel from Delhi to Mumbai to Bangalore to Kolkata to Chennai, and we will be getting you a series of reports how the infrastructure tends to crumble during monsoons. Let's move on. Now, from potato chips to protein bars, more and more Indians are turning towards healthier snacks. Shivani Bazaz finds out what this could mean for the 50,000 crore rupee snacks market.
From 25 rupees chips packet to a 250 rupee protein bar and makhana chips, India's snacking game has leveled up. Fueled by fitness, fast lives and fierce brand battles, the 50,000 crore rupee snack market isn't just about cravings anymore. It's about calculated choices, clean labels and conscious indulgence. And brands, well, they're queuing up for a bigger piece of the pie. According to Family Healthy Snacking Report 2025, India's snackers want more than taste. They want transparency. Busy professionals, fitness-first millennials and Gen Z consumers are seeking snacks that align with their lifestyle values and health goals.
The report says roasted dry fruits top savory charts at 36%, while makhana is having a serious moment at 19%. On the sweet side, dry fruit bites and protein bars dominate 45% of the market, signaling a big pivot from traditional mithai to functional indulgence. More than 55% of consumers now actively seek preservative-free, sugar-free snacks. Industry insiders suggest that of the approximately 50,000 crore rupees snack market in India, healthy snacks account for around 5,000 crore rupees. This is expected to touch 10,000 crore rupees in the next 3 years, because snacks are increasingly being seen as more than just fillers between meals.
People are not looking at three-day meals sort of concepts today. So people might have a very heavy breakfast and across the day they might actually not eat anything but only probably survive on certain snacks because that's how fast-paced the lifestyle is. But when they're surviving on snacks, now it becomes important.
But in a market flooded with bold claims, guilt-free, high protein, no added sugar, nutritionists are urging caution. The health halo around packet snacks can sometimes hide what's inside. No added sugar, for instance, can still mean ultra-processed, and high protein often brings high sodium or artificial additives along the ride.
So when you read the back label, so first don't go buy the product by just reading the front label. Turn the product, read the backward ingredient, what's going inside. Second, look at the first portion, first name that is mentioned. So if you're buying protein bar, first component should be having a protein. Maybe it's whey or any sort of protein. So you have to be very sure that it is real protein. It's not something first label in the ingredient list should not be maybe atta, because you're buying protein. So you don't want carb to be the first ingredient. That's how. Second, check the sugar. What kind of sugar it is sweetened with. Sugar that I support is mainly stevia, monk fruit I support. So those are the ones that I support. Erythritol are also fine, but definitely avoid this maltodextrin, maltitol. Those are the ones if they are mentioned in the product, they are sweetened with those. I would avoid that. And nowadays they are becoming smart. They don't write the name directly. They are putting up the codes.
The healthy snacking industry, though, isn't claiming to be perfect, only better than the alternatives. And the healthiest option is probably still those green veggies your mom used to make you eat.
India's snack economy is no longer just a volume game. It's a value game now. With health-conscious consumers willing to pay more for clean ingredients, this 50,000 crore rupee market is shifting from mass to mindful. The real growth now lies in premiumization, trust and product transparency. And brands that deliver on all three are poised to bite into the next big opportunity. In New Delhi, with VJ Pradeep Kumar, this is Shivani Bazaz.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
The single biggest way to impact an organization is to focus on leadership development. There's almost no limit to the potential of an organization that recruits good people, raises them up as leaders, and continually develops them. These words of author John Maxwell hold true for my guests today. With over 30 years of experience in the financial services sector, Reuka Ramanat has always been a believer that when the time comes, things happen. Not one to rest just on fate and serendipity, Reuka took many risks, pivoting from being a banker to an entrepreneur at ICICI Bank, and then to an entrepreneur who decided to venture into the world of private equity investing with her startup Multiples Asset Management, with close to $3 billion of assets under management in a portfolio of 30+ companies today. A self-confessed worshipper of entrepreneurship, Reuka is hoping to fuel the dreams of India's dreamers. It was on a plane trip that you decided the things in your life are going to be different.
When I sat in the plane, I said, I'm not going to look back because this is an opportunity for me to come back as a new person. The program was all about entrepreneurship, the near-death experience they have with their businesses. I was dying to have the same experience.
Really?
You know, liberating myself from being an employee into the launching yourself into the world of entrepreneurship. I just felt that I should give myself a chance. I should not be afraid of failure. So in Multiples, we worship entrepreneurship. You have to identify the blind spot and be that supportive investor. Indian families, now they are realizing that their children are not going to be interested to succeed. There are more exciting opportunities the subsequent generations want to pursue. Private equity is a very, very important source of achieving this. What VCP industry has done is really democratized capital and unleashed entrepreneurship in India.
Two young women who are looking at starting out, what is it that you would tell them?
I would tell them that, double down on your conviction. Brazen yourself, become very thick-skinned.
ICICI Bank is a classic example where women flourished.
If I was not in ICICI, with that cohort of women, there is no way today's Reuka Ramanat can exist.
Good to have you. I should have also worn a sari.
In Multiples.
How are you? Good to see you. Your therapy is also cleaning. Like me, I'm OCD about cleaning. So it's music, painting, and what else do you do outside your work?
No, I do a lot of yoga.
Oh, really?
Training, walking. On the physical side, Vipassana meditation.
Okay, nice.
Is another thing that I do.
How long?
Otherwise, just engaging with art. I love buying art without knowing where I will put it up.
What kind of music are you listening to these days?
Both classical and film music. Yeah, an instrument.
Do you sing?
I used to sing. I am a trained singer.
Really?
No, I trained for 25 years, from the age of 3 till the age of 25.
Wow.
Formal classical Carnatic music. Yeah. But given up also for that many, but I sing only for my grandchildren.
You know, I remember very distinctly, and I think I was watching an interview of yours where you said that you were always unmanageable, that you always believed that you should work alone because you're the most effective when you do things by yourself. So you've always been an entrepreneur at heart.
Absolutely, yeah. And I have to place huge gratitude to ICICI, the institution, and all my bosses, starting from super boss, Mr. Kamath, to all the other leaders like Lalita, Kalpana, Shika, who all nurtured, this entrepreneurial spirit in me and tolerated me for several decades. Yeah.
I'm given to understand that it was on a plane trip while you were going to the US to study at Harvard that you decided the things in your life were going to be different when you came back. And that was, in a way, the trigger or the start of your entrepreneurial dream. I won't say journey, but the start of the entrepreneurial dream. Take me through why that plane ride was so significant for you.
So, when I requested ICICI to sponsor me for AMP, this was something that came from my heart. It was not that ICICI had a very structured program where they would send their senior leaders for this course or something like that. And again, Mr. Kamath was so ready in sponsoring that. And when I sat in the plane, I said, I'm not going to look back. I'm not going to keep in touch on what's happening in ICICI, what deal, who's getting promoted, who got what increment, because this is an opportunity for me to come back as a new person. The program was all about entrepreneurship and the struggles that entrepreneurs, the near-death experience they have with their businesses. A normal professional would have got so hassled by, reading and going in depth into the experience of these entrepreneurs and would have said, oh, this is not for me. I should keep far away from it. And I was dying to have the same experience.
Really?
How do I go through those trials and tribulations to build enterprises? So I came back and again requested Mr. Kamath, can you give me an opportunity to do e-commerce or wealth management, which are the two big gaps.
You dabbled with the payment gateway as well.
Absolutely. So I went to a conference, just a routine banking conference, along with my then boss, Mr. Anand Mukherjee, and I saw Check Free. And I just got so inspired by the Check Free model, I said, hey, I'm going to go and build this in India. And again, because ICICI was an organization that encouraged innovation and new ideas, on the piece of a memo that I wrote, I got 15 crores of capital. And then I sent an internal mail to see who will volunteer to kind of set this up. I had an internal person, Bikramjit Sen, who put up his hand. And it was just reinventing this whole payment, bill payment business. We also set up our India's first payment gateway. My colleague Bhargav, was leading that initiative. Again, motivation came from me, and he was the guy who kind of built it out. And, we had to look into what are India's guidelines, what are RBI norms, which are very different from the clearing processes in the US. If I had not done those entrepreneurial ventures, probably I wouldn't have had the kind of training that I had to nurture other entrepreneurs through the investing business.
But you still, Renuka, had the sort of, the ICICI Bank name, the ICICI Bank legacy, and that's a significant legacy to sort of fall back on. So the decision to then say, I'm going to do this by myself. I'm actually going to start something of my own. How much of that was the belief that you wanted to try something different? How much of it was experience of having worked through some of these ventures that you decided, okay, I'm ready now to take the plunge?
So one, Shireen, in terms of conceptualizing a business, how do you go and sell the business to other stakeholders, whether it is building the team or getting the customers to buy from you or finding the capital. All of this training I had when I was in ICICI itself. The question was, can you just stand on your feet and will the market trust you? So what I said was, like how you would launch any new product, you would do a market test, right? You would choose your micro markets and you will go and try to sell the product and then get all the criticism and then improvise the product and then stage it to the world. I did the same thing. So I wrote my exit mail to a whole bunch of people in India who matter. Like Mr. Deepak Parekh, Mr. Sunawala, so many people at that time. And I went and met them and I said, look, I'm thinking of doing something on my own. Do you think it can happen? And each of them said, you could do this, but I wonder whether you have this, right? I'm sure you'll do a great job in investing, but do you have the money to set up your own firm? I'm sure you will get the money and you will do good investments, but will good people join you? And each of it, instead of rubbishing it, I would come home and think about it deeply and say that, if this is going to be a big problem, how am I going to overcome this?
So they actually helped you refine your proposal.
Exactly right. And understand what are the shortcomings in my proposal and how do I fill up the gap and how do I present myself. And some very interesting ideas came about there, saying that, hey, you don't have to pay your service providers with your own money. You can have a deal with them that when you become successful, you will pay them. I also reduced the amount of my personal money I had to burn, so to speak, before multiples became, had revenues of its own. So it was, I would say, one of my most beautiful experience of liberating myself from being an employee into the launching yourself into the world of entrepreneurship, and seeing how much goodness, how much trust, how much goodwill, how many good ideas and support come your way if you have a strong will to kind of do something new.
And an open mind, because I have to say, it's not easy to put yourself through that test. To put yourself up for scrutiny, because I think all of us only want to hear the good stuff, right? But when somebody comes back with feedback that could potentially be deterrents, that could be hurdles, that could be seen as weaknesses, were you afraid of how you would respond possibly to that?
Yeah, so Shireen, I didn't start multiples thinking that I'll definitely be successful. There were many other offers as well that came along the way, which could have de-risked my entrepreneurial journey. There were many institutions who said, take our business, you keep 26%. Some said, you keep 74%, and so on and so forth. But I just felt that I should give myself a chance. I should not be afraid of failure. I'm going to set myself exactly a 1-year target, and I'm not going to be endlessly pursuing this.
So what was the 1-year target that you had set?
At the end of 1 year, I wanted to pay myself salary. That was the target. So how
much salary did you take at the end of a year?
So I took enough to run my household, but the idea was that will you become revenue positive? So financially, I was extremely disciplined. I didn't have any baggage because this was a startup. All you had to do was to go out and raise money.
You were talking about those exit letters that you sent out. Was there an exit letter before the exit to Mr. Kamath? How did he react to it?
No, I would say that, Mr. Kamath has nurtured all of us, and, I owe everything I am to him. But for the opportunities, the guidance and the challenges that he placed along the way, I would not have emerged as the professional that I did.
Since we're talking about Mr. Kamath and ICICI Bank, Reuka, I want to ask you this, because this is the common perception, right, which we have heard ad nauseum, that women don't support each other, that if you have women in leadership roles within an organization, they very often pull each other down. I mean, ICICI Bank is a classic example where women flourished, women thrived across different roles pretty much at the same time. How do you explain that?
No, I would say that if I was not in ICICI, with that cohort of women who supported me through my several personal and professional challenges, there is no way today's Reuka Ramanat can exist. In fact, being in a cohort, being in a group of high women achievers who are pulling each other up, and who are lending a shoulder in your downtime is what was singularly responsible for us all to kind of float and emerge and come out so successful. So it's I would say they're completely baseless comment.
Where do you think it comes from, this perception that, it has been handed out across generations? Where do you think this stems from?
No, I guess people, these are all old cliched beliefs that women gossip, they are very jealous and they can't see other people successful. Like many other baseless assumptions about, if you're an unmarried woman, will you continue working after you get married? If you're pregnant, will you even come back after your maternity leave? These are all, completely unestablished biases coming from several generations. Even when I was in college, Shireen, many boys would say that I'm a wasted seat. I went to VJTI, which is a government college, and there used to be a lot of resentment that, this government is spending this money to educate you and get you an engineering degree, and all you're going to do is to get married and raise children.
Not
that that is bad.
But did they actually say that to you, to your face?
They did at that time. But we are talking about 1978 to 82. That is, that's how much understanding there was, about how much women can contribute to the growth of this economy, and what does a woman's determination really mean?
Yeah, well, speaking of biases, Reuka, when you finally decided to start, and it's been a 15-year journey for you at multiples, and the private equity venture capital market in India was very different 15 years ago, especially as far as the domestic market was concerned, and especially as far as homegrown private equity companies were concerned. What was the big challenge that you faced then when you actually went out looking for capital?
Yeah, so Shriram, I would say I faced an even bigger challenge when I went out to raise capital as part of ICICI Venture.
Really?
Because the market was even more nascent, right? One had to really go and sell this private equity product. And given how vibrant Indian capital markets are, IPO markets have been, right? I mean, from the 80s, people couldn't understand, why do you need private capital? What's the big purpose it's serving? Knowing fully well that the awareness around this product is very, very low, there is a lot of skepticism. And two, it's a very risky product. At the end of the day, you're giving long-term risk capital to enterprises, and it could go either way.
Either way, yeah.
I did one very good thing of deeply engaging these institutions.
Okay.
So I created two committees. There was an investment committee and there was an advisory committee. And I made sure that these institutions had representatives in both the committees.
Okay.
And I would go take a lot of effort and get my team to present up to the minutest detail about how investment, divestment decisions are being taken, the challenges of nurturing these enterprises. I could have chosen the other path of saying, hey, I've got the money. They have written a document where we alone take the decisions. Why should I involve them? I knew that the only way to build a business is by getting all your stakeholders on board, keep them deeply engaged, be extremely transparent, and get their support 100%. I want to recount a very interesting experience. When I got purchased Tata Infomedia from the Tata Group, it was a very big deal because Tata Group has never sold any business, and they were, for the first time, selling a business. And that too to a faceless entity called a private equity. Right? If it went from Tata Group to Birla Group, it would have been another matter. For whatever reason, the company bore the name Media. It was called Tata Infomedia. The circumstance was such that the CEO had to be replaced with a new CEO, and it was an important decision to be taken and implemented. Equally, I wasn't sure how the press will react, and more importantly, by reading the press, what our investors would react. So I was calling various chairmen of banks to tell them that this is going to happen, don't get hassled, I'm on top of the situation. So one bank chairman said, did I read the newspaper before I gave you money? I trusted your competency. Don't worry about what newspapers would write, So tremendous support. I firmly believe that the strength of a private equity or any alternate asset management institution comes from the stability of the investor base. How much trust you enjoy with them, how learned they are, and how deeply they are vested in the business and understanding of your investing style and the stability that they need to provide.
Hello and welcome to this special broadcast. This is what we've been waiting for, and the announcement has come in now from President Trump, posting on Truth Social and in all caps, I might add, for the benefit of our viewers who are tuning in. This is what has happened. President Trump has tweeted saying that India will have to pay a tariff of 25%, but that's not all. He's now talking about a penalty as well. Remember, there was no talk of a penalty. Now President Trump is talking about a penalty that will be imposed on India and China. So let's just read out, for the benefit of our viewers, what he has said on his Truth Social post. Remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country. Also, they have always bought a vast majority of their military equipment from Russia and are Russia's largest buyers of energy, along with China, at a time when everyone wants Russia to stop the killing in Ukraine. All things not good. India will therefore be paying a tariff of 25% plus a penalty for the above, starting on the 1st of August. This has come as a bolt from the blue. The 25% tariff, that was pretty much expected because President Trump has been saying that if you don't have a deal with the US, then a 20 to 25% tariff was likely to be imposed. But this penalty, and he has not quantified what the penalty is going to be. He's merely spoken about the penalty, and this is going to be imposed, as he points out, on India and China as well. This is the important development that has taken place. Remember the 1st of August deadline? Well, ahead of the 1st of August deadline, President Trump now making it clear that India will have to pay not just a 25% tariff, but also a penalty. Let's bring in Jayant Dasgupta. He joins us now. Mr. Dasgupta, of course, has been at the WTO and is a trade expert. Mr. Dasgupta, many thanks for joining us. As I pointed out, we were expecting a 25% tariff because that's what President Trump has been suggesting, because we don't have a deal in place. But this penalty that he is now bringing in, we don't know what the quantity is or what the rate will be, but this 25% tariff plus a penalty because India has been buying oil and defense equipment from Russia. Your first reactions, Mr. Dasgupta?
Well, if you calculate the tariffs according to the old formula which President Trump had used, then it comes to approximately 17.7%. But we had expected it to be rounded off to 20 or something above 20, but below 26, which he had imposed earlier. So 25 is, I think, that way not unexpected. But on the point of this import of Russian oil, Lindsey Graham and the other senator, they had proposed a bill allowing the president to impose up to 500% tariff on countries which were importing oil from Russia. Now, President Trump has indicated, of course, he keeps shifting, but he has indicated that he may impose tariffs up to 100% on countries which import oil from Russia. So we can apprehend some action which will be harsh, but the point is that we are not totally dependent on Russian oil, and we can always buy from other sources as well. As far as Russian military...
No, in fact, we've been buying from... We've been buying from the US, Mr. Dasgupta. We've significantly increased our purchase of energy from the US, but that doesn't seem to have stopped President Trump from threatening us with this penalty.
Yes, that is true. And the other point is that in order to bring down the trade deficit, we had informally, I think, promised that we would buy more oil and more defense equipment from the Americans. But that also doesn't seem to have really worked. And President Trump has gone ahead and announced this. But on the positive side, I think talks are still going on, and President Trump has the habit of saying something and then coming down, by several notches later on. So we hope that
yes, but you know, I just, Mr. Dasgupta, I'll bring in my colleague. I'll bring in my colleague Parikshit as well. But again, the language being used, and you know, Mr. Trump is known for using language that may not necessarily be seen as appropriate. But the language being used this time around in this post, and I quote to you, remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country. The language being used, calling our non-monetary trade barriers obnoxious, Mr. Dasgupta.
Yes, I think that leaves a lot to be desired. But, you know, for President Trump, I would say it is par for the course. He is not particularly known for his use of diplomatic language.
No, that he certainly is not. Parikshit, any reaction, any response, you know, from the Indian government at this point in time with this announcement coming in from President Trump?
The Indian government and Indian exporters. We've been speaking to exporters through the day, and a range of them, from the pharma sector, from the leather sector, to the textile sector, and the Federation of Indian Exporters. All of them were of the opinion that we're expecting something in the range of 20 to 25%. 25%, yes, will be a setback, will create panic in the market for some time. There will be a hit on profits and margins for the next couple of months. We are giving a lot of discounts to American importers, and all of that will have to increase. But now you have this question of additional penalty, and we don't know how much, because he's spoken about a penalty for India because we buy Russian energy and defense equipment, a penalty for India because we have a very high trade deficit with the US, because we have obnoxious non-tariff barriers. That's what Donald Trump said. So nobody knows the extent of the penalty that would be imposed. What seems right now that India, if it goes into the range of 35 to 40% of tariffs, then you could fall into a territory where you might be at a disadvantage compared to countries like EU, Indonesia, Vietnam, Cambodia, for that matter, even Japan. So that is a situation we did not want to be in. Our textile exporters, for that matter, leather exporters, footwear exporters, gems and jewelry. So let's see what happens. India would be weighing different options. Retaliation was one thing, but what we'll have to see is whether these tariffs come into effect within the next 4 to 5 days. Is there some room for negotiation?
He said the 1st of August. I mean, again, as Mr. Dasgupta is pointing out, you know, things change with every tweet. But at this point in time, on the back of what President Trump has tweeted, he is saying that these tariffs will kick in from the 1st of August, Parikshit.
That's right. So what I'm trying to say is, India would be trying to negotiate something behind the scenes. Those negotiations are still on. So we would try and see if there can be any sort of reprieve or delay for the moment. If that doesn't happen, yes, these tariffs are going to hit exporters immediately. Many of the orders have either been cancelled or put on hold. At least there will be some clarity, but the next few weeks are definitely going to be full of panic. There is going to be hit on profits and margins for exporters in the textile sector, in the leather sector, in the food processing sector, in the engineering goods sector as well. But there is a larger hope that there will be a BTA, but the conditions, the kind of conditions that Donald Trump is imposing, wanting us to cut off energy and defense ties with Russia, wanting us to make big-ticket investment commitments. And I'd like to just touch upon that, Shireen, because we're hearing that India has given a good deal from its side, minus agriculture and dairy, very similar to what we had given in 2017. But Donald Trump wants a big headline from India. He wants investment commitments. He wants India to go ahead and say that we will invest $300, $400 billion in the American market. You'll make big-ticket defense and energy purchases. US will become the trusted #1 energy defense partner of India. Those are the kind of statements that Donald Trump wants to hear. India has so far not given in to those commitments or announcements. So over the next few weeks, there will be a lot of hectic negotiations, I'm guessing. Currently, the Ministry of External Affairs, the Ministry of Commerce are reviewing this. We are going to have a reaction very soon. But currently, the government is trying to understand the exact impact. I'm sure the phone lines will be on between officials of the two countries to see what is the immediate impact, what is this penalty all about, because nobody had heard about this penalty coming into effect till yesterday. But I'm expecting a reaction from both the Commerce Ministry and the Ministry of External Affairs in the next few hours.
Yes, Parikshit, I would imagine that there will have to be some sort of a response to this. But hang in there. Let me also bring in Mr. S.C. Garg, the former Finance Secretary. He joins us as well. Mr. Garg, many thanks for joining us. As we pointed out, the fact that we would have to see tariffs come in from the 1st of August because we didn't have a deal, that I think the market was prepared for. But now it is 25% as per Mr. Trump's tweet. It's also a penalty, and there's a question mark on what that penalty is likely to be. But we also have to factor in that baseline 10%. So it's 10% plus 25% plus this penalty. Mr. Garg, what do you make of this development?
See, Shireen, I think we have got into a situation where we probably cannot do any business with the United States any longer. With this kind of tariffs, there is virtually no space for us to do business or export to them. Our exporters don't have any kind of margins to reduce the prices, and therefore they can only offer 5-7% type of things. That is not going to take anywhere. But that's, to my mind, is where we are hurt on the export side. But the bigger problem, which has caused why we have been cornered in such a situation, is our policies regarding agriculture and the imports from Russia and all. So you cannot give, because there is domestic constituency will certainly not be able to take on any concessions on the agriculture side. So since you have no negotiating space, you saw everyone else literally accepting 0% tariff for the American imports. Now, we are not in a position to do anything like that at all. So if you are not in that position to do that, you can't negotiate. So now, since he has announced, I don't think Indian policymakers have any options. If they go back to United States now, literally they would be pleading. They wouldn't be offering any of those things which he wants, including the other major things that you purchase from United States, the energy, the aircraft, and other things, or make investments. Our total outward FDI in a year is about $12 to $20 billion. You can't invest in United States even $10 billion or $20 billion. So everywhere on all the four kind of things, the tariffs to United States, the export tariff to India, purchases from there, all of them we are, or agriculture, trade, and we are, I think, boxed in such a situation, we just cannot do it. So in my judgment, the option is not to go and try to find some negotiation. The option is to stay firm and say, all right, if you don't want to do it this way, you don't want to do business with us, we will be fair enough, prepared to take some cut on our exports.
Yes, that is what it seems at this point in time. But Mr. Garg, just on that point about energy that we were making, since President Trump has called that out in his post, and as I was pointing out to Mr. Dasgupta as well, our imports from the US have gone up significantly in the last 6 months itself. India's crude oil imports from the US have jumped to 6.31 million tons in the January to April 2025 period, compared to 1.69 million tons in the same period last year. So India had already started to buy more. In fact, I've had several conversations with the Oil Minister Hardeep Puri, and he said we have absolutely no problem in buying more from the US, and we'd already started to see that happen. Even as far as defense purchases are concerned, we are buying from the US, and the view was that we will continue to buy more from the US. Of course, forget the fighter jet program, etc. That's a separate story altogether. But there were conversations on, and there was clarity on the path forward as well. But would you any indications on the back of what we've heard? Mr. Dasgupta was also talking about that bill that's been moved by Lindsey Graham, etc., which talks about a 500% tariff imposition on countries like China and Russia, countries like India and China that source crude from Russia. But this penalty that President Trump is talking about, I mean, it's hard to speculate, but what do you believe this could mean, Mr. Garg?
Shireen, the Indians have, I think, tried to accommodate on energy imports to the extent they could. It doesn't make sense for us to buy from the oil and gas from America. It's far away, transportation costs are very high. Still, you are trying to buy and show up that, yes, we will take up the flag, we'll buy the oil from you. You can't expect this to be applied to aircraft or defense equipment and others. The same logic. This is insane. It's not possible to do. And now, when you talk about the kind of 500% tariffs or penalty, which we don't know, if the penalty means that there would be higher tariffs, that would only be killing the exports to the United States, right? So that is the main thing. To save that export which we have, the export surplus which we have, if we keep on accommodating everything, that we will import much, much more, even at a higher cost, the gap between the exports and the imports will close. That one advantage we have will go. At what cost? Why should we do it? So the kind of regime which the President of the United States and his people are running that time, this is no trade, this is no business, this is sheer blackmail. That kind of business cannot be run. You should stop doing negotiations and talking about things till sanity comes back.
Yes, Mr. Dasgupta, as we heard there from Mr. Garg, at this point in time, what we do know, and before this development took place, was that the 6th round of negotiations between India and the US would have seen a US delegation come to India for the next round of talks sometime in the middle of August. Now, one would imagine that there isn't a complete derailment of negotiations and of talks. And as we've seen previously, I mean, there is a reason why there is a phrase called taco. Trump almost always chickens out. But, what should we be prepared for now in this scenario? Yeah, Mr. Garg, that question to you as well. As we've seen, Mr. Trump has made U-turns in the past, but given the fact that we were working towards the next round of talks, the next round of negotiations sometime in the middle of August, do you believe that this is now going to derail things completely, the manner in which President Trump has gone about this?
This is derailed. There is no question about it. I don't think we should entertain anybody in the middle of August to come and negotiate. What will they negotiate? When you have madness from the other side, you don't negotiate. If you're prepared to do a business deal, you can do a business deal. But if it is a madness and insanity on the other side, you can't negotiate. So I think this should be off. What I am most worried is that India should not be seen as a weakling now and succumbing to this big pressure and the blackmail and going with a tail inside its legs and say that, all right, Maharaj, we will accept what you say, we will do this and that. That would be a sheer surrender. That shouldn't be the case. We should call it off all the time. Fair enough. Whatever exports Americans want or whatever imports American wants from us, we should offer at the price at which we are offering. Let them impose the tariff and let their consumers pay for it. Why should we bear that? If they are not interested to buy any of the Indian goods, fair enough, don't buy. By the way, others are also going to feel. It will be interesting to watch how the Vietnamese and the Indonesians and others will absorb this 20% or 18% of the extra tariff. Will they reduce the cost? My sense is they'll not do it. They'll leave the Americans to pay for the Trump's ideas and decisions. If rest of the world does not bear any part of these extra tariffs, believe me, within 1 month, the Trump administration will collapse and come to senses.
Yeah. Except that is not what we're seeing happen, at least at this point in time. But Mr. Garg, you said that India should not succumb and India should let things, bring things to a standstill. Still, in your words, sanity returns as far as the U.S. administration is concerned. But what about any preemptive retaliatory action now? Do you believe that, we should just let things lie, or do you believe that we should respond in some fashion?
I don't think we should respond. That hurts Indian consumers. That doesn't hurt American exports. See, whatever we are buying from America, much of that is, let us say, the machines and equipment and other things. That is what probably we need it from America. Elsewhere we can't buy. So if we buy that at a higher tariff, or if you say that we don't want to buy that, that is a different matter. Either you say that we'll cut down on the imports from America. That is and if you can afford that all right, we'll not buy these things. That makes sense to me. But if you buy the thing from America, but at a higher tariff, it doesn't make sense to me. So I don't think we should retaliate in the form of extra tariffs and all. We already have higher tariffs. That is what they wanted to reduce. We shouldn't raise it that further. One should carefully take a decision that these are the things which we'll stop buying from them. That's the only thing we should do. Rest of the things, we don't get into this madness game of retaliating.
Right. Mr. Garg, please hold on, sir. We've also got Ajay Sahai, the Director General of the Federation of Indian Export Organizations, with us. Mr. Sahai, many thanks for joining us. We've, of course, been speaking to you and FIO and other exporters over the last few days to understand how the export ecosystem was preparing for the 1st of August. Now, what is clear is that there are tariffs coming on the 1st of August. What is clear at this point in time, and again I highlight at this point in time because we've seen President Trump change his mind very often, but as per his tweet, it's 25% plus a penalty, and of course there's already that base 10%. Mr. Sahai, this is the penalty aspect, and we don't even know what that is a complete bolt out of the blue. Your first reaction?
So definitely it's quite disappointing. We are still not certain what will be the exact duty. We were thinking that it will be in the range of 20 to 25. Even if it is 25, we have to see to what extent the additional duty can be absorbed by the Indian exporter or the buyer, because there are countries who will be subjected to much higher duty also. Those who have worked out some kind of FTA, they are also in the range of 19 to 20%. But since the penalty is not clear, the calculation from both the sides is not possible. Otherwise, we were expecting that lot of orders which were put on hold, the two sides will start doing the calculation when the duty is known. And probably since the additional tariff, the reciprocal tariff of a high 25% is for the limited time till India works out the BTA, they will be able to take a hit, and in the hope that once the BTA comes into, whatever little losses they may be incurring, they will be able to recover that.
No, but, again, and we don't know what this penalty is going to be, but it's 25% plus. There's also that base of 10%, Mr. Sahai. So, it goes to 36.
No, I think 10% is the reference tariff. It will apply to all the countries where he has not put any specific tariff.
Yes,
UK in any case will be 10%, we will be at 25%. It will not be in addition to 10%.
Okay, so you're saying it will be 25% and that 10% baseline will not apply.
Yeah.
So, so what happens now? Because, you know, we still don't have any clarity as far as this penalty is concerned. So, from an exporter's point of view, you know, what do you do in this situation till there is some indication of the rate?
So that's true. I'm saying still I'm that uncertain situation. Though I know that 25% at least is going to be imposed. But how do I do my calculation unless I know the penalty amount? Whether the penalty amount is 5%, whether it is 15%. Unless that is known, it's very difficult for the Indian side or from that matter, the US side to start doing the business. We have to wait for some more time to have better clarity on these matters.
Yes, we are. But Mrs. Sai, in your conversations with the government, was there any indication given that this could be a possibility, that there could be this penalty amount?
No, I don't think, but he has referred to, in respect to BRICS, he has referred to in respect of import of energy product from Russia. So I will not say that it is something which was not on the radar so far as Mr. Trump is concerned, but we were not factoring this additional tariff or the penalties on that.
Just hang in there, Mrs. Sahai. Let me also bring in Raymond Vickery. He joins us. Raymond, many thanks for joining us. We've just been reacting to the news that's coming from President Trump, a 25% imposition of tariff. But what is new now is this penalty that he's talking about, that he intends to impose on China and Russia for engaging with China and India for engaging with Russia in buying oil and defense equipment. Raymond Vickery, what do you make of this?
Well, I think that this is, thanks very much for having me. I think that this is a very unfortunate development. The U.S.-India relationship has been strong and growing under Republican and Democratic presidents for the past 30, 35 years. These two great democracies are key to solving world problems, whether it be in regard to China, whether it be in regard to climate. And this approach of my way or the highway is not the correct one. It is reflective very much of President Trump's background as a real estate developer, in that he takes a transactional approach rather than a relationship. That means it doesn't matter what happens in terms of even the midterm, certainly the long term, but who gets something out of a particular deal. That's not the way in which the U.S.-India relationship has been built. And this development will be harmful. That having been said, it seems to me that this is an opportunity for India to show leadership internationally. For too long, India has simply stood apart and said the West problems are the West problems in regard to Ukraine and other places. This is vintage Trump approach, and he wants to have more negotiation. So more negotiation should take place. You remember when the first came up about the U.S.-India trade relationship, we're talking about trying to move toward a free trade agreement sometime in the fall. President Trump, in terms of his own aggrandizement, has moved that up, but there should be further negotiation.
Well, you know, the negotiations, as I was pointing out, the next round of negotiations, the sixth round of negotiations is expected to take place in the middle of August, and we have a U.S. team that is supposed to be in India to take the talks forward. But Raymond Vickery, you know, you were talking about how this is going to be harmful for the overarching India-US strategic partnership. I mean, you know, these are two countries that have called each other natural strategic allies. What does this now do to the long-term relationship, to the long-term partnership? The former Finance Secretary here, S.C. Garg, speaking to me on the program, says that this is a derailment of significant proportion.
Well, it is a derailment of significant proportions, and I have written in other places that what we have entered into under the second Trump administration is an era of transactions. That it is not a question of building friendship and having trust. It's a question of what's in it for me right now. And this is the Trump approach. Unfortunately, India is going to have to deal with it. Others have simply bent the knee to President Trump. And it remains to be seen whether or not values, democratic values, will win out. Strategic values, particularly in regard to China and freedom of the seas in the Indo-Pacific area. All of these are thrown into difficulties, and it's because President Trump does not recognize that there needs to be a long-term relationship between these two greatest democracies. I do have sympathy for the perspective that India needs to take a leadership role now in terms of what happens, not just on its own borders, but throughout the world. I do have faith in India that it has the wherewithal and the stability, the adherence to values to be able to do this. But this is a crucial time, and unfortunately, Donald Trump is trying to make an example out of India in this regard, and it's going to take a lot of gumption on behalf of India to be able to work the way through this problem. The ties between the United States and India are overwhelming. If you look at what's happened on a people-to-people basis, Indian Americans in leadership positions here, the whole question of H-1B visas, the need to tap the best and the brightest throughout the world. But Trump doesn't recognize those long-term effects.
Yes, you're right in pointing out the Indian diaspora is a large cohort in the US and, of course, very, very influential. Most of the large US tech companies being run by Indian origin CEOs at this point in time, including now large consumer companies like P&G, etc., being run by Indian origin CEOs. But let me bring Anjali Prasad, the former envoy to the WTO, into the conversation as well. Ms. Prasad, many thanks for joining us. We are still trying to understand what this penalty means while we were factoring in the possibility of tariffs of 20 to 25%. But now President Trump saying there will be an imposition of a penalty. He has not quantified what the rate will be. Does that give you hope that there is wriggle room for negotiations between both sides?
Hello, thank you for having me. Can you hear me?
We can hear you, ma'am, loud and clear.
Yeah, okay. Now, first of all, I would approach this from a slightly different angle than my previous speakers. First of all, I have to say, aren't India and the United States, as well as other countries on whom a similar regime is being imposed, members of a multilateral trading system? We are. That is number one. Number two, if you were to do this unilaterally and announce tariff and so-called penalties, I'll come to penalties later, on various trading partners, First of all, the rules don't permit this. So you are creating an anarchical situation in the multilateral trading system. Now, what are these penalties? There is no provision for penalties on regular tariffs. So we don't know until and unless the details and the fine print comes out what these penalties are. Number 3, you cannot give the justification that just because India is trading with XYZ country or buying defense equipment from XYZ country, you get a tariff raise across the board of so-and-so and you get penalties, etc. Under what rules? Either you say you are not part of the multilateral trading system, in which case then you walk out of the WTO. But if you are, then you've got to follow the rules, I'm afraid. And in such a situation, as the previous speaker said, India should take a leadership role. India should take a leadership role. My version of the leadership role would be that we have the right to retaliate. If this goes on and goes on illogically, then we've got to get together with trading partners who are affected by it and then have the guts to retaliate on their most sensitive exports. We are a large market, and as I always believe that the world needs India's market to thrive and to grow its production. So we cannot be afraid of arm twisting, which I would call this clearly. And you can't have a bilateral deal on the side, the kind of deal that we are going on talking about. It's not part of any WTO rule. You see, either you declare a formal FTA, in which case, yes, it is covered. You can have a derogation from the rules and you can have your deal. But bilaterally, if you have a deal on the side, that is something not allowed. You've got to multilateralize all that you do. So if you are going to lower tariffs for the US, you've got to multilateralize for all the trading partners of the WTO. So this is complete arm twisting, trade anarchy that is being created. And the question here to be asked, and also to our establishment, is, are we or are we not members of the WTO? Are we dealing with another member of the WTO or not?
No, a very important point that you make. And of course, President Trump has made it very clear in previous comments that he doesn't much care about multilateral bodies or multilateral institutions. But you're absolutely right that in a way, this is trade anarchy, because these are unilateral decisions being taken by one regime being imposed on other trading partners. Ms. Prasad, I will come back to you in just a second, but we also have with us the former Commerce Secretary, Mr. Anup Vadhavan. Mr. Vadhavan, Anjali Prasad, their former envoy to the WTO, talking to us about what she makes of this development with President Trump unilaterally imposing not just 25% tariffs, but also now a penalty. We don't know what the penalty amount will be, but also imposing a penalty on China and India for dealing with Russia. Mr. Vadhavan.
Yeah, good evening. The most unfortunate and purely illegal act, as I think Anjali would have mentioned also, that it's absolutely contrary to USA's WTO commitments, and it's in violation of their bound rates, it's in violation of their MFN commitments, and clearly, the trade deal that was being negotiated, we could not, encourage the US to be reasonable in striking a balanced deal that addressed our sensitivities and satisfied their ambitions. So clearly, we were unable to convince them on a reasonable deal, which is unfortunate. And I think the options for us are clear. It's a purely illegal act, and ultimately, it's going to harm, the country that is imposing these tariffs, because it's going to carve a wall around the U.S., a tariff barrier around the U.S., and it will, encourage trade flows to divert elsewhere. So that's all I can say. It's unfortunate. We have very, very long-standing and deep ties, and we have ties across all dimensions. And this is, most unfortunate and uncalled for, and purely illegal. There's an international law which determines all these things. So that's what I have to say on this.
I understand that we're still trying to make sense of this penalty that President Trump has spoken of. But since both you, Mr. Vadhavan, as well as Ms. Anjali Prasad are calling this trade anarchy, you're saying that the imposition of penalty, for instance, in this form and fashion is an illegal act. What then do you believe India's response should be? How should New Delhi react to this development, Mr. Vadhavan?
Even the 25% duty is illegal. The penalty, of course, is completely illegal. So both aspects are illegal. And I think the options are clear. The very law that the U.S. is violating, the options are determined by that very law. We have the right to retaliate on violation of, their bound rate commitments. We have the right to retaliate on violation of the MFN principle, which the U.S. is committed to. And we must retaliate in the most effective manner open to us, which would include, all the digital businesses, services businesses which the U.S. has. They just don't count those earnings of, American entities. They're looking just at goods trade and discounting all those billions of dollars their digital companies, whether it's Google or Amazon or Facebook, or WhatsApp for that matter, earn in India. So we must certainly, convey some sense that the economic relationship has to be seen more comprehensively across goods, across services, across all aspects of our economic relationship. And to the extent they are being unreasonable and doing something purely illegal, then we certainly have the right to retaliate, and we must. And that should include, retaliation against their digital businesses, which earn billions of dollars in India. And they have a huge potential. India is a growing market. We can't forget that. And more importantly, I don't think we should worry too much about the economic impact of these actions. Ultimately, we are a $3 trillion economy approximately. Our trade with the U.S., whatever it is, 100 billion or somewhat more, our trade surplus, whatever it is, 30 or 40 billion, the heavens won't fall, Firstly, these duties will not be, trade stopping. A lot of areas, the trade will continue. Our exporters will adjust. To some extent, the American consumer will pay higher prices. And to the extent some aspects of our trade, get halted, there's an entire world to trade with. And our exporters, whoever is exporting to the U.S., they, I'm sure, are serving other markets also. So they'll focus their energies elsewhere. And India will adjust. It's a small blip as far as we are concerned. Given our economic size, given our economic potential, given our economic relations with the rest of the world, we will certainly withstand this. But ultimately, the U.S., especially if they repeat all these things with other countries also, will carve themselves out of the, global economic flows. And the world will adjust around them, and economic flows, to the extent they are disrupted with the U.S., they will find a passage elsewhere. So I'm not overly concerned. It is just, a bit alarming and shocking on the face of it, and outrageous, if I can use that term. But I don't think we should be very worried about it in terms of economic impact.
Yes, in terms of India's exports to the US. But, you know, Mr. Vadavan and Ms. Prasad, if I could come back to both of you on the point that Ms. Prasad was making. And Ms. Prasad, let me address that issue with you to start with. As you were pointing out that an FTA is one thing, but this bilateral arrangement, this bilateral agreement that was ostensibly worked on, you believe that that was probably not the appropriate route to take to start with, which is given the Trump administration this leverage that they're now exercising.
Look, the bilateral arrangement, as Anup explained, could violate their various commitments in the WTO. They have bound their duties at a certain level. We have bound our duties at a certain level. And if there is a gap between the bound and the applied rate, we have room to play with that. Okay. Now, if we do it bilaterally for the US, it doesn't mean that it will remain confined to the US. We will have to multilateralize it because it is not an FTA in the technical sense of the term. We have not started Article 24 negotiations with the US. So we will have to multilateralize it with all our trading partners, and so will the US have to.
Yes.
So therefore, it doesn't.
Ms. Prasad, if I could request you to just hold on, ma'am. Yeah. Sorry to interrupt you. I'm going to come back to you in just a second to complete that point. We're also joined by Rahul Chhabra, Secretary of the Economic Relations Division at the Ministry of External Affairs. Mr. Chhabra, many thanks. The former diplomat joins us. You know, as Ms. Prasad and Anup Vadavan, the former Commerce Secretary, were pointing out, this is in many ways the term used by Anjali Prasad, trade anarchy that is being imposed by the US administration. But where does this now leave the relationship? And more importantly, what is the way forward that you believe India should adopt in response?
Yeah, thank you, Shireen. Firstly, I agree with whatever has been said earlier. It's quite well explained technically, and Anup has also made the additional valid point that it may not be because of India-US trade just being over $100 billion. It may not necessarily have such a huge impact. So that is just purely looking at it from the trade commerce point of view. What I feel that the United States has done is they've sort of played their maximalist card. That's the usual style that President Trump has been adopting in all fronts. And leaving, I think there's still room for diplomacy, for some sort of negotiation, and some sort of give and take, a quid pro quo, may not necessarily flow in the commerce and in the trade field. There could be other sort of set-offs, which have been spoken about earlier also, in terms of defense purchases, LNG, the nuclear reactor, changing the, all sorts of larger issues also were in play and may not have been finalized. So this may be a sort of signal that we need to move faster, maybe offer a bit more. We'll have to see how, as diplomacy plays out, how this can be resolved.
What do you think, Mr. Chhabra, has led to this pass? Because by all accounts, talks were on. We were waiting for this next round, the 6th round of talks to take place. There seems to have been, some sort of a falling out between both sides, even as these trade negotiations continued. What would you attribute this kind of almost targeting of India by the Trump administration?
Not really. I think it's really President Trump, his personality, the way he sort of, the person he is. Whatever was put on his desk, it probably didn't sort of meet what he had expected or what he had thought would come out. So he has sort of just gone ahead and done this. So, I mean, there's always a sort of pullback. There's a, we can always negotiate. That's what a good diplomat does. That's what we all do all the time in the MEA. So this is sort of, he has given you, he's told you that this is what now is on the table. That's what he's putting on the table. So it's good in that sense. We at least know what we are up against.
Well, not exactly. We still don't have any clarity on what the penalty is that he's talking about.
Exactly. So all this is, I think, behind the scenes. Then I think his team would be communicating with our team, and there'll be a lot of back and forth going on. So this is really not the end game. So I think this is more to be looked at as, they put that card out there in the public domain. So it's no longer sort of behind the scenes sort of thing. Though we of course have got our own cards to play, and how we play it, what we are going to do with it. We'll have to see how this evolves actually.
Yeah, we most certainly will have to. We also got with us Mr. Kawal Sibal joining us. Mr. Sibal, many thanks for joining us. We're discussing the impact and the implications of the latest announcement that's coming from President Trump. How should New Delhi respond, Mr. Sibal, to this, to the language, not just what President Trump has decided to do, but also the manner in which he's decided to do it?
Very uncouth, very undiplomatic, extremely aggressive. He talks about our monetary barriers being strenuous and some other language.
Obnoxious.
Obnoxious. Look at this word. You don't use that word in diplomacy. And then what is even more perturbing is that he has linked this to the war in Ukraine. He has said that India is buying most of his arms from Russia, is buying most of its energy from Russia at a time when all countries want Russia to stop the killing in Ukraine. And it is because of that he's thinking of imposing a penalty. Earlier on, if you remember, he has said that he will impose 100% tariffs on those countries which continue to import oil from Russia. Now, clearly, it will not be 100%, but whatever it is, the thing is, he's strong-arming India. He has really won a decisive victory in negotiations with the EU as well as with Japan. So his tail is up. He thinks he can get his way, and India is relatively a softer target, he thinks, and he can bludgeon India into submission. This is part of his bullying and domineering nature. But what I'm worried is that he's in the process of wrecking the India-US relationship, because the kind of mistrust that he is showing after another 3 years or whatever to go is going to linger on.
Yeah.
And no country is, including especially India, likes to negotiate under duress. In fact, the two sides have reached some kind of an agreement. And as I understand, that both Lutnick and Greer had gone to Trump and thinking it was a reasonable agreement. But Trump obviously wanted much larger concessions, a complete opening up of the Indian market, or a near opening up of the Indian market, as the American side said. So I think it's going to be tough times ahead for us, and it has many other repercussions with regard to the Quad summit in September, October. What will be the purpose and the possible result of that in the context of Trump paying such little geopolitical attention to the larger relationship with India, and also at a time when he's closing up to China. In China, they've decided after Stockholm to continue to have negotiations and extend the time frame during which the tariffs will not be announced. So he is mollycoddling China, and he is kicking India he's kicking India around. So this is most unfortunate.
No, it certainly is most unfortunate, and it's also ironic that President Trump at the start of his presidency was reaching out to Russia and in fact was siding with Russia and had taken on Zelensky and Ukraine and asked Zelensky and Ukraine to do business with Russia. And this is President Trump now saying that India must stop doing business with Russia because he wants the war in Ukraine to stop. But Mr. Sibal, the question now is, what do we do? Should we retaliate, as we've heard Anjali Prasad and Mr. Anup Vadhavan point out, or should we, as Rahul Chabra was pointing out, hold still and let things cool down a little bit before we act?
Well, it's a difficult call to make. On the one hand, there could be an argument that Trump is a fighter. After all, he's very fond of wrestling, as you know. So the American style of wrestling. So, to take him on and provoke him, and then he may do something more irrational. That is one option. The other is to go to the WTO on some of the decisions he has taken, which are in violation of the WTO. And also what we could do is to stop in the tracks some of the discussions, negotiations we are having on the purchase of US military equipment, which I think we should do. There is this Striker business and there is this Javelin. We just should stop that. And if there's anything else that is under discussions, we should put everything on hold. Some pushback by us is necessary. Otherwise, a man like Trump, who's used to bullying and getting his way, and also he's shown the capacity to step back when he's challenged. So it's not as if he's terribly consistent. So I think if India just takes it in its stride and doesn't do anything in terms of a pushback, then we'll be in for even more difficulties in dealing with Trump. I think, on the whole, I would say that we can immediately try and see if through other channels something can be worked out. I doubt it if it can, but we cannot wait to show some teeth on our side.
Yes. We've also got with us Nisha Biswal, former president of the USIBC, joining us, was a member of the previous administration as well. Nisha, many thanks for joining us here on the program. We're all digesting the announcement that's come in from President Trump and trying to understand what this means, not just for the economic relationship, but for the larger strategic relationship between India and the US. Are you surprised? Are you shocked, Nisha, by what we've seen unfold? Nisha, can you hear me? We'll re-establish contact with Nisha Biswal in just a second. But, I want to go back to Anjali Prasad and perhaps also getting a view from both Mr. Sibal as well as Mr. Vadhavan. To Kaval Sibal's point, Anjali Prasad, that India cannot be seen to be doing nothing. We must show, in his words, some teeth. Now, while we react or we respond, but still leave enough room for us to be able to negotiate without provocation, what could those next steps be?
See, anything we do will be seen as provocation. Whether we retaliate on their exports, whether we go to the WTO, or we stop negotiating on other things which we may, the defense equipment or defense deals, etc. Everything will be seen as an affront to his supremacy. So this is not really going to be the end. Suppose you say, okay, let's not take on Trump because he might do something more irrational. Fine. Today you give in, tomorrow he will go a step further on something else. What is the guarantee that this is going to be the last of his, I'm sorry to use that word, but maverick actions? It is indeed anarchical. I don't remember a case in history where such a thing has happened in the multilateral trading system between two members. So we have to take steps and we have to think them through. That is true. We need not react immediately, but we have to react. I also agree with Anup that heavens will not fall, because India is basically a domestic market-led economy. And we can have other destinations for our exports in the medium term. We can look for them. But the fact that we are going to accept something which is a complete out-and-out violation of a treaty to which both of us are signatories is not going to be very, very, I would say, good on us, because he will do this to other countries as well. It will be an example. If India can be taken to task, so can others. So we may like to talk to some of our other trading partners as well, and then see how it works. But we have to take action. We have to take studied action on this.
Right. Let me come back to you in just a second, Ms. Prasad. Nisha Biswal, the former president of the US-India Business Council, with us. Nisha, we're still trying to digest the announcement that's come in from President Trump. While the tariffs were kind of factored in, this penalty, which he has not quantified, have shocked most people that we've been speaking to. Nisha, what do you make of this? What does this do not just to the economic partnership, but to the larger strategic relationship between India and the US?
Well, first of all, I have to say it's an unfortunate development. I had understood that India had actually had very productive negotiations with USTR that, as recently as a few days ago, I think we had been hearing from officials in both governments that a deal was very close. The U.S. had said repeatedly that they thought that they were achieving far more ambitious deal with India than had ever been contemplated before by any administration. And so I think that we were on the cusp of something quite historic and far-reaching. And so this development on tariffs is, I think, quite unfortunate, and hopefully is not going to be lasting, that there will be additional negotiations, discussions, and that, these two countries, which are so important to each other, such important partners economically, strategically, that they're going to find a way forward here, because I do understand that there is a deal within reach.
You're saying that you believe that there is a deal within reach, but where does that leave that deal that was work in progress, especially in light of this very public announcement? And it's not just the announcement that's been made, it's the manner in which the announcement has been made, calling India's non-monetary trade barriers obnoxious. Nisha, does this really leave room for the talks as they existed prior to this announcement to continue?
I do think that we have a president who tends to use very, very blunt language, and perhaps sometimes also, pivots positions quite quickly when he sees the opportunity. And so, yes, language is quite unfortunate and unwarranted. On the other hand, I think there's a lot at stake for both countries. And so what I would recommend is, India may decide that it feels like it needs to have a reciprocal action of some sort. I understand that impulse and that instinct. What I would say is no matter what action India takes, there should be married with any action an outreach on what does an off-ramp look like, what does an agreement look like. I think the sticking points are not that many or that significant, though I know that they are important sticking points for India. But it seems to me that further negotiation could overcome that. This is a president who wants to be hands-on and personally involved in negotiations. That is something that I think our Indian friends are not necessarily comfortable with, and are probably much more oriented towards a process where the negotiating teams hammer out agreements. But this is a president, as we saw in the case of Japan, in the case of the EU, and other countries, that wants to be able to engage directly. And that's something that I think India needs to think through and prepare for as well, if it wants to try to bring forward some kind of a deal. And I do think that there is something historic that is possible between these two countries. It's been a long time coming. It's not been without its bumps in the road and obstacles that have to be overcome. But I still think that it is feasible. In fact, probably more so because I think we're at an end stage where the president wants to directly engage and directly be able to achieve the outcome.
Well, that is one way of looking at things, and we'll have to wait to see how of course all of this pans out. But Nisha, just is there any indication on what we could be talking about as far as this penalty amount is concerned? Because he's kind of left that open-ended at this point in time. And we know what the Lindsey Graham bill proposes, which is 500%. So I mean, I'm imagining it's nowhere close to that. But is there any indication of what we're talking about?
Look, I think on the Graham bill and on the Russia piece, there's certainly a lot of, it's a very dynamic situation vis-a-vis U.S.-Russia policy, and I think India is caught in that. But it has been moving quite a bit in different directions, and so I can't say with clarity where what needs to happen on that front. I think India has been moving in recent years to diversify away from Russia in terms of its defense ecosystem, and that has been appreciated by the United States. And we have understood that there's a necessary kind of legacy relationship here that is important for India. Nonetheless, it has been a point of friction in the United States in years past. With respect to where we are on the trade deal, look, I think that the overall tariff rate is an issue of concern where President Trump wants to be versus where India and the negotiating teams on the U.S. side had landed, and that needs to be figured out. I think that there is residual pressure from the U.S. side to try to make some additional progress on ag and dairy issues. I know that that's a sticking point for India. And so I think that these are the issues that need to get resolved. But I think, it's workable. And honestly, I would urge, both sides to find a way forward here for the United States. And what I would urge the president is that, he has the opportunity to create a trade agreement with India that is truly historic and unprecedented, and one that would go down in the history books, because the United States has not had a trade agreement with India, in recent history. And so this could be quite a monumental achievement. And the way to do that is through dialogue and discussion. And I think it's unfortunate to bring about this kind of public pressure, and I don't know that that is necessarily going to achieve the outcome. I would hope that the two sides will still sit down and reach the agreement that I think is so close.
Well, yes, the public pressure certainly doesn't help. But Jyoti Vij of FICCI with us as well. Jyoti, industry obviously grappling with what all of this is going to mean, and especially with no clarity on what this penalty rate is likely to be. The 1st of August is here. How's industry reacting at this point in time, Jyoti?
So we are just trying to understand, Shireen, what the implication would be, because there is a new element which is penalty over here, and what that would be. But I think the hope is that, the discussions have really advanced quite a bit, and we were just hoping for a final BTA to happen. Our Indian team has really worked very hard, but obviously I think the national interest will remain supreme, as has also been pointed out by the Honorable Commerce and Industry Minister as well. But having said that, I think these two are very important markets, and we need to continuously work forward on, finalizing the trade agreement, because our relationship doesn't really stop at trade. We have a lot to kind of work together with each other, be it technology, defense, energy, advanced manufacturing, all kinds of area. The opportunity is humongous between the two countries, and it's very important for us to arrive at an understanding. This obviously causes a lot of uncertainty, and we do hope, with the kind of talks that we have had and the advancements that have been made, I hope that the engagement kind of continuously remains there, and we are able to, arrive at, certain conclusion in this space.
Yeah, Jyoti, I just wanted one clarification, and I'm wondering if you have any clarity on that. The 25% tariff, is this likely to be over and above the 10% generalized tariff that President Trump has spoken of, which will be imposed on everybody? Or do you believe that because there is a specific 25% rate, the 10% will not apply?
Yeah, honestly, don't have the clarity as of now. I think we'll have to wait and see the exact statement. I mean, what the statement really entails at the moment. But if it is over and above 10%, then I think it's going to be a real blow. But that's an important, I think, fine print that we need to understand.
Yes, we do need to get all of that, the details, and as they say, the devil does lie in the detail. And today we have a penalty, but we have nothing more on what that penalty amount is likely to be. But Ambassador Sibal, if I may come back to you, and we still haven't heard a response from the Indian side. There's nothing so far from the government on what they make of this announcement to start with, and of course how they intend to respond to this will be later. But Parliament is in session as well. Mr. Sibal, the room for manoeuvring our way through this, given the fact that this is happening all very publicly on social media and so on and so forth, does that limit the options? Does it constrain diplomacy?
Oh, yeah, absolutely it does. In fact, all this is coming at absolutely the wrong moment when the parliament is in session, when the opposition is finding every possible way to put the government on the defensive. Already, Trump has rocked our internal politics on this Sindoor operation by repeating 24 times that he was responsible for the ceasefire, and that he wielded the trade threat to force India to agree to a ceasefire, something which has been officially denied on the floor of the parliament by our foreign minister once again. He's also talked about mediation between India and Pakistan. He has reached out to the Pakistani field marshal in various ways. So he's playing the Pakistani card against us. And now he's playing the Russian card against us, despite the fact that, as you earlier mentioned, or somebody mentioned, that he's been reaching out to Russia in the hope of, getting a ceasefire between Russia and Ukraine, and having failed there, his language on Russia has changed. And from the Russian side also, there is now a pushback in terms of the language that they are using. Now he announces these tariffs, and the penalty, which the figure is not announced because he's hoping that there'll be some comeback from India, some bending of the knee by India, which will then, make him decide what the penalty should be. And if India resists, then he has the option open of imposing a big penalty on India. So he's on a kind of a warpath, political and economic warpath against India for reasons which are extremely difficult to comprehend. The relationship was going on, was proceeding very, very smoothly. He said that, he talked about having no trade, having no economic relationship with India, something like that, he said in his Truth Social tweet. Whereas, in fact, if you look at the progress in our economic ties, which have reached almost 200 billions of bilateral trade, it's been remarkable. And so has been the agreement to buy defense equipment from the United States. And on the technology side, India is deeply involved in the United States, and energy. Now, if he thinks that India must stop buying energy from Russia and buy LNG from United States, because he's forced the Europeans to buy LNG at 3 times the cost of Russian LNG. If he thinks he can force India to do that and buy more American defense equipment, as he is forcing the EU to do so, then I think we're going to have a very difficult time ahead. And as you rightly said, when the parliament is in session, when the government is on the defensive, when the argument will be made that you've invested so much in your American relationship and you are being kicked around, then what has been the success of your foreign policy? In this situation, the government it will be on the defensive, and I think will be pushed into some kind of a reaction. It should be a measured reaction to begin with, but depending on how things proceed, I think we can also up the ante on our side.
Well, yes, this is a developing story, but we've got the most credible voices here on CNBC-TV18 giving us an insight on where we could be headed and what our response should be, as you've heard there from Anjali Prasad, Kanwal Sehgal, Nisha Biswal, and many others like Anup Vadhavan and Subhash Chandra Garg. This is going to be complex. This is going to be difficult. The fact that it's happening publicly also leaves you with little room to maneuver. And any act on India's part will, as Anjali Prasad was pointing out, will be seen as a provocation. But India must also ensure that her interests are considered at this point in time, and we must not be seen as walkovers either, is the word that's coming in from all the experts that we've spoken. That penalty question, that's the big question mark, and we will have to wait to see if that is going to be what opens the room up for more negotiation between both sides, because that is what he hasn't clarified. He has clarified what the tariff is going to be come the 1st of August. But what we've seen with this regime is that, your things are only as good as the next tweet or the next Truth Social post. So we'll be monitoring that very, very closely as well. Ambassador Sibal, Anjali Prasad, Nisha Biswal, Jyoti Vij, Anup Vadhavan, many thanks for joining us here on CNBC-TV18. We hope that you will give us your time as we continue to track this developing story with its many angles, its impact and its implications. But for now, from all of us here, thanks very much for watching. Hello and welcome to this special broadcast. This is what we've been waiting for, and the announcement has come in now from President Trump, posting on Truth Social and in all caps, I might add, for the benefit of our viewers who are tuning in. This is what has happened. President Trump has tweeted saying that India will have to pay a tariff of 25%, but that's not all. He's now talking about a penalty as well. Remember, there was no talk of a penalty. Now President Trump is talking about a penalty that will be imposed on India and China. So let's just read out, for the benefit of our viewers, what he has said on his Truth Social post. Remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country. Also, they have always bought a vast majority of their military equipment from Russia and are Russia's largest buyers of energy, along with China, at a time when everyone wants Russia to stop the killing in Ukraine. All things not good. India will therefore be paying a tariff of 25% plus a penalty for the above, starting on the 1st of August. This has come as a bolt from the blue. The 25% tariff, that was pretty much expected because President Trump has been saying that if you don't have a deal with the US, then a 20 to 25% tariff was likely to be imposed. But this penalty, and he has not quantified what the penalty is going to be. He's merely spoken about the penalty, and this is going to be imposed, as he points out, on India and China as well. This is the important development that has taken place. Remember the 1st of August deadline? Well, ahead of the 1st of August deadline, President Trump now making it clear that India will have to pay not just a 25% tariff, but also a penalty. Let's bring in Jayant Dasgupta. He joins us now. Mr. Dasgupta, of course, has been at the WTO and is a trade expert. Mr. Dasgupta, many thanks for joining us. As I pointed out, we were expecting a 25% tariff because that's what President Trump has been suggesting, because we don't have a deal in place. But this penalty that he is now bringing in, we don't know what the quantity is or what the rate will be, but this 25% tariff plus a penalty because India has been buying oil and defense equipment from Russia. Your first reactions, Mr. Dasgupta?
Well, if you calculate the tariffs according to the old formula which President Trump had used, then it comes to approximately 17.7%. But we had expected it to be rounded off to 20 or something above 20, but below 26, which he had imposed earlier. So 25 is, I think, that way not unexpected. But on the point of this import of Russian oil, Lindsey Graham and the other senator, they had proposed a bill allowing the president to impose up to 500% tariff on countries which were importing oil from Russia. Now, President Trump has indicated, of course, he keeps shifting, but he has indicated that he may impose tariffs up to 100% on countries which import oil from Russia. So we can apprehend some action which will be harsh, but the point is that we are not totally dependent on Russian oil, and we can always buy from other sources as well. As far as Russian military...
No, in fact, we've been buying from... We've been buying from the US, Mr. Dasgupta. We've significantly increased our purchase of energy from the US, but that doesn't seem to have stopped President Trump from threatening us with his penalty.
Yes, that is true. And the other point is that in order to bring down the trade deficit, we had informally, I think, promised that we would buy more oil and more defense equipment from the Americans. But that also doesn't seem to have really worked. And President Trump has gone ahead and announced this. But on the positive side, I think talks are still going on, and President Trump has the habit of saying something and then coming down, by several notches later on. So we hope that
yes, but you know, I just,
the US
Mr. Dasgupta, I'll bring in my colleague. I'll bring in my colleague Parikshit as well. But again, the language being used, and you know, Mr. Trump is known for using language that may not necessarily be seen as appropriate. But the language being used this time around in this post, and I quote to you, remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country. The language being used, calling our non-monetary trade barriers obnoxious, Mr. Dasgupta.
Yes, I think that leaves a lot to be desired. But, you know, for President Trump, I would say it is par for the course. He is not particularly known for his use of diplomatic language.
No, that he certainly is not. Parikshit, any reaction, any response, you know, from the Indian government at this point in time with this announcement coming in from President Trump?
The Indian government and Indian exporters. We've been speaking to exporters through the day, and a range of them, from the pharma sector, from the leather sector, to the textile sector, and the Federation of Indian Exporters. All of them were of the opinion that we're expecting something in the range of 20 to 25%. 25%, yes, will be a setback, will create panic in the market for some time. There will be a hit on profits and margins for the next couple of months. We are giving a lot of discounts to American importers, and all of that will have to increase. But now you have this question of additional penalty, and we don't know how much, because he's spoken about a penalty for India because we buy Russian energy and defense equipment, a penalty for India because we have a very high trade deficit with the US, because we have obnoxious non-tariff barriers. That's what Donald Trump said. So nobody knows the extent of the penalty that would be imposed. What seems right now that India, if it goes into the range of 35 to 40% of tariffs, then you could fall into a territory where you might be at a disadvantage compared to countries like EU, Indonesia, Vietnam, Cambodia, for that matter, even Japan. So that is a situation we did not want to be in. Our textile exporters, for that matter, leather exporters, footwear exporters, gems and jewelry. So let's see what happens. India would be weighing different options. Retaliation was one thing, but what we'll have to see is whether these tariffs come into effect within the next 4 to 5 days. Is there some room for negotiation?
He said the 1st of August. I mean, again, as Mr. Dasgupta is pointing out, you know, things change with every tweet. But at this point in time, on the back of what President Trump has tweeted, he is saying that these tariffs will kick in from the 1st of August, Parikshit.
That's right. So what I'm trying to say is India would be trying to negotiate something behind the scenes. Those negotiations are still on. So we would try and see if there can be any sort of reprieve or delay for the moment. If that doesn't happen, yes, these tariffs are going to hit exporters immediately. Many of the orders have either been cancelled or put on hold. At least there will be some clarity, but the next few weeks are definitely going to be full of panic. There is going to be hit on profits and margins for exporters in the textile sector, in the leather sector, in the food processing sector, in the engineering goods sector as well. But there is a larger hope that there will be a BTA, but the conditions, the kind of conditions that Donald Trump is imposing, wanting us to cut off energy and defense ties with Russia, wanting us to make big-ticket investment commitments. And I'd like to just touch upon that, Shireen, because we're hearing that India has given a good deal from its side, minus agriculture and dairy, very similar to what we had given in 2017. But Donald Trump wants a big headline from India. He wants investment commitments. He wants India to go ahead and say that we will invest $300, $400 billion in the American market. You'll make big-ticket defense and energy purchases. US will become the trusted #1 energy defense partner of India. Those are the kind of statements that Donald Trump wants to hear. India has so far not given in to those commitments or announcements. So over the next few weeks, there will be a lot of hectic negotiations, I'm guessing. Currently, the Ministry of External Affairs, the Ministry of Commerce are reviewing this. We are going to have a reaction very soon, but currently the government is trying to understand the exact impact. I'm sure the phone lines will be on between our officials of the two countries to see what is the immediate impact, what is this penalty all about, because nobody had heard about this penalty coming into effect till yesterday. But I'm expecting a reaction from both the Commerce Ministry and the Ministry of External Affairs in the next few hours.